Today is Veterans Day, and Starbucks is continuing its commitment to supporting those in the armed forces. Coffee Giant has opened 62 military family stores to date, supporting veterans, military spouses, and the military community. Joining us is Matt Kress, Senior Manager of Veteran and Military Affairs at Starbucks, and Banna Miller, a representative from nonprofit Team Red, White, and Blue. Thank you to you both. Good to see you. And Matt, thank you for your service. And Banna, thank you for your husband for his years of service as well.
Thank you.
Matt, Starbucks has done historically some real good work working with veterans. What are you working on right now?
Well, we just passed hiring 26,000 veterans and military spouses, and we've opened 62 military family stores. And now we're really pivoting to meet the mental health and well-being needs of veterans and military families.
What do those 62 military stores look like?
Well, they're next to major military installations around the country, and they're meant as a place of community for active duty families. And then when military families are getting ready to leave the military, we work with veteran service organizations to provide the services that they need to have successful transitions.
And Banna, your nonprofit works with Starbucks, but a lot of other big companies. What companies are doing it right besides Starbucks?
Well, we're so grateful for Starbucks' support. I mean, we couldn't do what we do without them. And then we've got some other fantastic partners in the space as well, CBS and Comcast. So,
what are some of the challenges, Matt, for you, just going from that life in the military to transitioning into a job at a Starbucks?
You know, Starbucks was a great place to go into because of all the work that they've done in the past to work with military. But I would say for people coming out of the service in general, it's really hard, one, to find a place where they have the same sense of camaraderie, teamwork, and really understand how passionate you are about what you do.
Mm-hmm. You know, see, to your point, Starbucks has hired 25,000 veterans and military spouses. What's the longer-term goal? How are you planning for the next 5 years?
Well, the next 5 years, we'll continue to hire 5,000 veterans and military spouses or more each year. But as I said, we're really going to focus on the mental health and well-being needs of the military community.
Banna, what's some areas of focus for you as you look into 2020?
So we know that veterans, as they transition away from active service, are struggling with isolation, they're struggling with mental health, and our organization specifically has found that the connection between physical health and mental health is very strong. And so we attempt to connect those veterans and military members to members of their community through physical activity. Today we have thousands of our members working out in their communities for Veterans Day in our WOD for Warriors. And we're going to continue to focus on that connection between physical health and mental health throughout 2020.
Is corporate America doing enough?
I think with Starbucks leading the way, following that example, there's certainly more work to be done, but we're excited to have Starbucks' support and in that effort.
Now, what is it like having veterans working in the stores? What do they do that, let's say, a typical worker may or may not do?
You know, veterans and military spouses bring a great sense of camaraderie and teamwork to our stores, and I'll tell you, the enthusiasm and commitment that military spouses in particular have in our stores and that they bring to that environment is fantastic.
22 years in the U.S. Marine Corps. How was it like for you, just transitioning outside of that? What was that like for you?
You know, as I said, Starbucks made it easy because they had the same sense of purpose and the same sense of dedication to make the world a better place that I did when I was in the Marine Corps, and then in the 10 years that I was a firefighter as well. You know, Starbucks truly cares about making the world a better place. So for me, that made it an easy transition. I know that some of my fellow veterans don't have the same dynamic when they go into a corporate role.
Well, some big investors are eyeing a potential resurgence in Europe. A new report out from the Copley Fund Research says more than 80% of global investment funds are now overweight in European equities, with the exception of the UK. Copley attributes that to renewed expectations of expansionary policies from the European Central Bank and improved economic indicators driving growth in the Eurozone, along with cheaper valuations. Joining us is Tony Nash. She is CEO and founder of Complete Intelligence. Tony, how are you viewing Europe right now?
I wouldn't say we're quite as optimistic, Akiko. We are not seeing healthy economic indicators in Europe. We're not seeing the euro come to an interesting level. We're not expecting the massive fiscal spending that's been talked about, and so on and so forth. So the other real question is China healthy enough to receive German imports? We're not seeing that either. And so we're not quite understanding where the European optimism is coming from.
You talked about Germany. That's clearly been the big drag over in Europe, and obviously manufacturing slowdown there. You said you're not so sure about China and how healthy it is to kind of spur demand again. But if we do get to some kind of trade deal between the U.S. and China, how much of that would actually help the German economy, which is so reliant on that demand from China?
We actually think, excuse me, a U.S.-China trade deal would be harmful to Europe because China has to overproduce their manufactured goods. If there is a U.S.-China trade deal, it will likely restrict deflationary exports from China to the U.S. Europe is the only country with an income profile that can receive those deflationary exports. Japan's already amped down their imports from China since 2012. So, pardon me, so deflationary exports can only head to Europe. And so we see hollowing out of European industry with a China-US trade deal, and we see real headwinds for Europe more broadly.
So, Tony, having said that, when you look around the globe outside of the U.S., where are you seeing the biggest opportunities right now?
Mexico. We really are bullish on Mexico. We've said for about a year and a half that the ultimate winner of the U.S.-China trade war will be Mexico, as we see regionalization of trade patterns. And Mexico, when you look at power price deregulation in Mexico, you've got electricity prices coming down. You have a market that's proximate to the U.S., and you have a skills level similar to that of China, and you have CapEx and fixed asset investment on the rise in Mexico. So we are, of all the places around, we're pretty optimistic about Mexico and of course, the U.S. But Europe has real headwinds. We think on a relative basis, the UK will do better than Europe. And Asia, we're having a real hard time seeing a good story for Asia generally as China continues to slow down. China, Japan, Korea, Taiwan, Southeast Asia all continue to slow down. So it's really hard to see a positive differential for Asia.
Yeah, that's a pretty broad-based slowdown you just highlighted there. Going back to Mexico, though, how much of that bullish case for Mexico is contingent on the USMCA getting signed? And ultimately, what is your expectation on that front?
Yeah, we think the USMCA will get signed. Obviously, I'm sure you've heard there are partisan differences in the U.S. right now. So, that'll be slower than we expect. In any case, NAFTA is still in force until USMCA is ratified. USMCA has already been ratified in Mexico, so it just needs to pass through the U.S. There really isn't opposition to USMCA. There's more just legislative slowdown. So once that's in place, I think we'll see just a rejuvenation of U.S.-Mexico relations. I think we'll see a lot more manufacturing, a lot more higher value manufacturing rotated out of China and Southeast Asia into Mexico. We'll see more things like mobile phones made in Mexico, which haven't been to date, or very few have. And we'll see more sophisticated electronics equipment and high-value manufacturing there as well. So even things potentially like China's chip industry that hasn't really been able to get off the ground very well, we may see more and more of that type of investment in Mexico. It's good all around. If Mexico's fortunes rise, it's good for the entire region.
And Tony, finally bringing the conversation back home, we're coming off of a week where we saw record levels in some of the major indices. How much higher do you think that pushes going into year end?
We don't think it pushes much higher. I was, very publicly did a mea culpa about our expectations in November. We expected a fall of a few percent in the S&P in November, and it didn't, or in October, and it didn't happen. We're not bullish on the last 2 months of the year, but it's all a relative basis as well. We need to see what happens in other markets, but we don't see things going dramatically higher before year end. We do see things resuming in Q1. So, we're not calling some, bear rally or recession. If there is a recession, we think it's 2021 before it happens. That all depends on the election as well. But for the next couple of months, we expect things to be relatively flat to slightly negative. But we were proven wrong in October, so we're just going to wait and see what happens.
Okay, Tony Nash with Complete Intelligence. Good to talk to you.
Thank you.
Well, the overall U.S. unemployment rate has been hovering at 50-year lows. It's now at 3.6%. The rate of unemployed U.S. veterans is actually even lower. I was surprised by this. Last month, the veteran unemployment rate clocked in at 3.2%, and it's been below the non-veteran unemployment rate for 14 straight months. That's according to the Department of Labor, thanks in part to businesses like JDog Brands, which make it a priority to employ former members of the U.S. military. Most of the company's 200 franchises are owned and run by veterans. Jerry Flanagan, the aforementioned JDog, he's an Army veteran. He is JDog's founder and CEO. Thank you so much for being here.
Thanks for having me. Thank you.
So talk to me about the genesis of this business, and as a veteran yourself, how you sort of put that message out that you wanted veterans to be a part of it.
Well, my wife and I started JDog Junk Removal in 2011, and I started hauling junk in the neighborhood, and I showed up on time. Yes, sir, yes, ma'am. And a customer said to me, "Where'd you get this from? You're a junk guy. You should be dirty. What are you doing? You're all clean cut." I said, "I was in the military." And they said, "You should let the whole world know you're a military veteran." So we changed our strategy. I went home and said, "Tracy, we're going to be JDog Junk Removal, veteran and operated." And it took off. So we started hiring veterans from the local VA hospital. Tracy said, "We should franchise this thing. Everyone has junk. Let's get the word out there. Let's get the unemployment rate down to under 1%.
And when you talk about the franchises, it's over 200, 90% of which are owned by vets.
By military veterans, and the other 10% are veteran families.
Okay, so it's not just taking junk and dumping it. There's a real, you're helping, deal with I'll call it the garbage crisis.
Sure.
Because what is it, 80% of the product that you're picking up from our closets and our basements is either recycled or reused?
It's recycled, repurposed, donated. The franchisees are allowed to do what they want with it. A lot of them like to donate to organizations. Some of them like to resell some of the items so they can hire more veterans. So yeah, we go in, we clean out homes, and we try to repurpose everything we get our hands on.
Do you think a lot of big companies are doing enough to hire veterans?
I think they try to all follow the same playbook, and I don't know if it's working. I think that veterans need to go to a human resource department that's veteran friendly, so they can speak the same language. I think there's a big disconnect. Veterans don't trust big corporations, really. I think that what's different from us is we're all vets, and veteran families. So when they come to our office, it's camouflage everywhere.
When you advertise, if you advertise, whether it's in journals, online, do you point out so that we, the consumers, know we are hiring a vet-owned business?
Absolutely, because you're able to hire a veteran without running around trying to find a veteran to hire. When you hire us, when you show up, most people are going to be, it's going to be mostly veterans coming to your home.
I imagine when we talked about that unemployment rate being about 3.2% for veterans, I imagine that doesn't capture folks who are not in the workforce because of mental illness crises that they come as a result of their service or physical ailments that they have. What do you think the U.S. needs to do to also, help those folks? And are we doing enough for veterans overall?
Well, I think disabled veterans would work well in call centers. I think we can make a big effort there. I think they want to be involved, but they want veteran-friendly companies to work with.
Do you work with, we had a guest on earlier from JP Morgan Chase that talked about the 15,000 vets they've hired. And then when you look at corporations nationwide, the commitment is to hire 1 million vets within the next couple of years. The original goal was 100,000, and it's over 500,000. Do those organizations work with you? Because what you're also providing is more than just a job, it's ownership.
We'd love to have banks be better lenders. Unfortunately, they all follow the same SBA lender laws. And the GI Bill is used for school. Right. We'd love to see the GI Bill used for a business. After World War II, the GI Bill was allowed to be used for business. So when you saw those veterans getting out, almost 50% of them started a business. Today, it's about 14%.
Oh, wow. Is there any movement, any talk about changing that?
I need a couple senators and Congress people to start getting on that, because a lot of these guys do not want to go back to school. They want to just go out, start a business, and more importantly, if veterans own businesses, they're going to hire veterans, and that's going to really affect.
So where do you expand next? Is it 31 states?
We're in 32 states. We just launched J-Dog Carpet Cleaning, and one thing veterans know how to do is clean carpet and floors. We pretty much do it every day of our careers. And the idea is to get verticals going on in the service businesses so we can offer J-Dog painting, J-Dog plumbing, any of these other skills that people welcome you to in your home.
All right, Jerry Flanagan, thank you so much for being here. Appreciate it. He's the founder of J-Dog Brands. As you heard here, he is expanding into carpet cleaning, so keep him in mind. Thank you so much.
Thanks for having me.
Appreciate it.
Could farmland be the next big asset class? A new investment firm thinks so. It's called Acre Trader. It allows clients to invest in a piece of the nearly $3 trillion worth of farmland in the U.S. And Acre Trader CEO Carter Malloy joins us now on the couches. Hi, Carter.
Hi.
Thanks for coming on. Now, you guys just launched recently, right?
We did.
Okay, so tell me about the premise, like why farmland? How did you come to the idea to use this as a new investment?
Sure. I think from a big picture perspective, farmland's been an incredible performer over the long term. So over the last 30 years, roughly unlevered, so without using debt to amplify the returns, has returned about 12% a year annually. So pretty phenomenal investment returns in a very stable manner. So without the volatility you see in public markets.
And of course, I'd wonder what the trade war has done to that and if that's changing things. I mean, we know how much soybean farmers have been affected by tariffs and the China trade war.
Absolutely. So the trade wars have affected commodity prices, no question. Farmers live through these cycles of positive and negative commodity prices, up and down, up and down. It's just an unfortunate nature of the business. It has been since the beginning of farming. And so importantly for us as investors in the farmland, it's a simple rental relationship. So it's a tenant-landlord relationship between us as investors and the farmer on the farm. So actually we've seen no real discernible effect on the farm prices themselves. And again, that's a sort of a beauty of being an investor in farmland is our tenants are actually effectively backstopped by the government. Right? The trade wars have affected commodity prices, but for the farmer, the government has programs in place to help those farmers out to make sure to keep them afloat.
Well, this is kind of an interesting concept. I grew up on a farm, not really a working farm growing up, but you kind of touched upon it. How does an investor play it exactly? You were mentioning this tenant relationship to the farmer and I guess the investor. How does that work?
Sure. So it's a great question. Investors haven't really played it much in the past. Right. Private equity has been here. There's about 30 billion of PE money in the space now. It's up from 3 billion 10 years ago. So they've seen the trend. They're investing in it. For individual investors, it's kind of tough to go out and buy $1 million farm and go manage a farm. And so as a result, that's why you haven't heard a lot about farmland and its performance as an asset in the news. That's what we're here to change. So we take a farm, put it in a unique LLC, and allow investors to invest in that LLC. Then do that again and again. We have a dedicated team of people, farmland analysts, that go out and look at hundreds of farms every week looking for just the right investments for our platform at Acre Trader.
And then they earn dividends based on the asset valuation of the acreage of land?
Great question. You make money two ways investing in farmland. You get distributions, right? The farmer pays you rent every year. So unlike commercial real estate, we're not out fixing toilets and all kinds of problems. It's dead simple asset. So the farmer pays you rent every year, and in addition, you get asset appreciation.
So who are you targeting in terms of is it kind of, your
regular retail firms?
Right, average Joe kind of investing, or is it retail firms, funds?
Sure. All the above. So we have institutional investors active on the platform. We have family offices, and we certainly have mostly individual investors. Right now, accredited investors. In 2021, we anticipate opening it up to all investors in the U.S.
So accredited for now.
Right.
Not you. Not me.
Soon enough.
And my last question would be, some of these farms, I imagine, are family owned. And are you having to meet with these families and say, let us come in and here's how the system works and essentially buy the land from them?
Yeah, that's quite often the relationship. Is about 40% of U.S. farmland is non-tenant owned, right? So effectively it's already rented. So what we're doing is a highly common relationship with the farmer. In the case where it's a farmer selling to us, we do a sale leaseback transaction typically, and that's very simple. So.
Got it. All right, really interesting. Carter Malloy of Acre Trader.
Thanks for having me on.
Good stuff. Well, Alibaba is seeing record numbers on its 11th annual Singles Day shopping event. With minutes to go in the day, the event has already brought in more than $36 billion in sales, with $1 billion in just the first 68 seconds of Singles Day going live. Yahoo Finance's Crystal Hu is here to break it down a little more. Hi, Crystal.
Hi.
So Singles Day is so huge, and yet, I mean, we have our finger on it because it's the business press, but I think the average American consumer may be only vaguely, barely aware of Singles Day. But do you think that other companies, obviously Amazon, are watching very closely? Target, Walmart?
Yeah, for sure. I think they were watching their competitors' behavior very closely, and especially an event that has grabbed the headlines across the world. I think some of Amazon's sales event, like Prime Day, has seemed to be taken some playbook from Alibaba sales event, sometimes starting the concert, cutting down. Like this year, Alibaba had Taylor Swift, and also the ability that Alibaba was able to deal with such sheer amount of orders under seconds definitely demonstrate the ability that they have in terms of technology. Because you may remember during one of the Prime Day events, Amazon has this like a website shut down that we've seen a lot of dark photos. So I think that's something that they definitely want to learn from their peers.
Well, definitely something they'll be watching closely. And right now, we've got Chris Tung from Alibaba. He is the CMO, joining us live from Hangzhou, China. Chris, welcome, and thank you so much for joining us.
Thank you for having me.
Chris, I want to start with the numbers. I'm looking here, and you all are just approaching $37 billion when it comes to that gross merchandise value. We only have minutes to go. So I just want to get your sense on how important will GMV be going forward, and how do you think about topping it going into the next 11/11 festival?
Right. This certainly is a very exciting day for us. This year marks the 11th anniversary of Double 11 Global Shopping Festival. And we beat the number of last year around 4:30 this afternoon. So we're making new records every minute we go. So right now, the numbers are doing very well. We're trending towards $37 billion right now. And the last hour is normally a very exciting hour for the people who really want to seize the day. So it's super exciting for us and all the consumers that are joining the festival this year. And I think a lot of reason for another successful year for Alibaba is we keep working very closely with the brands to be able to launch new products to cater to the needs of consumers from different segments. For example, 200,000 brands are participating Double 11 this year, and they're jointly launching more than 1 million new products from their brands. So that's what makes Double 11 a very special event for consumers.
Chris, when we've talked in the past, we've talked about this concept of new retail, what that means for the future of retail. I know innovation is really important to you. Just looking at Singles Day this year, what is that one innovation that really stood out to you?
Yeah, we've been working very closely to support the brick-and-mortar stores by leveraging Alibaba's digital technology. The idea is really to integrate the online-offline experience for consumers to feel, a seamless brand experience anywhere they go. We've been doing pretty well. We have launched Fresh Hippo supermarket stores in China, and we have launched more than 170 stores in China. That's already set up a new model for grocery stores, chains. And now we're expanding this collaboration with more grocery chains, for example, in China, and by leveraging Alibaba's digital technology and to help those chains to going through the digital transformation and largely increase the efficiency of their operation and be able to create more personalized products and services for the customers offline. So definitely we are playing a very critical role in this transformative journey for all the retailers nationally.
Hi, Chris. This is Crystal. One follow-up question on GMV because we love talking about numbers here. Apparently, Singles Day have been growing exponentially in the past 10 years, and last year the GMV growth number was 27%. Do you see we can still achieve that growth this year, or is it still meaningful to look at that number at all?
Well, it's not just GMV that we are looking at, although it's you can see from how the number is trending right now, it's doing great. But the way we measure our success is whether or not we are providing meaningful and innovative activities and outreach to really engage more consumers to support the growth of the brands and merchants we're working with. And the other thing is, how do we take Double 11 beyond China and really cover more markets where Alibaba has built a footprint with different platforms to be able to help the brands worldwide, as well as help the consumers from China to be able to get more imported products from a lot of markets at the same time. So those are the important issues that we're looking at, and we keep driving innovation to support those initiatives along the way.
Chris, I know a lot of American brands has been working with Alibaba to participate in the Singles Day. Apple, for example, this year have using very aggressive promotions and have achieved a lot of good results. So why do you think premium like U.S. brands like Apple will see the need to work with the Alibaba to get access to the Chinese consumers? And do you think U.S. brands still appeal to Chinese consumers?
Oh, absolutely. I think the reason why more and more consumers are joining Double 11 is it's a great platform for the consumers to find the quality products from the brands they love. And I think many leading brands from U.S. are doing particularly well this year. We're seeing great success from even the pre-sale period from Estee Lauder's great success, and it hits the top-line news. And we're seeing Apple breaking the sales records even through a few hours into the day and versus last year. And other brands like Nike, Starbucks, Mondelez are doing very, very well. I think the key is keep offering the quality, innovative products to consumers, and there's still huge room to grow here, and there's still untapped opportunity in the less developed areas in China, where people has huge demand for quality products from all over the world. So this is really a great platform to drive continuous growth for the brands we're working with.
Hi, Chris. Brian Chung here. So you talk about the brand exposure of U.S. brands in China. You are listed here in the United States. You do have a lot of exposure in the United States, especially on the supply chain side of things. So I guess I'm just curious to get your thoughts on just the current U.S.-China trade negotiations right now. There's this phase one deal, but no one knows if it's going to be signed imminently or at all in the future. So I'm wondering how closely Alibaba pays attention to that. Does that create, or has that created so far, headwinds to your business model?
I think our focus has been how do we leverage our digital technology to build a platform that actually increase the efficiency for operation to support the trades between nations, and especially Chinese consumers in China are having this great demand for cross-border products. So how do we build an infrastructure that facilitates the trading and really understand more about what's demanded by consumers, and be able to work with the brands they like to import the products on our platform is really the key focus. I think it's really a consumer-centric approach we're taking, and we're gonna keep leveraging the technology we have to make the exchange more efficient than ever.
All right, Chris Tung is CMO of Alibaba. Thanks so much for coming on Yahoo Finance, Chris. Today is Veterans Day, and the veteran suicide rate is 50% higher than among non-veteran adults in the U.S. Stop Soldier Suicide is a group whose mission is to support veterans and help them receive the mental health care they need. And joining us now is Brian Kinsella, the co-founder of Stop Soldier Suicide. He is a veteran himself of the U.S. Army and a former Goldman Sachs analyst. Brian, thanks for coming on.
It's great to be here. Thanks for having me.
Great guest to have on for Veterans Day. Tell us about the organization, when you created it, and why, and how it's going.
Sure. The organization was created in 2010. Myself and two other former Army officers, all who went to the same ROTC program at Johns Hopkins, all who decided to serve after 9/11, saw the issue of military and veteran suicide firsthand under our own commands. We got together, decided to form the organization, originally designed around providing free mental health care services as a way to what we thought at the time would prevent the rising suicide issue. What we ultimately found out once we launched and went live was that people were reaching out from all over the country. We needed to help a lot more people than we expected, especially military families, veterans, not just those on active duty. And so we reoriented the organization back in 2011 to be much more of a triage assessment and then resourcing and case management organization, which gave us a lot more operating leverage to be able to help people at scale.
We're talking a lot about jobs for veterans as well, and I can imagine the transition can be difficult. Can you take us back to your time? You get out of the Army as a captain, you are a civilian again, and you're going to try to get jobs on Wall Street. Can you talk about your experience and then what you've seen from other veterans?
That's a great question, and actually Secretary Mattis did a great ad campaign piece over the weekend that came out specifically talking about if you want to honor veterans, help them get a job. And so definitely something we agree with. We think that from the data that we see, and data is really the key, in our opinion, to reducing the veteran suicide issue. But the data we see tells us that a lot of people that reach out to us for help are not necessarily struggling with post-traumatic stress or combat-related issues. It's more geared towards the transition process, with jobs ultimately being a key part of that. When I transitioned off active duty, this was before there were a lot of transition programs. So I ended up working in finance at BNP Paribas and then later Goldman Sachs. There really were not a lot of job transition programs, but it was awesome to see how the banks really were some of the first major companies to respond. In fact, Goldman has and really leads the way in their veteran transition program. They have a program called the Veterans Integration Program, or the VIP program, and they really, in a very targeted way, help to not just get veterans jobs, but also try to really place them in the best job at the firm that's aligned against what their skill set is.
And in addition to job training, what other types of resources does Stop Soldier Suicide, and then also maybe just broadly, what types of resources should be available to those beyond that can kind of help to address this issue?
So that's a great question. One thing we think a lot about, we've got over 4,000 partners that exist all over the country that we tap into. Again, our case managers, our clinicians create bespoke and custom plans, and then we not only make the high-touch transition, or the high-touch introduction, but then do 2 years or 3 years, even in some cases, of case management. And so, it isn't just about a mental health care service at the community level. So, substance abuse, therapy, it was things that you would traditionally think about, but it's also those job placement programs. It's canine, dog type programs, equine therapy. It's a lot of more holistic ways to kind of help that veteran or service member or family member in need, outside of just kind of the traditional mental health type resources.
Really important, really good work. Brian, thanks so much, and thank you for your service.
Thank you very much. Appreciate being here.
Well, honoring America's heroes today, the Veterans Day celebration rolls on. We're highlighting a bakery based in Washington, D.C. that aims to help veterans ease their transition back into civilian life. And joining us now to discuss is DogTag CEO Megan Ogilvie. Megan, good to see you.
Hi, good to see you too.
Thank you so much for joining us. I love this story and what you guys are doing there, because it's a nonprofit built around great products, but also helping veterans kind of integrate back into society and also figure out what they want to do. So where did this idea come from?
So we have two co-founders, Father Richard Curry and Connie Milstein, who are really pioneers in the space of recognizing how do you teach a man and woman how to fish. And so after 9/11, both of them turned their focus towards service members, military spouses, and military caregivers. And so our bakery is located in Georgetown. And so we actually use it as a living business school to teach entrepreneurship and small business, specifically to veterans that have service-connected disabilities, military spouses, and military caregivers.
So what's interesting is that in many cases, it's not that they lack the skill sets. In fact, a lot of the things that a lot of these service members learn in the military are perfectly applicable to many jobs. So what exactly is it structurally that makes it hard for them to maybe integrate back into a society when they do return from active duty and whatnot? And how does DogTag Bakery try to handle some of those structural problems?
So you're completely right. The skill set is there. And what we're seeing is that post World War II, 48% of our service members started their own small business. Today, 26% of our service members want to, only 6% do. Why? Lack of network and community and funding. Military spouses today are the unemployment rate of recession at 20%, 5 times the national average because of multiple moves. So what we're seeing is really not just about skill set, it's a cultural shift. So you go from the military, which is so efficiently black and white, and that's why it's so good, to a world of gray. You go where your uniform is your resume, so I can see how many times you've been promoted, how many people you manage, and by the way, I introduce you, is a level of respect. And here you are today at a job fair, and your name is John.
Yeah.
You've lost community, identity, and the ability to really connect. So our whole program is really about teaching us skill set, building a foundation in business, giving tools, and most importantly, a network and community to support.
And that's the awesome part too, though, right? Because downstairs, you guys are working on treats that taste very good and have attracted the likes of former President Barack Obama and Joe Biden.
Yes.
But also upstairs, you're teaming up with Georgetown University professors to teach them the skills of business as well.
Correct. So our delicious shared love brownie, which is a recipe of our co-founder Connie Milstein, you must try it.
Yes, I will try it.
It would be offensive if you didn't.
Oh, believe me, I know it's going to stop me from trying it. Okay, fine.
But what we realized is that brownie is actually a business widget. So there's cost of goods, there's labor, there's the ability to actually put a price on it. So what's the margin you have to put on versus what it costs to make? There's a communications and marketing behind it, and there's SOPs of those that deliver the product and sell it that you have to create. So the bakery is basically a true widget to be able to understand it. So above the bakery is a classroom. So our fellows will go through 7 courses taught by Georgetown professors over the course of 5 months. They will earn and graduate with a certificate in business administration from Georgetown School of Continuing Studies. So a tangible result. You put the hard work in. Our whole program is not about a handout. It's really a hand up.
Yeah.
And so with that, you realize for every good theory of classroom time, you need experiential learning or case studies. Well, our whole business is that altruistic business to learn that. So for 20 weeks, they rotate through all different areas of business.
Yeah.
And then we bring in our network of entrepreneurs, small business owners, and corporations to come in and bring the personal and professional development side.
It's so honestly, it's so awesome, and it's such a great story to be profiling on Veterans Day, and it's phenomenal as well.
It's a great brownie.
Not to be looked over. The fact that it's awesome and it's the best brownie I've had perhaps ever, and I don't really eat brownies. To be fair, I don't eat brownies all that often.
We have a
but
lot of
these are
other
phenomenal.
options.
Yeah,
awesome.
Blondies are good. I've had those.
They're all very good.
Solid.
Dog Tag
We're in
CEO
that free bakery too.
Megan
so.
Ogilvy, thank you so much.
Thank you
Honestly,
so much for having us.
Yeah, appreciate it.
It's the Netflix for cooks or wannabe chefs. Food Network Kitchen, daily live and interactive cooking classes with grocery ordering and delivery straight from the app. Joining us now is Peter Faricy. He's CEO of Discovery's global direct-to-consumer, which is rolling out the new app. I found this super intriguing. I'm curious, though. Let's see. I've got Peloton already vying for my time to watch me on the screen. I have Netflix. I have a million places that I could go spend my time. What do you think the demand opportunity here for busy people is?
You know, we think it's pretty big. And one of the signals we have is consumers have always loved the Food Network TV shows. You know, it's the most popular TV network for food enthusiasts all around the world. And the number one piece of feedback we get is, I want to be able to see what take what I see on TV and bring it into my own kitchen. So, you know, we were inspired. I am a big Peloton fan, by the way. I do love Peloton. And we were sort of inspired by the idea of, you know, if we gave people access to both live classes but also on-demand classes, would it change how they think about cooking? And there's a lot of people who feel, and I'm one of them, underconfident in the kitchen, you know? So part of what we want to do is we want to give people confidence. We want to give them easy recipes and step-by-step tutorials. And when you guys get a chance to see our classes, they've been a big hit so far. Consumers love them, yeah.
Now, when you think about, I guess, the whole tech stack here of the ability to actually stream this stuff to people, then assuming that everyone has the device that's able to sit on the counter, and so, like, how do you see that evolution playing into your decision here? I mean, because everything is going over the top, but obviously 4 years ago, before Alexa was a thing, and you know, half the number of people had iPads they have today, it wouldn't really have worked, I think, in the way that you can count on most consumers having this stuff.
I think you're absolutely right, Miles, and I think this may be the year that the smart kitchen inflection point hits. I really believe that. So we're launching on iOS, Android, and then all the Amazon devices. That basically means that you can take a laptop, you can take your iPad, you can take almost any device into the kitchen and play along. But I do think there's also a number of smart ovens. In fact, Amazon announced one a few months ago. You know, Brava oven, June oven, the new smart Amazon oven. The cool part is I think the hardware on smart kitchens is coming along. But someone still has to teach the consumers, you know? How do you use these things and how are you gonna cook and make meals? Right. And I think we can play a big role there.
Now, do you guys, I mean, obviously you just launched this, so you don't know how the cycle goes as consumers get more used to this, but I look at my own culinary expertise, everybody, I'm a very good cook. No, but like, you learn how to cook 5 things, right? And then I just cook those 5 things. Do you worry that people are gonna get phased out of, oh, I'm comfortable with these recipes and I like these things, now I know how to do them, I don't need to have the service anymore?
Well, the evolution in cooking, if you look back in time, the reason cookbooks started is that people wanted inspiration, you know? Now the inspiration is just more video-based. So you can take a look 2 weeks in advance at our live schedule. You know, there was Rachel Ray yesterday making English pub burgers. I didn't have time to watch it, but I was like, I want to take that class right there. So that's one use case. The other use case is, much like Peloton, our on-demand classes, you can filter. So let's say you have a Mediterranean diet. Let's say you're vegetarian. Let's say you're lactose intolerant. You know, there's a lot of use cases where we think the on-demand classes are going to be very useful for people. And I think many people have told us they are kind of stuck in the rut with their 5 meals. This is going to give them a chance to buy fresh food, and actually make their own food.
Kind of for food.
Yeah, exactly. But we hope much more.
Limited time discounted price, $47.99 for a year right now.
Exactly.
So you have to pay for this product. And when initially it got pitched to us, I thought, oh, this is a great idea, but it's only going to work if they send you the food. So that's why you're there and I'm here, because you guys already came up with that part of it. So how does the part about getting your food, because I've done Blue Apron and other boxes as well, and part of the value proposition there is that's very easy to get everything delivered. You don't have to do the shopping part. How does that work with what you guys are offering?
Absolutely. This is easy too. I really love it. We've taken every Food Network TV show that we've ever featured a meal on. We've tied every meal to a recipe. We've tied every recipe, including recipes that haven't been on TV, to the ingredients. And then we allow you to order the ingredients, and you can check and uncheck ingredients you may already have in your pantry. You may already have some of the spices, so you just uncheck those. Right now, we're connected with Amazon Fresh, Instacart, and Peapod. And it's fantastic. You know, it's not quite instant, so you can't think I want to take a class and they show up an hour later, but it's pretty close to that. And I think the feedback we've gotten from consumers so far is that's one of the barriers to taking cooking classes. Do I have the ingredients I need? So
always
imagine,
missing one thing.
Absolutely. We're trying to work our way down the consumer chain. What are the things we can do to help them really bring more of this joy and excitement back to the kitchen?
And now, just thinking about your portfolio more broadly, obviously Food Network is a unique asset that you guys have, but do Do you think that this is kind of the way forward for D2C? Because every company has their bundle that kind of looks the same in some ways, but you can have niche carve-outs like this. Does this feel to you like the beginning of a broader segregation of your portfolio because you know that certain brands speak to certain consumers and you can monetize them more effectively one-to-one rather than as a group?
Yeah, I think we're thinking about it in two ways. So as you point out, this is a very different product than the other products that are just streaming products. Most of the other D2C products, they take what you see on TV, they stick it in an app, people stream it, it's done. This actually, we provide all the TV shows, but we're trying to provide utility that goes far beyond that. You know, so people actually love the recipes, being able to save those. They love the classes. They love the delivery. And so you can imagine the utility factor is quite big. The other thing that's pretty different about our app is that it has 3 revenue layers, you know, from our perspective. One is a lot of this is free and ad supported. And then we have the subscription layer that includes the classes and includes the video tutorials, the how to carve a turkey, for example, last weekend, and all of our TV shows. And then obviously the more we can help people deliver ingredients, and we're also, next year we announced, we're actually going to add cookware to that as well. So for every single class, we not only list the ingredients out, we actually list what cooking equipment are we using, and we're going to give people a chance to order that in advance. So we're excited about that model where there's high utility. But we also have so many other great brands. You know, HGTV, we announced this partnership with Chip and Joanna Gaines on Magnolia. We have a partnership with the BBC and Natural History with Discovery. You know, so the best thing I could say would be stay tuned because we have some incredible products coming out next year.
All right, Peter Faricy, CEO of Discovery's Global Direct-to-Consumer. Come back.
Good morning, everyone, and welcome to all of you watching online and on FiOS One News. I'm Alexis Christoforous.
And I'm Brian Sozzi, and this is the first trade for Wednesday, November 13th.
In the public eye, the first public impeachment hearings are set to kick off in just about an hour as the president reportedly tries to distance himself from a top advisor. We are live in D.C. with the latest.
And Capitol Hill face-off. Fed Chair Jerome Powell set to be grilled on the state of the economy and if more rate cuts are in the cards, why the markets will be hanging on his every word.
And banking on Google. The search giant makes a new push into consumer checking accounts. But would you trust them with your money? We'll dig into it.
Let's get a quick look at the futures here ahead of the opening bell. The Dow futures are down 90 points. The S&P 500 and NASDAQ slightly in the red as investors still try to digest that tumultuous press conference or showing for President Trump yesterday in New York City.
We'll get a full check of those markets for you in just a bit. But first to today's big story.
The first public hearings in the impeachment into President Donald Trump kick off in Capitol Hill today. In about an hour, Yahoo Finance's Jessica Smith is live in our Washington, D.C. bureau with more. Jess?
Well, this is the public phase of the impeachment inquiry. As you said, it starts at 10 o'clock this morning, and this is just the fourth time that Congress has seriously considered impeaching a president. Today, we will hear from two witnesses, Bill Taylor and George Kent. In a statement about the hearing today, Chairman Adam Schiff, who will be leading this hearing, said, "We intend to conduct these hearings with the seriousness and professionalism that the public deserves. The process will be fair to the president, the committee members, and the witnesses. Above all, these hearings are intended to bring the facts to light for the American people." So while witnesses have been testifying behind closed doors, this is now a chance for Democratic lawmakers to really make their case to the American people. Republicans, the president's strongest allies, continue to insist that the process is politically motivated and the president did nothing wrong. Brian and Alexis.
Jess, what about the format of today's hearings? Is it going to be the traditional Q&A?
Part of it. I mean, they're going to have longer questions in the beginning, a longer series of 45-minute questionings, and then move on to the typical 5-minute questions. We don't know how long this is going to go on, but it could go on quite a while.
Jess, how is the White House planning to respond to this?
The White House president, at least, has already been tweeting out this morning saying never Trumpers, read the transcripts. He's been tweeting quotes from people on Fox News saying that he did nothing wrong. So we expect the president to continue to keep that up, defending himself, trying to say that this is all politically motivated. And we might hear from him this afternoon talking about this when he has a press conference with the Turkish president later today.
Do you think they're going to wind this thing down by the end of the year, or could this drag on into 2020?
I think that would be the goal, to get this done by the end of the year, but it is really not clear how long this is going to go. We're just going to have to see over the next few weeks how long these public hearings last, and then how long the Senate portion continues.
All right, Jessica Smith there for us in D.C. Thank you. Time now to head down to the New York Stock Exchange, check in with Yahoo Finance's Inez Ferre for what's going on there before the bell. Inez, it looks like Google wants to get into the banking business. Tell us about it.
Yeah, Alexis, we've seen big tech companies going more and more into the financial services business. Well, the Wall Street Journal is reporting that Google is partnering with Citi and also a credit union in Stamford to offer checking accounts to consumers next year. Now, this would be pretty significant because checking accounts contain so much information really about consumers, about their salary, where they shop, what they spend their money on. We're watching Luckin Coffee this morning seeing a pop. Remember, this is the company that went public back in May, pricing their shares at $17. The revenue for their latest quarter came in as a solid beat. Their loss for the quarter widened from the same quarter last year, but remember that they have been expanding aggressively, opening many stores, and the company said that they're on track to reach their goal to become the largest coffee player in China by the end of the year. And then we're also watching Skyworks Solution, a little bit under pressure. This is after a revenue miss for their latest quarter, in part because of that Huawei ban, although the company says that they've handled it well. Also, they've acquired new customers in the last quarter, and they're also very bullish on 5G going into 2020, saying that they're well positioned not only for the upgrade of 5G for smartphones, but also in other areas like AI, enterprise, automotive. Alexis, Brian?
Inez Ferre, thank you. Coming up here on the first trade, heading to Capitol Hill, Fed Chair Jerome Powell is set to kick off 2 days of testimony before Congress. What investors should expect is coming up next.
Wall Street is looking at Capitol Hill for some direction today because that's where Fed Chairman Jerome Powell will testify before the Joint Economic Committee. And it comes a day after President Trump pushed once again for negative interest rates. Our Fed correspondent Brian Chung is joining us now. And Brian, we know the Fed has cut interest rates 3 times since Powell testified back in mid-July. What do you think he's going to say now?
Yeah, well, a lot of pressure from President Trump yesterday, setting the scene for what might be some questioning on Capitol Hill today in front of the Joint Economic Committee. President Trump saying that he would like the Federal Reserve to have negative interest rates, and also said that even though the Fed has indeed cut by 3 times this year, he said that wasn't fast enough. Although, to be fair, the Fed cut interest rates in 3 consecutive meetings, so they couldn't really cut any faster than that during that time period, at least.
Unless it was something outside of the meeting, which would be
unprecedented
for that,
in recent history. Regardless, this is interesting because the Joint Economic Committee is not the same thing as the Humphrey Hawkins testimony, which happens biannually. So it's a mix of cast and characters for both the Senate and the House side. So there are, again, members from both sides of Congress kind of, they'll have the opportunity to ask Chairman Powell a bunch of questions. A lot of that probably will be focused on perhaps some of the rhetoric from President Trump yesterday saying, look, I've done a great job, again, from the White House's part, of getting the economy to where it's at right now, but then some saying, well, what's the next steps then? Does the Fed need to cut further if the economy does look okay? And I think from a monetary policy standpoint, that's going to really set the tone for what will be the Fed's last policy setting meeting. That's December 10 and December 11.
Brian, handicap this for us. What is the chance that Jerome Powell gets up there and wants to take a little air out of the stock market balloon?
Well, for right now, I mean, the stock market actually isn't even expecting another 25 basis point cut. So it's kind of hard to see a situation where Chairman Powell would say something that would, as you mentioned, take air out of the market, because the pricing right now is basically for, no change at all to rates in that last meeting. However, there could be the downside possibility that maybe Jerome Powell sounds a little too hawkish, but for what it's worth, he said pretty clearly in the last FOMC press conference that the Federal Reserve is not at all thinking about the possibility of raising rates again.
So for him, it's basically don't mess this up.
Exactly. Don't mess this up. Just say we're on pause or some variation of that, and you're fine.
Also, because all the talk about a recession, a looming recession, has really dissipated on Wall Street. And is that why we're seeing, investors not expecting another rate cut anytime soon?
Yeah, I mean, for right now, it seems like the Federal Reserve would like to be able to say we've engineered the soft landing. So 75 basis points of cuts were designed to be an insurance against recession. Markets are now saying we're comfortable with the level right now at 1.5, 1.75%. So let's just keep it cruising for right now.
Showtime for Jay Powell. Brian Chung, good to see you.
Yep.
And we'll bring you Jay Powell's testimony live starting at 11 a.m. Eastern Time. That's right here on yahoofinance.com and on our app. Let's get a look now at European markets. European markets are in the red right now. The FTSE 100 down about 0.3%. The CAC 40 and DAX also in the red. Yahoo Finance's Oscar Williams-Drew joins us now from London. Oscar, some new data out this morning from the UK, and inflation looking pretty weak.
Brian, it's the weakest since November 2016. Inflation was just 1.5% in October, down from 1.7% in September, and lower than forecasts of 1.6% for the month. Now, there is one big factor driving down inflation, and that is energy prices. Theresa May, the former Prime Minister, introduced an energy cap that basically dictates the maximum amount that companies can charge for a unit of energy. The idea is that any cost savings get passed on to customers to give them a fairer deal. Now, that cap got lowered last month, reflecting changes in the energy market. It got cheaper to serve energy over the last month. As a result, electricity and gas prices dived. But this is all factored in. The Bank of England had predicted that we would see this and we would see inflation going lower before it goes higher. So the pound has largely been unmoved by this. This isn't seen as making a rate cut more likely.
And Oscar, I know a former UK government minister is warning of the possibility of a no-deal Brexit. What's he saying?
That's right. Former Justice Minister David Gauke told the BBC today that if we get a Conservative majority government, then that could lead to a very hard Brexit. That's because he thinks Boris Johnson would let the UK crash out of the EU in December 2020, when the transition period for his deal would elapse. Now, in ordinary times, this would be a pretty extraordinary warning. David Gauke was Justice Secretary until July this year. But these are, of course, not ordinary times. Gauke was in fact kicked out of the party by Boris Johnson in September for rebelling against his government. So it's unclear if this will change the polls ahead of the election.
All right, Oscar Williams-Groot for us in London. Thank you. Straight ahead on the first trade, up to their knees in problems. Terrible flooding hits Venice. Your news bites are next. Let's take a look at today's news bites. China is warning it could soon intervene to stop the protests in Hong Kong. There were more arrests earlier today in the central business district where protesters and police have been clashing for days. Commentaries in Chinese state media signaled Beijing may send troops into the territory, with the Global Times saying direct intervention may be in the cards. President Trump will welcome his Turkish counterpart Recep Erdogan to the White House today. It's happening weeks after Turkey invaded Syria and launched an attack on Kurdish forces. Trump then withdrew U.S. forces in that region, which many saw as a betrayal of Kurdish allies. Critics of the meeting say it is, quote, a particularly inappropriate time for President Erdogan to visit the United States. Top officials from the CDC and FDA will be on Capitol Hill today for a hearing on vaping. Senator Tammy Baldwin asked for the hearing in the wake of a growing number of deaths and illnesses connected to vaping. Doctors in Michigan, meantime, have revealed that a 17-year-old underwent a double lung transplant due to vaping-related injuries. Global greenhouse gas pollution continues to rise. That's according to the International Energy Agency's annual report. The study shows that the world is on track for pollution increases through the year 2040 unless the government takes extreme action. And in Venice, Italy, here's a look at what's happening there. They are experiencing their worst flooding in 50 years. And Venice's mayor, Luigi Brugnaro, is blaming climate change for the unusually high tides that are flooding the city. Colin Kaepernick might be headed back to the gridiron after being off the field for nearly 3 years. The controversial quarterback confirmed on Twitter he will attend a private workout for teams on Saturday in Atlanta. NFL teams will then decide if his game is good enough to be put back on the roster. Kaepernick infamously came under fire and lost his QB position with the 49ers after kneeling during the national anthem to protest social injustice and police brutality. Coming up on the first trade, setting its sails for high profits. The CEO of Norwegian Cruise Line is here to tell us about their latest expansion plans. Don't go away.
Norwegian Cruise Line is setting sail on a new quarter after reporting third quarter earnings that beat Wall Street estimates. Norwegian Cruise Line CEO Frank Del Rio is in the house to discuss. Frank, always good to see you. Does it feel like a 1% U.S. GDP economy to you?
No, not at all. You know, I hear that there are signs of recession, slowdown in pockets of the economy. So the coal miners might be having a bad year, or some of the industrial machinery, but the consumer is alive and well. And we see it in several ways, Brian. First of all, the booking window. How far in advance are people buying a cruise? Expanded 10%. That's huge in one year over year, 10%. So people are buying their cruises further and further out, showing they have confidence in their situation. Second is those who book their cruise 8 or 9 months out and are on their cruise today. What are they doing on board? Are they spending money on spa treatments? Are they going on shore excursions? Are they spending money in the casino? And the answer is yes, in a bigger way than they ever have before. And the third way, perhaps even the most indicative one, is those that are on board and spending money in the spa and so forth are also buying their next cruise on board.
Wow. So
I don't see.
They are the loyalists, right?
They're yes, and we love them. But it shows the confidence of the core consumer. Here they are buying something that's totally discretionary. No one has to take a cruise. Yes, they choose to. And that's because the economy's strong.
And the latest numbers I saw, 30 million people expected to cruise in 2019. Where is most of your business coming from? Where do most Americans want to cruise to?
Yeah, well, the largest region year-round is the Caribbean. So across the industry, and similar to us, roughly 40% of the capacity is dedicated to the Caribbean. And that comes mostly out of Florida, as you'd expect. But we have cruises that sail from the Hudson down to the Caribbean, from Tampa, from New Orleans. So the Caribbean is the big destination, but Alaska's growing like a weed. Europe has always been strong.
Is Europe still strong given some of the slowdown we're seeing there and Brexit worries?
Yeah, so the German economy, the Italian economy has slowed down, Brexit. But Americans still make up a good 60 to 70% of the folks who are on board our ships that sail around Europe.
Frank, you're making a big bet on Alaska. What's going on there?
You know, Alaska's got everything people want. First of all, it's safe, right? There's no risk of hurricanes. It's American. It's the last frontier. It is not year-round, but expanding. So we're seeing, it used to be that Alaska was maybe good for June, July, and August, 3 months. Now we're seeing cruise ships arriving in late April, extending their season through October. And as a result, we're making big investments in Alaska, in land programs. As these ships get bigger and bigger, as you know, Encore is 170,000 ton, nearly 5,000 people capacity. The berthing capacity in some of the upland projects in Alaska are lacking, and we, along with other cruise lines, are building up the infrastructure that will allow us to bring these huge, beautiful ships to Alaska.
And you have some new ships in the pipeline, right? And you have to order those well in advance, I understand?
Well in advance. We have 10 more coming through 2027 across our 3 brands. As you know, Norwegian Cruise Line Holdings operates Norwegian Cruise Lines, Oceania Cruises, and Regent Seven Seas. And so we have ships for all 3 brands coming.
Real quickly before we let you go, you have repurchased, I believe, 9% of your outstanding shares under your current buyback.
Yeah.
It's almost like you're taking the company private.
Well, not quite. We love the public markets, but look, we're underappreciated right now. Our stock is undervalued. We're trading at 9 times 2020 consensus. With all the cash flow that we're generating, we think that the best use of that cash right now is to buy back our stock at these ridiculously low prices.
Yeah.
All right, Frank Del Rio of Norwegian Cruise Lines, thanks so much. Enjoy your cruise. I understand you're getting on the ship after this.
I'm heading there right now. Thank you.
All right, enjoy. Well, from Bill Gates to Mark Cuban, Senator Elizabeth Warren is triggering billionaires with her wealth tax plan. In this week's Ballads and Dollars podcast, we talk about what alienating wealthy investors could mean for Warren's presidential campaign. Check it out on Apple Podcasts or wherever you get your podcasts.
The opening bell is coming up here next on The First Trade. Here's a look at the action in overseas markets, and we'll be right back.
Welcome back to the first trade. We're about 6 minutes away from the opening bell. Futures are lower. We've got the Dow futures off more than 90 points right now. Let's go around the bell with Aaron Gibbs, President and CIO at Gibbs Wealth Management, and Rob Proche, Senior Portfolio Manager at Mellon. He's in Boston this morning, along with Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board. Good Wednesday morning to you all. Aaron, I'm going to start with you. Is the big news or event for the markets today this Jay Powell testimony before Congress?
No, I think right now what we've been seeing for the past few weeks, Wall Street has been pretty dismissive about a lot of any of the impeachment investigation, any of the sort of Washington announcements, and I really feel it's come more about earnings. I think we've gotten our Fed rate cut, and that's what people are really talking about, and so. Yeah, we're not expecting another cut, so I'm certainly not expecting like a big change from anything that he could possibly say today. Mm-hmm. Certainly, if he really expresses a lot of concern about the future, but I think we're pretty stable at this point. I don't really expect any big surprises.
Rob, isn't this market hooked on rate cuts? Doesn't this market want to hear Jerome Powell give another wink saying, hey, we may cut rates, maybe not at this meeting, but in the first half of 2020?
I think the market would love that, but I also think that it's unlikely. The Fed has been pretty clear that they're comfortable with a wait and see, starting where we are today. And the market has taken that as very good news as well. I mean, we've seen sentiment really improve in the market. High yield spreads have come in. Treasury term structures have increased, improving the profitability of banks. I mean, sentiment has really improved in the market over the last few weeks.
Now, this morning, Aaron, we had consumer prices up 0.4% in October. That was running a little bit hotter than expected. Does that change anything, do you think, for the Federal Reserve? Or we would need to see many months of something like that?
Yeah, because we're overall, when we're still looking at adjusted inflation, they're still running below their target rate. Right. You know, it's always just slightly below, but we're certainly not at 2% or above 2%. So I don't think that's been their big concern. And in fact, you know, as we've known the past two rate cuts, the big issue that they've mentioned, the reason why they've done the rate cuts is because of what's happening outside the U.S. and the global uncertainty. So I really think that we would have to see just super hot numbers coming out of the U.S. to really offset what they've already mentioned is big concerns about global deflation.
Rob, President Trump's performance yesterday, and I'll call it a performance, at the Economic Club, does that suggest to you that we may not get a phase one trade deal before year end?
I mean, the market certainly seems concerned. You know, our portfolios are built in a way that, you know, we're not making a bet on trade deals getting done or not getting done. The market seems to be pricing in some type of deal that, you know, may or may not get done, but this market's gotten very, very good at shrugging off this kind of news in short order. You know, a couple of days of higher volatility and then sort of back to trend.
What do you expect for these last few weeks of the year, given that trade is still a big question mark for investors?
I think investors at this point are pretty stabilized. They're not expecting any big shifts. I don't think anybody's really baked in that phase one is going to be some massive rollback of tariffs. And when you talk to the companies that are really impacted, those that are having to shift, like trying to import all their inventory before the tariffs hit and that type of thing, what we really heard is how they got hurt in third quarter because there were 5 announcements and actually only 2 that happened. And so for 5 times they were doing these fire drills of trying to move shipments and pay extra for shipping faster and that type of thing. It's really companies can still handle things well and really manage their inventory, manage their supply chains, even if they still have connections to China, as long as we don't have a moving target. And so as long as we don't have these sort of preemptory announcements that he's going to set tariffs, you know, in the next 2 weeks, and then it doesn't happen, that type of just volatility and sort of threats, that's what really hurt a lot of businesses in the third quarter, was just this constant fire drill scrambling. So I think as long as we even have just no news and companies can just expect December 15th to be, you know, where they have to worry about that really means that most of their inventory is here before holiday season. They can get through the holiday season. I think that would just keep us on the same track that we're already going. It's just that change that really throws off these companies and makes life a little difficult.
Yeah, you can hear. We talked to a lot of executives here, and they're shifting supply chains around. They can't plan for their business the next day, tomorrow, or even 2020. So it's
So when you have that moving target, if it's stable, it's good.
And one of the reasons why we're seeing CapEx spending pull back as we are, and here we have the opening bell at the New York Stock Exchange and the NASDAQ. We saw futures coming under some pressure here leading into the trading day, and it looks like we're going to start on the downside as well. Dow Jones Industrial Average down 71 points. Want to head on over to Jared Blickery now at the Wi-Fi Interactive Board for a closer look at the Dow action. Hey, Jared.
Hey there. So we just got some opening prints. Apple down 0.25%. That's coming off another record high. Microsoft, another record high for it, down 0.5%. So really stocks aren't off that much, but we are seeing some red, a little bit of risk being taken off the table, and importantly, bond yields are down. So the 10-year T-note is down another 3 basis points. It was down yesterday. Might be a start of a kind of correction. And in that case, we're going to see a little bit of the opposite rotation that we've seen over the last few weeks. Just to give you some more names, financials under pressure. Again, that's with the yield curve compressing a little bit. JP Morgan off 1%, as well as Goldman Sachs. Stocks in the green, not a lot, but we're seeing Procter & Gamble, Staples Play up 0.75%. McDonald's and Nike both up about 0.25%, which is impressive because they both have a lot of China exposure, as we know.
Rob, back to you. I was reading over some data from DataTrek, and they said after years in which the S&P 500 rose about 25%, as it is this year, we still might see high single-digit returns in the following year. Do you agree with that?
Absolutely. The data is very clear that this is mostly a momentum market in the intermediate to long term, and that's still true.
Erin, sorry, I was in mid-gulp here with my water. What's your take? I mean, can this market move up another 5-10% in the next 6 to 12 months?
Yeah, I really see that. So as we're going through the end of third quarter earnings, we're having a much better sense of what we're expecting for 2020. And in general, we're expecting about 9.5% earnings growth and about 6% revenue growth. And that has stayed remarkably stable throughout third quarter as companies are giving us better guidance. So any year where you're talking about, high, digits on both your top and bottom line growth, that's generally a very good year for the market. So, even if we just expand with profit growth, maybe we end up with only 8%, that could be a good year. And then we're not overvalued right now. That's another thing. We could have further value expansion as the U.S. market looks that much more attractive to the rest of the global equity markets.
Where do you see value right now? What sectors?
So one thing I really see value, particularly going into 2020, are industrials. They're basically, the valuations have come down. They've been hurt, obviously, by the trade deals. And they have one of the highest expected growths for 2020. There's a big rebound for them. Consumer discretionary as well, though they're not quite as much of a value play. But we have seen a shift into more defensive value names over the past 2 months. And as values earnings growth is basically sort of catching up with growth. I know that doesn't make sense, but when you look at these growth companies, the spread between the two is a lot less coming into next year as we get into a slower growth environment. I think your value plays are where you could really get more price appreciation because they're just such low valuations at this point.
Jared, back to you in the good old heat map.
The good old heat map. Well, we do have some green. This is the NASDAQ 100. We're seeing Expedia and Tesla. They're both up about 1.5%. To the downside, Skyworks Solutions, now they just reported earnings and they were down about 4%. And then we're seeing American Airlines, Mylan, Baidu, NetEase. And I want to take a look at the leaders here because we were just talking about some sectors and the rotation that's going on. We're seeing to the downside, the regional banks are down the most, about 1.3%. Emerging markets, the Dow Transports. Dow Transports, incidentally, they just hit a high that we're going to take a look at here and might be rolling over a little bit. We can see they've been in this sideways action for some time, and we had these breakouts in stocks such as American stocks, the S&P 500, the Dow, the NASDAQ, but we might need to retrace a little bit before going higher, and that would be that scare to push out the naysayers. And you're talking about upside targets in the S&P 500. Bank of America Merrill Lynch yesterday came out with a 25% upside, which is 3850 in the S&P 500. Not saying that's a base case, but they said it's possible based on the size of the breakout that we've seen so far, but maybe a little correction first.
Rob, what do you think might get us there? I mean, we were just talking with Erin about sectors she likes right now. She sees some value in industrials. What about you?
We think that the market has really gotten good at shrugging off this bad news, but there's so much volatility in the news cycle. And it's very, very hard for firms to plan not just their short-term behavior, but their intermediate and longer-term behavior. So it's very hard to say what's going to drive the market in the next couple of months. But with capital expenditures coming down and firms indicating that it's very hard for them to invest for the longer term, it's there's a lot that needs to happen in terms of firming up of the macro picture for us to get excited about next year's equity markets.
Well, today, all eyes on the Federal Reserve and Jerome Powell with his testimony. That much is for sure. Rob Crochet, always good to see you. Aaron Gibbs, good to see you as always. And Jared Blickery, thank you. Google may be following Apple's lead in looking to get into the banking sector. According to the Wall Street Journal, Google will soon be offering checking accounts direct to consumers. Yahoo Finance Ethan Wolfman joins us now. Ethan, wow.
How you doing?
Wow, that's all I had for you on this one. It's
good to be
Just
here.
a wow.
Yep. I mean, it comes a day after they basically said they're looking at 50 million medical records, and they're already on Capitol Hill talking to lawmakers about privacy issues. Does this seem like the right time for Google to be getting into banking?
It's definitely an interesting time. Oftentimes there is the back and forth of who does Washington hate more, the big banks, which often they really don't hate at all, or the tech companies. And right now we've had this big privacy swing and data swing. So this, as you say, is not particularly the best time to get into this. But Google is doing this in a very interesting way. They are going to be partnering with some small banks, like there's a credit union out of Stanford, and also Citibank, to kind of power this solution. They don't have a banking license, kind of similar in the way that we've seen Amazon and Chase partner, and Apple and Goldman Sachs partner. This is kind of what we're seeing now, and it's going to be going through the Google Pay platform, most likely, but really Google is going to take a slightly backseat on this. But it's interesting because we've seen how Gmail slowly crept on, and eventually charged something. I wonder whether something like that will be the case for the checking.
You know what's interesting here, too? PayPal. How is it? You follow this space very closely. Are they hurting? You have the Apple Card, the potential Google getting in bed with Citigroup or Citibank. PayPal would seem like a loser here.
I mean, this is an incredibly competitive environment, especially as all these tech companies are trying to come in and oust some of the banking spaces. And obviously PayPal, Square, these are companies that have been trying to do this for a long time. And they're companies with maybe less power, I think, for kind of the network effect as we've seen from these kind of incumbent players that already have a great reputation for user experience. With products like Gmail and Amazon, obviously, is super easy. So that is something that I think could be potentially disruptive, but it has to be done in the right way.
Yeah. Is the greater play here, though, at the end of the day, that Google wants more of our data? Have they said at all what they would do with the data they collect on this banking front?
Not too much. There's they've said in the past that stuff for the wallet situation will not be used for advertising. I don't know if that's going to be something that will last forever, or whether it'll be, that I'm sure is up in the air. But it's incredible how much data that you can get from a checking account. So this is clearly a data play that would make a lot of sense. And also, whenever there's money changing hands, that is money to be made.
I'm not getting this card. I'm sticking with Bank of America. I'm just saying.
I have to think that lawmakers are going to raise their eyebrows at this one, too, but we'll see. All right, Ethan Wolfman, thanks for the update.
Thanks.
Coming up on the first trade, a former HBO bigwig could be making his way to Apple's new streaming service. We have the details for you coming up.
Now let's check in with Yahoo Finance's Inez Ferre down at the New York Stock Exchange. Inez?
Hi, Brian. We're looking at Tilray this morning, down about 2%. This is after their latest quarterly results, with a reported loss for the quarter, though they did beat on revenue. Total kilograms sold increased by sixfold compared to the same quarter last year, even though prices, though, decreased by about half. Now, this stock year to date is down about 70%. Today, it's slightly under pressure, down about 2%. Apollo Global is set to acquire the IT company Tech Data. You're looking at Tech Data that's up around 3% today. This is a deal that's valued at $5.4 billion. Or $130 a share. Now, speculation of this deal did come in around mid-October. That's when you really saw Tech Data go from about $111 to $125. And then we're also watching Tesla this morning. Tesla is up more than 1%. Tesla has selected the Berlin area for their European Gigafactory. This announcement was made by Elon Musk at an awards ceremony in Germany, and the Gigafactory will be located near the new Berlin airport, and it will build batteries, powertrains, and vehicles, starting with the Model Y. One interesting note is that Elon Musk said that they discarded the possibility of the UK because of Brexit, saying that Brexit was too risky for them to put the Gigafactory in the UK.
All right,
Brian, Alexis.
Sounds good. Thanks a lot, Inez. Worries surrounding the trade deal with China are sending oil prices south today. Yahoo Finance's Jared Blickery back at the Wi-Fi Interactive board with today's commodities report. Oil down by about 0.5%, I guess?
Yes, it is. So it could be worse, but crude oil is playing, like a risk asset here. So let's take a look at the intraday price action, and we can see, well, this is going to be over 10 days. So let's just take a look at that. Basically in a big trading range from 56 all the way up to 58, just kind of treading water here. I like to look at my 3-month candlestick chart, and really nothing has changed in that arena. But I want to take a look at something that's happened overnight with respect to the IEA. They are predicting that global oil demand growth is going to peak by 2030. I remember Saudi Aramco said 35. They're talking their book, but that's a pretty big shift in expectations. Just switching gears for a moment, let's go to gold futures. And we have gold just popping up here. Now, we had drawn this trend channel that's been in place for some time, noting that it had hit the bottom, might be due for a pop. And in fact, with interest rates falling right now, the 10-year T-note yield off about 3 or 4 basis points, gold is catching a bid. And just as gold is rising, copper is falling. That is on the demand concerns associated with trade risk. And we can see that we had this upward trend channel, which has now been violated, down 4 or 5 days in a row.
Jared Blickery, thank you. The streaming wars are getting even more competitive. Former HBO executive Richard Plepler is reportedly looking to sign an exclusive production deal with Apple for Apple TV+. Yahoo Finance's editor-in-chief Andy Serwer is here with more. Andy, Plepler is a heavy hitter.
He is. He's really a maestro. He's the person who is probably most responsible for the success of HBO, which was always the jewel in the crown at Time Warner, and left that company after it became clear he wasn't going to have as much autonomy as he wanted recently. And there's been all kinds of speculation as to where he would end up. Would he become the CEO of CBS, for instance? Well, that didn't come to pass. And now apparently he's going to get this big job at Apple, but it is not the top job, to be clear. That is Zach Van Amberg and Jamie Ehrlich. Those are the two people who Tim Cook has tasked with being head of content. This is a production deal, but it's interesting, you guys, because I think that if it works, he will end up having a big role at Apple.
And shaping the content we see. So when you say a production role, do you mean that he's going to go out there scouting or getting people to come in with their ideas for shows?
That's correct. I mean, he's not a showrunner, Alexis, but he is the person, for instance, at HBO who greenlit Game of Thrones and Veep. And for instance, when Game of Thrones came to Time Warner and HBO specifically, a lot of people were very skeptical. Fantasy, it costs a lot of money. I mean, this is ridiculous. It's never going to work. And of course, it became the biggest show in the history of television. And so he has a way of handling talent that is really, really non-paralleled in the business world, in the world of entertainment. And people who make documentaries, and smaller things at HBO always talk about Plepler's high touch. So he is someone who is a magnet, Alexis, for talent. I wonder if it's kind of too small a job for him.
I mean, it kind of sounds like what you're describing to me is he's going to wield a lot of power. It kind of sounds like the top job without having that title.
Yeah, I mean, it could be. And I think ultimately, you know, if it's successful, he may end up being that person.
Right.
So it's kind of great for Apple to have him in their universe. And if you look at the competitors, I mean, Disney has this incredible catalog to lean on, right? I mean, they just need to continue making content the way they've always done it in terms of the streaming wars. Netflix aggregates content and, of course, makes it an original. Apple is starting from square one, right? They've got nothing. I mean, they've got these new shows out now, which apparently have got a little bit of buzz, but they've got a lot of work to do to compete with, say, Disney and Netflix.
They have an ecosystem, but they don't have the content.
That's correct.
That's
They
what
do have this incredible universe of an installed base and all that, but now they just need the content for it.
All right, we'll see if Plepler lands there. Andy Serwer, thanks a lot.
Thank you.
Smile Direct Club gave investors, well, something to smile about yesterday. Their earnings report. Sales soared and the full year outlook was raised above analyst forecasts. And Brian, I know you had a chance to speak with Smile Direct CFO. Here's my question. They're out with this really is a pretty stellar earnings report. Their loss widened, but it was still better than expected. Why aren't investors responding to the stock positively? The stock was down again.
I asked him, and I think CFO Kyle Wells continues to go use that same line or that same approach when I talked to him back at the IPO in September. We're focused on the long term. We're going to invest in our business. So for him, he obviously acknowledged the stock price decline, but for them, it's continuing to build products, open up stores in the likes of CVS and Walgreens, and continue to drive their marketing efforts. He said they are profitable on a product basis. It's just the cost to build out the business are chipping away at the bottom line.
Another huge cost is going to be all these regulatory hurdles that they're facing. There are states out there, including California, that don't want them to do business there right now because they actually have a number of customer lawsuits they're also fighting. How is that going to affect the bottom line?
And that's a good point. There have been a lot of shareholder lawsuits since the IPO. Look, the IPO priced at $23. Last time I checked, the stock was about a little over $10. So it has been significantly underperforming since the company's IPO. But to your point, Alexis, the company is still doing battle with dentists. They are fighting tooth and nail with regard to these dentists who don't want to see their business taken away. Smile Direct is letting letting people put their braces on at home. Dentists obviously want to sell those big metal braces in their offices.
Yeah, and Wall Street largely remains very positive on Smile Direct. There is a 100% buy rating on the stock right now. Of course, some of these folks are underwriters as well of the IPO, so take that with a grain of salt. But at least for now, investors are not really jumping all over Smile Direct.
Smiles are coming.
All right. This Thursday, we'll be at the Paley International Council Summit, and our own Dan Roberts will interview Discovery CEO David Zaslav and MLB Commissioner Rob Manfred. You can catch it throughout the day on yahoofinance.com, also on our app.
Coming up here on The First Trade, Nike is partnering with Amazon and is focusing on a new strategy. Your companies to watch coming up next.
Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. Federal regulators are now looking into Google's deal to collect health data on some 50 million Americans. The Office for Civil Rights in the Department of Health and Human Services wants to know if Google and the Ascension Health System violated federal privacy rules by sharing the data. Google insists it is abiding by all federal laws and won't use the health data to sell ads. A strong quarter at Canada Goose. The high-end coat maker beat estimates with a net income of $45.9 million, revenue of nearly $223 million. Sales of those $1,000 jackets were up 28%, and it expects even better numbers in the holiday season. The CEO tells Yahoo Finance the company is, quote, off to a great start and expect the momentum will continue. Fiverr is out with its third quarter results. The company posted revenue of $27.9 million, which beat analyst estimates. That is an increase of 42% year over year. It's also raising its revenue guidance for the year by 40% as the company gets closer to profitability. And sneaker lovers can no longer buy Nike products on Amazon. The sportswear brand has announced it will stop selling its products directly through Amazon in order to focus on its own direct business. Nike began selling its products on Amazon in 2017 during the website's big push to bring in larger fashion brands. And for more on this, you make sure to check out Wi-Fi AM. That's happening at the top of the hour on yahoofinance.com. They'll be interviewing Nike Direct's president, Heidi O'Neill. Still to come on the first trade, looking forward to retirement, the new study that shows why you may have to wait longer than you think. We'll be right back.
When people consider coming out of retirement, there are more factors than just how much money is sitting in the bank. More people are deciding to take a break from retirement or deciding not to retire altogether. Here to talk on retirement is Christine Russell, Senior Manager of Retirement at TD Ameritrade. Good to see you. I was reading your survey, and we'll get more into the results, but immediately I thought, I'm going to die at my desk working. I'm never retiring.
Only if you want to, Brian. Only if you want to. That's the best news.
It's likely. I mean, well, listen, I think at the end of the day, people are working longer. I think that's the takeaway from your findings, right?
Absolutely, absolutely. And they're working longer, not just for financial reasons, but they're also working longer, Brian, because they want to keep their mind sharp, because they don't want to be bored. So there's very positive reasons behind working longer.
Sure.
What are they doing when they go back to work? I mean, are they still in the industries they were in during their regular work life? Are they trying new things? And because I'd have to imagine it might be difficult to start over in an industry you were never part of that late in the stage.
That's a good point, Alexis. It can certainly be difficult, so you want to plan ahead, that you've thought through what other industry you'd like to go into. But we do see about 4 in 10 people who want to join a new industry, try something new. Again, think about these unretirees as folks who want to challenge themselves intellectually. They want to keep their mind sharp. So trying something new in a new industry gives them that opportunity. It might even have been a job that they would have liked to have done, but their career took them in a different direction.
What really stood out to me is people are working into their 70s.
Yeah.
What are they doing into their 70s? Obviously, they're not out there lifting bricks, I guess, or concrete. I don't know. Maybe they are. I'm not sure. What are they doing?
But you also need somebody to hire you at that age. And I have to think that can be a challenge, right? To say, look, I still have something to offer, even though I'm in my 70s or sometimes my 80s.
Absolutely. And in our TD Ameritrade study, we did have some of our older folks say that it is difficult to switch industries or find someone to hire you to use your skills to the best of your ability.
Right.
But I think a lot of it has to do with knowing what are your skills, and again, planning ahead a little bit to think about how do my skills translate into something else that I want to do, and talking to folks in that new industry.
I have to say, I see a lot of folks, I mean, just anecdotally at Home Depot.
Oh, sure.
That's like one of the places where a lot of
Yes.
people go. I mean, are those the kind of jobs we're seeing? Is it more customer service type or retail jobs that they're going into?
Our particular survey, we didn't ask them in particular what they were doing, what kind of industry they're doing. I know anecdotally, my mother, her neighbor across the street, he drives the school bus part-time.
Yes.
Because he
Another
likes
popular
that
one.
social interaction. So I think we are seeing that as well. Also think about from our study that for folks who were in their 70s saying they wanted to work, they were talking about 10 hours a week.
Okay.
We're not
It's not a
talking
full
about
40-hour
right.
week or something.
So
Okay.
what job would lend itself to a part-time experience?
All right, Christine Russell. Is it Russell?
I'm dying at my
Russell.
desk.
Yes,
Russell.
that's me.
Thanks so much for joining us. Interesting stuff.
Absolutely. Thank you, Alexis.
All right, that's going to do it for us here at The First Trade for this morning. I'm Alexis Christoforous.
And I'm Brian Sozzi. Now let's get one more check of the markets with Inez Ferre down at the New York Stock Exchange. Inez?
Brian, Alexis, taking a look at Canada Goose, you'll see the stock is a little bit under pressure right now. This is even though they beat on earnings and revenue for their latest quarter, driven by some of their key markets, the U.S. and also Asia. We're watching Datadog. Remember, this company went public earlier this year. Datadog is up this morning. This is after their first earnings report since they went public. They had priced their IPO, by the way, at $27 a share. They beat on estimates for the top and the bottom line, and the company also raised its current revenue guidance, current quarter revenue guidance. And then we're also watching Luckin Coffee. Luckin Coffee, which back in May went public, pricing their IPO at $17 a share. Their revenue for the quarter was a solid beat. Their loss for the quarter was wider than last year's, but remember that they have been opening stores, expanding aggressively in China, and the company says that they are on track to reach their goal of becoming the biggest coffee player in China by the end of the year. Luckin Coffee right now is seeing a pop up around 13% in the early hours of trading. The Dow's down 35 points. The S&P's down 6 points. Make sure to stay with us. Wi-Fi AM starts after the break. You won't want to miss the interview of Reggie Wade. He will be interviewing Nike Direct President
Good morning and welcome to Wi-Fi AM here at Yahoo Finance. I'm Dan Roberts. We've got Heidi Chung and Kristen Myers here on the couches to go over all the business news of the day. Right now, markets in the red. Check it out on your screen. All three major indices slightly in the red across the board. The Dow down just 30 points ahead of Jay Powell's testimony that we are awaiting. Now, at this hour, the first public hearings of the impeachment inquiry into President Donald Trump are scheduled to get underway on Capitol Hill. And Yahoo Finance's great D.C. correspondent Jessica Smith is there with more. Jess, what can you tell us about what might happen today?
Well, first, we'll start out with a series of questions from the ranking member and the chairman of the committee. That will be an extended period of questioning, and then we'll move on to member questions that'll each last about 5 minutes. This could go on for quite a while today. We're not exactly sure how long it could last, but there will be two witnesses, the top diplomat to Ukraine, Bill Taylor, and then George Kent. They will be answering questions from lawmakers. They have already testified behind closed doors, but now they'll be speaking in public, and the American people will have a chance to hear from them themselves. In a statement about the public hearings, Chairman Adam Schiff said, "We intend to conduct these hearings with the seriousness and professionalism that the public deserves. The process will be fair to the president, the committee members, and the witnesses. Above all, these hearings are intended to bring the facts to light for the American people." Now, the president's strongest allies, Republicans, have been insisting that this process is politically motivated, that the president did nothing wrong. So we'll be watching to see how far Republicans go in defending the president throughout the hearing today.
Hey, Jess, it's Kristen here. So are we expecting to hear anything new during this testimony, or is this all repeating what had been heard behind closed doors?
I think it will be a lot of repeating what was heard behind closed doors, but lawmakers will be able to really zero in on certain topics, and the witnesses will be able to focus on certain topics, the points that they want to get across. I think that lawmakers will really try to show their message or get their message across through their questioning today. I mean, we've had thousands of pages of transcripts. The American people haven't necessarily had time to go through every single one of them. So this is just a chance for lawmakers and witnesses to highlight key portions of that.
Jess, I know we have a bunch of hearings before anything really gets underway, but if we were to see a potential impeachment on the table, how soon would we be able to find out?
I don't know how long this process is going to take yet. Lawmakers are trying to move quickly, but they say they're not rushing this either. So this could be quite a few weeks of public hearings, and then it will move over to the Senate side if the House does vote to impeach. That Senate proceeding, we've heard something around 6 weeks, but nothing is set in stone here. So we're still waiting to see how long this will take to play out.
Jess, can you just explain to viewers, on Monday we were checking in with you after Mick Mulvaney was subpoenaed and just didn't show up. Now, today, very different. You can't just not show up today, right?
Well, these witnesses, we've heard, there are reports that they were subpoenaed. The White House has said that they are not going to show up, that Mulvaney's not going to show up. The White House has been pretty clear that it does not plan to cooperate on this. Yeah, I don't know if you can say that they just can't, they don't have that option here. I mean, the White House is going to do what it wants to do, and Democrats have said that they can move forward without having that direct testimony from the White House because they have the evidence they need. They have plenty of other witnesses, and they have said if the White House doesn't cooperate here, that is just more evidence of obstruction.
Jess, so just one more question for you. So obviously this inquiry is going on still while the investigation is ongoing, right? So we actually might hear about more witnesses a little later down the line that is going to testify in front of the public, correct?
We could. We don't know exactly who is going to be testifying in public yet. Democrats have said that they would release more names as this continues, but there's always the chance that as more people testify, you could learn of more witnesses that you need to bring in. So it's all still up in the air here as this investigation and this inquiry goes on.
Up in the air. All right, Jess, thanks so much. Good stuff. Appreciate it. Well, Google's next frontier is banking. Surprise, surprise. The company is getting ready to offer checking accounts direct to consumers under a project that was internally codenamed Cash. Now, partner banks like Citigroup will handle the back end, and the Wall Street Journal is reporting that the accounts will be branded with the names of the banks. They will not be branded as Google checking accounts. Ethan Wolfman, our personal finance guy, is here on the couches. What do you make of this? I mean, no surprise.
Sure, I think it's interesting.
They all want in.
We've seen a lot of tech companies getting interested in banking and the transfer of money. Obviously, whenever there is money changing hands, that is a prime opportunity, I think, as Kurt Vonnegut once said, for somebody to come in and grab the money. In this case, we've seen, obviously Amazon partnering with Chase in the past, Apple with Goldman Sachs. We've seen Facebook going the crypto route with Libra. It's working out for them, isn't it? And right now we have Google looking to partner with Citi and some other banks on checking accounts. Now, checking accounts really make a lot of sense for Google, I think, because there is so much data in checking accounts. You have all the debit expenses of people. You have what people have kind of in the rotating finances of monthly expenses. And so if they can figure something out how to make this possible, that would give them a huge advantage, I think.
So exactly how is this going to work? So, because they already have Google Pay. So how is this going to be different? How is this really expanding their reach in financial
And why would
services?
someone want to sign up?
Right.
Necessarily. I mean, I don't see
Well, so-
what added thing might
Right.
they
What
get?
is the added value that Google is providing?
If you think about what Google has done for email, Gmail really changed how easy email could be. I think there's a potential for people who are unhappy with the way their checking accounts are with extra fees and things like that. At the same time, banks have gone the tech route and tried to make things more like a Gmail for banking. Now, that's something that I think is going to be a big challenge for Google. Often people don't even like to change banks. That's a huge kind of pain. So how they can get users kind of remains to be seen. If they can do it cheaply, easily, I use Google's phone plan, which is kind of incredible how it's disrupted how that works compared to other mobile carriers. I think if they can make the user experience incredibly easy and simple, they'll have a big value proposition here.
Sure, this sounds great, but I feel like a lot of people on Capitol Hill might have a different idea in terms of regulation, how this looks for a lot of the big tech companies when they go to make different changes like this. So do you think the regulatory scrutiny is going to be very intense?
I'm sure we will continue to see Google's lobbying expenses rise. I think that's sort of clear. That would probably happen anyway. They're facing antitrust issues. But I think in this case, they're doing a very smart move, which has followed a lot of other companies and a lot of foreign banks that have come to the U.S., which is partnering with another bank that has a license, that has a relationship with regulators, and kind of taking it from there. If the other banks do the heavy lifting and they can kind of stay on the kind of user-facing aspect of it, then I think they'll be in a much better position. Handling compliance is incredibly difficult and expensive, and if Citibank or Stanford's Regional Credit Union can handle that instead, then so much the better for Google.
Now, we're talking about checking accounts, but you also monitor closely these online savings accounts that have good interest rates, and there's Ally, and there's Marcus from Goldman Sachs. I mean, that is even, it seems to me like a lower barrier to entry. I mean, you might think that Google would want in on that.
Yeah, I mean, all this stuff is purely, commodity kind of things like that. Generally speaking, although all of these companies have tried to differentiate themselves to give an extra sort of value thing. But I think
all brand.
I think here, you won't necessarily see the savings kind of account stuff because there must be lending to go out. The reason why they get all that money is to lend it out. And I don't necessarily see Google going that risky at first. It'll have to become a bank or have to work with another bank on some sort of lending product. Now, that could be the case for the future, but I think they're going to kind of ease their way into the pool, so to speak.
So I feel like we haven't addressed the elephant in the room, though, which is data privacy concerns. With a tech company then having, much like with Facebook, this tech company having its hands into your personal financial information, and then possibly, they say they don't want to use it, right, to sell to advertisers, but do we all really actually believe that?
Well, I mean, let's think about how other banks and things use your financial data precisely for those reasons. Your credit card spend, your debit card spend, all of those things. There's nothing that prevents the banks from selling this data, which they do. And so I think that might actually bring that issue out to the fold a bit more than it has. I think a lot of people don't realize that right now.
All right, Ethan, thanks so much.
Thanks.
Well, let's stick with Google and the topic of Google and your data, because the Department of Health and Human Services has now launched a federal probe into Google's Project Nightingale. The company had teamed up with Ascension, the country's second largest healthcare system, in what had previously been a secret deal to collect medical data on tens of millions of patients. Then the deal leaked, and the companies went ahead and announced it. And now critics want to know why consumers were not told that Google was collecting their data for this purpose. Yahoo Finance' Anjali Khemlani is on the couches with more. So what's happening here? I mean, we know, okay, there's going to be a probe.
Right.
What would that really lead to? Because so often, oh, there's a probe, well, and then life goes on.
I think it's based on actually a very small technicality in how the relationship is based, because Google has said that their relationship with Ascension is based on HIPAA law, and that their agreement with them allows them to in fact have access to this data as long as Ascension is okay with it, and as long as Ascension is doing what it can to protect it under HIPAA. So
too bad if customers aren't okay with
right. And that's actually the thing that I've been hearing on repeat since yesterday. All the health experts that I've talked to, it seems like they all got the same talking points, but the key repeat is it seems like we don't understand what's going on with our health data, period.
Right.
So we have obviously like the graphic up for everyone to see, but walk us through exactly what the value add Google is providing to Ascension with the health data, and therefore to people that are coming into doctors'
Not
offices.
unlike any other similar relationship, what they're trying to do is figure out how to make this relationship more efficient, how to make the hospital system itself more efficient. There's constantly complaints about the health system overcharging, running too many tests, things like that are what they're trying to figure out. And so the way that they're going about it is by, collecting all the data in one spot, looking through it, helping the doctors with the diagnoses or with trying to figure out what other tests might be relevant. So that's sort of like where the AI portion of it comes in, which is where Google is actually leading when it comes to sort of the health tech space.
So I guess we're going to continue to just see big tech and healthcare just work together and collaborate. I think this is just something that's going to continue. Is that what you think as well?
Yeah, I mean, I know that there is a probe into this relationship. A lot of the health experts seem to think that it's just going after Google again. But yeah, we're already seeing relationships like this. Do they go to the key, part that bothered people was that the patient identification data, like names and that kind of information is available. And whether or not that has already been happening in other relationships, no one knows, because no one's really asked that question. So that's what remains to be seen, is whether or not this is something that will see new regulation maybe.
Well, and Amazon, one of the other biggest ones, I think, that has had a lot of scrutiny.
Yes.
Absolutely.
What Amazon wants to do with healthcare and pharma.
But I mean, oddly, as I just mentioned, right, the issues about privacy concerns and stuff like that, I'm kind of like, well, I just feel like this is where healthcare is going to go. To have all this information in one, to have all this information in one almost centralized place, where if I go to a doctor in California, even though I live here in New York, someone has access to all my medical records, and I don't have to fill out all of those
that's
forms
the very worst thing.
all over again. They have
That has
access
got
to
to end
everything
in our lifetime.
I mean,
when you go and you get the clipboard,
and you have to fill
every
it
time
out.
you see a new doctor,
Right.
and then every time you see a
Right.
new doctor too, they don't have any of your information.
They have no clue. I'm sure this just creates better care. So I was going to ask, so the Google Ascension deal, this is the first partnership, but are there other Google partnerships like this one that are currently exist in the United States?
Yeah, so Google has a lot of health partners. They have varying degrees of similar relationships or different things that they're working on, but AI is the core underlying factor. So in what way they're using it, in what capacity they have access to information, that varies by company, but it's not the first. And for example, IBM was one of those companies that early on, Watson.
Dr. Watson.
Yeah, exactly.
We'll see you now.
So it's been starting from there.
Well, we have to use Watson for something.
Right, there it is. That's what's really going on. Anjali, thanks so much. All right, we'll keep monitoring. I'm sure there's going to be more news soon on Google and Nightingale. Coming up here on the show, what to expect during the upcoming holiday shopping season. Welcome back to Wi-Fi AM at Yahoo Finance. Markets right now in the red, just barely. We want to find out what's happening live on the floor of the New York Stock Exchange with Inez Ferre. Hi, Inez.
Hi, Dan. Look at what's happening with Tesla. Tesla is up right now more than 1%. Now, this is a stock, it's unbelievable. Back in June, it was sitting at below $200 a share. Now it's at $355. The big news, though, with Tesla is that they have selected Berlin as the European Gigafactory site. Now, this announcement was made by Elon Musk at an awards ceremony in Germany. He said that the new factory, the Gigafactory, will be located near the new airport in Berlin. And also he tweeted out that they will be building batteries, powertrains, and vehicles, starting with their Model Y. Now, over the summer, Musk had said that they're expecting production to start in the European Gigafactory by the end of 2021, so their site has been selected. And one interesting note also is that Musk had said that they discarded the possibility of the UK because of Brexit, because it was just too risky to put that Gigafactory in the UK. Dan?
Ines, you're so right about Tesla stock. It has been remarkable after everything that has happened watching that stock. Thanks so much. We'll see you soon.
Thank you.
Well, the holidays are right around the corner. Online retailers like Amazon and Walmart have already begun promoting their holiday deals. And despite the U.S.-China trade war, many projections are indicating a very strong holiday season for retail. That will be very important. Joining us with more is Deloitte's retail lead, Rodney Sides. Rod, thanks for coming on.
Thanks for having me.
So tell us about the Deloitte holiday spending study. That's the new thing. And what does that show us? Because what we hear from everyone is that with everything going on in the economy, and some people were, scared about a pullback, but now that looks less likely, but that this year's holiday shopping season will be extremely important.
We believe it's going to be a really exciting season. We think that the consumer's going to show up. They're going to spend a fair amount of money. We see the spending to be up year over year. We think the whole holiday is going to be over $1.1 trillion.
So tariffs, not a concern. People were saying, they're going to hit your wallet. The average person is going to feel it. It's coming soon. Holiday shopping season is when the average shopper will finally notice higher prices because of tariffs. Doesn't look like it.
It has not shown up so far in the price.
So I know the report mentioned that there were headwinds, however, brewing. Can you talk us through what those are?
Yeah, so we always ask a question, what do you think the next couple of years are going to look like? For the first time since, I think, 2011, we found that the respondents said, you know what, we think the economy in 2020 probably is going to slow down. About 44% of the folks thought that was going to be the case.
But when we take a look at retail, this holiday shopping season is shorter than the typical holiday shopping season. I hear the word omnichannel all the time, right? Like if you're a retailer in the space, if you're not an omnichannel company, you're going to have a hard time surviving in this industry. What are your thoughts on the winners, I guess, this holiday shopping season?
Well, I think the winners are going to make it convenient for the consumer because that's what wins in the holidays. With 6 less shopping days, either send it to me directly, make it easier for me to stop by and pick up, help me shop when I'm ready to shop because it's such a compressed season. So those who win on convenience are going to win.
So talk us through how the delivery wars, right? We've been talking about this a lot between Amazon, Walmart, Target, how this might actually play out this holiday season, right? Because it's not the fastest shipper that's going to get the customer, right? According to your survey.
That's correct. So about 85% of respondents said they prefer free shipping over fast. And then we determine what is fast versus free. So fast is 2 days or less. Free is reasonable within about 5 days. So those who are able to meet those demands are going to win.
It's funny, we've been talking a lot on our shows about how early now the holiday discounts start. I mean, Black Friday is now like really an entire week, arguably longer. The sales start so early that you wonder if you can even use the phrase holiday shopping season. I mean, it becomes like the entire fall and winter is like the holiday shopping season. I mean, does that take away a little bit from what used to be kind of the crush of just 2 weeks before Christmas, everything really heats up?
It does. And the other thing is not only the offers are there, but what the offers are going to be are also pre-public at that point, so folks can start to plan. But we found Cyber Monday to be much more important now than even Black Friday.
Really? And why is that? People are returning stuff, buying new stuff, they've gotten gift cards?
I think what you'll find is when people are looking, they want to go online, they've got the time on Cyber Monday. A lot of those promotions are pushed to that Monday versus the Friday, and so as a result, folks are spending time there.
Oh, I guess not returning stuff because I'm thinking.
Not yet.
Okay.
No,
they haven't gotten the Christmas.
They haven't given it yet.
But now they've had Thanksgiving and they're full and they're just feeling like full and fat, so they just sit and shop online.
Right.
Rod, really quickly, so some retailers are still choosing to close on actual Thanksgiving Day. Do you think at the end of the day that's really going to affect their holiday like their holiday sales?
No, I don't think so. I think that's settled out. It was a big issue about 3 years ago when folks started looking at that. But at this point, we're not seeing that be a huge factor.
So I wanted to ask you a question because I believe that I was reading in the report that the average spending for each consumer actually declined from last year.
It did, but last year we were up against some really tough comps. So we had predicted about a 20% increase last year that we knew wasn't going to happen. And so I think a lot of it was just one of those issues with the data itself. If you look at it over the last 5 years, the accumulated growth has been about 5% a year. So I think on average, it's going to be pretty consistent with what we've seen.
Okay. And then, of course, the ever increasing shift from going to stores to buying online. And you know that I love to talk about places like Bonobos, where you still go to the store, but then you walk out with nothing and they just send you everything. Is that kind of the future?
I think so. I think we'll see some of that continue. You know, what we're seeing, too, is maybe a little bit of an uptick in the resale market, which was a little bit surprise to us. So we didn't expect that to see that coming. But we're seeing consumers come back and say, yeah, I might be interested to look at resale as an option. I'm not sure how I would feel about getting a resale gift, but we'll see.
Yeah, maybe you won't know.
Perhaps.
It's a package like it's new. All right, Rod Sides of Deloitte, thanks so much.
Thank you so much.
Coming up here on Wi-Fi AM, we'll give you our trending tickers, stocks that readers are checking right now on Yahoo Finance, including what some are saying about one of the worst unicorn IPOs of the year.
All right, it's time for today's trending tickers. First up, we have Smile Direct Club. The stock is tanking in early trade after the company released its first earnings report after becoming a public company in September. Now, like many of its recent IPO peers, Smile Direct Club is a high-growth but unprofitable company. It posted revenue that grew 50% during its most recent quarter, but losses ballooned as well. Now, keep in mind, Smile Direct Club shares plunged 28% on its debut, which made it one of the worst-performing unicorns this year.
The worst one of a company valued over $1 billion, actually.
Right, injured unicorn.
Yeah, Jesus. Actually, you know what was really interesting out of this report? Their legal expenses have actually doubled.
Well, dentists are going after
Right,
it.
exactly. No, I think that's really important because this is something that we talked about a lot when they were going public. Essentially, how dentists were coming out and saying, "Look, Smile Direct Club should not at all replace you visiting an orthodontist." Like, sure, we might need to disrupt this space. Going to an orthodontist can be incredibly expensive, but like taking the doctor or the dentist rather completely out of the equation is a problem. And now we're seeing all of these states trying to create legislation to essentially prevent what Smile Direct Club is doing. So I wonder how long they're going to be able to continue the model that they currently have.
Well, and actually, I know that tech and video conferencing are disrupting lots of things, but I'm not sure that dentistry is something that I want to just get sent online. Like, I want the person who is the expert there in person going in my mouth themselves. They're the expert. No, seriously. I mean, I would prefer, for anything involving my teeth, I want to see a human being who's right there in the room with me.
Right.
And also, it is fair to say that while all these dentists and the ADA or whatever the group is of dentists, while they are raising legitimate questions and issues with Smile Direct Club, it's also true that, well, they're the biggest competitors. They're the ones being disrupted. So it's not shocking. And you have to take whatever they say with a grain of salt because they're the ones whose business is being disrupted by this company.
But remember, they don't go after Invisalign in the same way they have gone after Smile Direct Club. And Invisalign's expiring patents is actually what allowed Smile Direct Club and other competitors to really take rise. So, I mean, you do have to take that criticism with a grain of salt, but notice that they are only really going after one main company.
But to be fair, there's also a lawsuit where Smile Direct Club is suing the California Dentists Association for the way that they were treated when one of their places was raided.
Well,
so
you got to sue back, of course.
I mean,
gotta
there's a
countersue.
ton of
The
lawsuits,
way
and
they
this
were
company is just
treated.
entangled in a bunch of them. So we'll have to continue to monitor all the legal aspect of it. But the company sucks right now. The stock sucks right now, excuse me. But let's shift gears here and talk about another trending ticker that we are watching today. That is Luckin Coffee. Shares are soaring about 12% today after the coffee chain posted a wider than expected loss, but revenue much better than estimates during its third quarter. Luckin is Starbucks' biggest competitor in China. Now the CEO saying, quote, during the third quarter, sales from freshly brewed coffee drinks continue maintain strong growth, and we believe we will reach our goal to become the largest coffee player in China by the end of this year. Now, as of their most recent quarterly results, Luckin has 3,680 stores. Meanwhile, Starbucks has 4,125 stores in China.
Starbucks is, as I understand, opening stores at a faster rate, though. It depends on whom you ask, but I feel like the Luckin versus Starbucks thing has been a little overblown and a little over-exaggerated. I don't think Starbucks is really that worried about Luckin as a competitor globally. I mean, I know that in China, but
if you think about where Luckin started, they've caught up really significantly in just this past year. Of course, they listed here in the U.S. back in May, but in that time period, it's been outperforming both Starbucks and the broader market. I mean,
by the way, wider losses than expected, but revenue growth was, was
another
great.
one of those
It's something
stories.
we have heard so many times. I mean, every single earnings report recently that is about a tech company that went public within the last 2 years. Now I know Luckin is coffee, but oh, sure, it's all tech. Starbucks is tech. Everything wants to be tech. Every single one, it's, well, we're still losing money, and yes, in fact, we're losing more money than before, or more money than was expected. And yet, our revenue is growing. Well, revenue's nice, sales are nice, but can you make a profit? I mean, that's what you're in business to do.
But investors have not reacted the same amongst all of these companies when they receive, even though a lot of them receive that same story. So, I mean, like, revenue did better for Smile Direct Club, and yet their shares are sliding. So, I mean, Luckin, their losses are also, their revenue also not doing as well, but hey, stock is up today. I don't know though, but do we actually believe that Luckin's going to be able to become the biggest coffee player in China by the end of the, like, by this year?
If they did, what is it? What does that
just
matter?
number of stores?
Number of stores.
All right. Well, they're
Oh,
opening
well
quickly.
then.
That's what I'm saying. Like,
That
what
has
does
cost.
that eventually that doesn't even matter
Ooh, look
because
at the
it's about
stock.
who survives the best. Yeah,
Look at that line. Woo.
What's the market comparison? I thought Starbucks had like 50% of the market in China.
Julie LaRoche
And,
will
like,
tell you off the top
Luckin
of her
had
head
like
the
2%
rate at
or
which
something
Starbucks
like that.
stores are opening. It's something like a store every 3 minutes or something insane, something really hard to comprehend. But it's because China is just so vast.
Yes, that is
1.3
true.
billion people. Okay. We're going to drink our coffee in the break. Now, coming up after a short break, Apple TV Plus gains a big executive boost, potentially, and that could spell trouble for another soon-to-launch streaming television app. We'll explain. Welcome back to Wi-Fi AM here at Yahoo Finance. Markets right now are in the red, but just barely. We will keep monitoring. They might get close to the flat line soon. We'll see what happens. Now, Apple TV Plus has been out for less than 2 weeks with mixed reviews of its original shows like The Morning Show and See. But the platform might be getting a big talent boost. Former HBO head Richard Plepler is reportedly in talks to sign an exclusive production deal with Apple for Apple TV+. Now, Plepler left HBO after AT&T took control. Some big changes over at HBO right after that acquisition closed. Plepler was very well regarded during his time at HBO. The network became known for its slate of prestige shows, including, of course, Game of Thrones. There was Veep and Big Little Lies, just to name a few. And HBO, you might recall, is soon to launch its own new streaming service, HBO Max. So this, a little bit to me, if it happens, is kind of like, you know, one team losing its star player to its rival just before the two teams head to the playoffs. I mean, Plepler's going to bring his talent and his ideas from his old employer to Apple, and that will help Apple compete with HBO Max. Sorry,
that was
HBO.
the main concern in February when it was announced that he was stepping down, right? Because he's such a veteran and so loved in the space. He has all the connections with the producers, the talent. And so when HBO lost him, a lot of people were worried. They were saying, okay, where is he going to go next? If Apple can snag this deal, and right now Apple is essentially all original content, right? If they could really build up that library with solid content, I think people should be worried.
Yeah, especially because now you can have Apple TV Plus if you just bought a recent Apple product. You get it free for a year.
Giving it away.
Apple's clearly already showing they're willing to spend very big to make sure that Apple TV Plus works. You already hear how Netflix on some ends is struggling with subscribers. Disney Plus obviously coming out also into the space. Losing Plepler to Apple TV Plus is, I think, terrible news for HBO, especially since they're launching HBO Max. How many of us are going to go purchase that in addition? What shows on HBO are you like now?
The entire library of everything that's ever been on HBO. I mean, I've always found their streaming app to be laid out very nicely, and I mean, it has everything, which is really cool.
And movies.
You want to watch all The Sopranos? Yeah, they have a ton of movies. There is a lot on HBO. I will say that I'm a little surprised he didn't have a non-compete. I mean, he's going direct to a direct competitor, and he's going there promptly in the end. I mean, when did he leave HBO? Probably less than a year ago. And it is a sign of the turmoil that has happened at HBO immediately after AT&T came in. And in fact, some analysts who are very bearish on all this will tell you that HBO is in real trouble now. The culture, I mean, we know the juicy reports that came out of that town hall meeting where all the employees were basically told, we now want you to behave completely differently and consider your company and your job to be different. It's like, well, you know, some people are going to walk out the door voluntarily. Some are going to get laid off because there's going to be cuts. So tough times maybe at HBO.
Do you get a non-compete if you're kind of pushed out of the door?
He wasn't, though.
Well,
he left because he didn't have as much control, though.
Right. But there are reports that there was a lot of tension
with John Staten.
Right. When AT&T came on board.
They gave a nudge with the tip of a boot.
Right. Exactly. So that might be why there isn't a non-compete in place, as if instead of him saying, you know what, I actually want to quit, I want to leave, my time here is done. They might have had him sign those documents, but they pushed him out. Moving on.
All right, let's talk about TikTok, the Chinese video sharing app that has 1.4 billion downloads to date. It is very big already, only been around 2 years. That app is also boosting music streaming numbers. Now, if you haven't seen the app before, TikTok users record videos and add sounds or music from the app's library of sounds and music, and videos that use songs that end up going viral on the app have in turn boosted the song's streaming numbers on Spotify and YouTube and other places. The most notable example is Lil Nas X's Old Town Road, which ended up spending an unprecedented 19 weeks atop the Billboard Hot 100. That was discovered thanks to being used in a viral TikTok video. Now, there's also political controversy with this app because the parent company ByteDance is under a national security review by the U.S. government amid the ongoing trade war concerns about tech and privacy. And by the way, one of many U.S. companies that has already partnered with ByteDance, the NBA, which we know is going through a lot in China. So the average person who loves TikTok, I don't really think they care when they learn, oh, it's Chinese owned, but maybe they should.
I don't even think they know.
Current administration's claims about the Chinese using tech apps to spy on us, well.
I mean, well, first of all, consider who TikTok is popular with. It's not super popular with
kids.
Gen Zers.
It's not
It's
millennials.
Gen Zers.
It's not older people. It's Gen Zers. It's very
millennials are old
it's
now.
Kids in high school, kids in college that are really using TikTok right now. So I mean,
that in the Washington Post newsroom for some reason.
But
Okay.
to
Well,
that point,
so think about how much they would care that it's a Chinese company that has
Right.
made it.
I actually had never used TikTok, and then my friend was over at my place. She opened up her app because I was curious to see what it was like, and there was a song that was playing on someone's TikTok, and I wanted to know what it was, and so she showed me that it's like listed on the video, and I went to Spotify and I streamed it, and
Wow.
now it's on my playlist.
You are literally
I
the
am
cause
the
of this
story.
story.
Yes.
I did not know Old Town Road though was from TikTok.
Yeah.
I did not know that either. But
I mean,
TikTok
that's what
is
helped it
actually.
get big. It's not like it was.
I can
created.
see why people are into TikTok. It's actually very fun and interesting. I don't know how to use it personally, so I haven't jumped in. But yeah, the music that's played on it, you get really short snippets, but they're good. And a lot of people continue to use the same song for a specific theme that they're trying to portray in their videos. And I don't know, it's a very creative way to incorporate music and all of that good stuff.
Especially once Vine went away.
Yes.
I
I
think
loved
people were
Vine.
looking
Same.
for a way to create very short, you know what I mean, pieces of content. And it's interesting because to your point about how they create a theme, it makes it easy for like a meme to be created or something like viral. You know how everyone was like, this is my mom, this is my dad, and they got married. Do you know what I'm talking about? Wow, I'm alone on this. Everyone's laughing at me. Okay, we have some people on set here that do know what I'm talking about because then what happens is it moves over from TikTok onto Instagram, and that is where people that are our age,
I just don't know the one
right?
you're
But that is where people that are our age can then see those TikTok videos and hear
Really
some
late
of those.
though.
What I should have said when she said that and there were crickets, I should have said, "Okay, Boomer."
Wow.
Yeah,
It's
you wanna
too late
get
now.
a meme for you.
Hi, that's terrible.
Here's how I know I'm old. There was a time, relatively recently, where I thought of myself as an early adopter. People are talking about a new app. Oh, I'm on it already. You guys are just hearing now about, TK, whatever app it is. I already have it. And now we are here with TikTok, and I'm good. I don't need
It's been
one
out
more
for
thing.
3
I'm good.
years.
No, 2 years. I'm not going to download.
No,
it.
since 2016.
What's
I
so
thought.
crazy is TikTok is to us such an isolated just one app, right? But the fact that it's under ByteDance, which is then really threatening Baidu in China,
Right.
I think that is a larger story, especially for investors.
Absolutely. All right, coming up here on Wi-Fi AM, Nike splits from Amazon. A messy divorce. We'll tell you all about it.
Welcome back. I'm Ines Ferre here with our friend John Corpina. John, right now we're looking at the Dow that's down about 20 points. Fed Chair Jerome Powell will be speaking, will be testifying today in Congress. What are the markets going to be looking for in his words?
You know, usually in those comments that come out of Powell, we're looking for some transparency, right? So some information as what the Fed was thinking and what they're going to be thinking moving forward. Unfortunately, we're probably going to get the same answers that we've gotten before and the same information before. So nothing new coming out of there, which is going to be okay, right? I mean, we don't need anything too, off script at this point to shake this market right now. I think, our markets are clearly focusing on China and the continued headlines from there, the continued talks from there, and the impact that's going to occur there. Many other things going on in this world, but it seems like the China headline is really the one that's dictating our market.
And President Trump yesterday spoke here in New York saying that Beijing is dying to make a deal, that China's dying to make a deal, but didn't really give any details on about perhaps a rollback of tariffs or when, where a phase one deal would be signed. Was the market expecting that?
So kind of interestingly enough, when President Trump speaks about that stuff, he usually says gives us a lot of information, right? He says that, where we stand and what we're doing and all these great things. The fact that he didn't say anything yesterday might be leading us to think that they are a little bit closer than we think they are, and maybe someone tapped him on the shoulder and said, let's not say too much at this point right now. So that could be viewed as a good sign.
Walmart's going to be reporting earnings tomorrow. You've got retail sales on Friday. Two big data points for the consumer.
Yeah, I mean, clearly that's what Main Street can relate to those numbers, right? And we saw it with Amazon too. When you look at, Amazon and Walmart, household names like that, clearly relatable. And it is going to give us some sort of insight as to how Main Street investors are spending their money, especially ahead of this holiday season, and also how the larger retailers are gearing up for the holiday season.
And lastly, earlier we were just talking about looking at the impeachment hearings that are going on. They're not moving the markets, though.
They're not moving the markets at all. It's incredible that we have this on all of our live TV screens down here watching it, but yet the market isn't reacting to that. I don't think the market is really feeling that that's going to be a process that's going to happen quickly and get a lot of true information out of that. So I think there's other things that the market is clearly focusing on at this point. Maybe down the road at some point we get there, but as we're talking, the market has turned positive here as the discussions are going on TV. So I think, once again, it really just comes down to China at this point.
John Corpina, thanks so much for joining us. Make sure to stay with us. Wi-Fi AM continues right after the break.
Welcome back to Wi-Fi AM at Yahoo Finance. We're tracking the markets, and the Dow just a moment ago flipped into the positive, but not by much. We'll keep watching. As you can see, it's up 2 points. NASDAQ and S&P still in the red, but all three major indices basically flat as we await Jay Powell's testimony. Now let's talk about Nike and Amazon. Sneakerheads, sorry, you can no longer buy Nike shoes on Amazon. Nike announced that it will stop selling its products directly on Amazon in order to focus on its own direct-to-consumer business. Now, Nike had only just begun selling on Amazon 2 years ago. And joining us from Nike's new S23 NYC digital studio is our colleague Reggie Wade. He is with Nike's direct president, Heidi O'Neill. Hey, Reg.
Hey, Dan, what's going on? Yes, we are here at Nike's new Studio 23 NYC, right at Pier 23. I wish you guys could see it. We have backdrops of the Brooklyn Manhattan Bridge, real hardwood floors that we use in college NBA games, and we are here with the president of Nike Direct, Heidi O'Neill. Heidi, thank you for joining us.
Oh, thank you for having me. So glad you're here in our new space.
Yes, this is amazing. Now, it's been about a year since you transitioned to president of Nike Direct. How's it going?
Well, it's going great. I mean, we're on an incredible journey of digital transformation, and we're making things happen. You know, we love the fact that we're breaking down the walls between stores and digital and tech, and bringing amazing consumer experiences to life. We've launched 3 new store concepts, 4 amazing apps, and some never-seen-in-the-world services that I hope you've seen.
Yes, I've seen all of them.
Okay, cool.
Now, with so many different brands going to the direct-to-consumer model, what sets Nike's apart?
Yeah. That's so easy for me because it's such a privilege, the history we have at Nike. And, you know, I think everyone's challenged with transformation, sees disruption, and understands that we all have to ground our experiences in tech. But not every brand has the 1972 Phil Knight, Bill Bowerman brand that we have, you know? And if you think about it, we founded this brand on serving consumers one-to-one. We founded this brand on a flywheel of community and coaching and amazing product. And so if you think, you know, I wouldn't say my job's easy, but it makes my job and our team's job so much easier when you think about we're building off that heritage. And, you know, we've built a vision for our brand to make sport a daily habit. And when you think, and we really mean that, Nike believes that people's lives are better, you're healthier, you're happier with sport in your life. And when you have that as your compass, when you have that as your North Star for transformation, you know where you're going.
Now, it was reported earlier that Nike will no longer be selling its sneakers and clothing directly on Amazon.com. What was behind this decision?
Yeah, well, we have ended our pilot with Amazon, and you know, it comes back to a lot of what we've talked about before, which is that we are incredibly committed to amazing experiences for our consumers, direct relationships, and building unbreakable relationships, honestly. And so we want to move forward and make sure we continue to innovate on our own platform, and we also want to make sure that we build an ecosystem of partners, other partners that will help us have those direct and amazing experiences with our consumers.
You've been at Nike over 20 years. You've seen it all at Nike. CEO Mark Parker leaves in January. He's been at the helm 13 years. What do you think is Mark's legacy at the company?
Oh my gosh, you know, we celebrated his 40-year anniversary just on November 1, and it was incredibly emotional because we saw his legacy in front of us. We saw the shoes he's designed. We saw him actually in our Exeter location on the treadmill as working in the lab, so Mark is he's so much a part of our history of serving athletes, of innovating. His vision and passion for a product design is, I think, unmatched in the world, and he's always pushing us and Nike to our potential. He sees a potential that sometimes we don't even see. And you know, I think what's amazing about the transition is that he's still going to be here. He's still going to be with us as executive chairman, and he's been actually a huge part of this Nike Direct transformation as well. And because he knows and he believes in innovating for the consumer, so it was so easy for him to apply this theory of innovation to a new structure.
Speaking of innovation, new CEO John Donahoe takes over in January, and he has an extensive tech background. He was the CEO of eBay and ServiceNow. Where do you think he will bring Nike?
Yeah, that's great. Well, first of all, I hope you feel and see this. There's an incredible power in this transition, that Mark is staying with us, that John has been on the board with us for 4 years. So he's part of our entire strategy. And then I think it says a lot, you know, that Nike is bringing on a proven, successful, visionary tech leader to the Nike brand. And you know, we've been talking about tech. We've been delivering some amazing experiences, but it makes me so proud that Nike is bringing this leader to help shepherd us to the future. And he's a tech leader, but he's also a people leader. You know, I've had a few conversations with him, and he's so committed to our 74,000 employees. And I think he's called over 50 of us like the day after the announcement to make sure he's connecting. So he's tech, but I might say he's people first before tech first.
Heidi, thank you so much. This has been a wonderful experience at these beautiful facilities. Thank you very much, Dan. Back to you.
All right, Reggie Wade with Nike. Thanks so much, Reg. Great stuff. And coming up here on Wi-Fi AM, Disney Plus is a big bet for Disney. That is just one of many things that Bob Iger very candidly discusses in his recent book. We'll discuss some of the gossip. Welcome back to Wi-Fi AM at Yahoo Finance. Just yesterday, Disney Plus launched. It was a little bit rocky on day one. There were some outages because of the high demand. But it is a good time to discuss Disney CEO Bob Iger's recent book you might have missed, The Ride of a Lifetime. It's a business memoir, and it came out at the end of September. The book contains a lot about his success at Disney, where he has been CEO since 2005. It also contains some surprisingly candid moments and news nuggets that you might have missed, and a few that stood out to me. I mentioned Disney Plus. Iger, of course, that comes toward the very end of the book, and it's interesting. I mean, he's betting that it would be a success because the book comes out and Disney Plus wasn't out yet, but there's a whole section on launching Disney Plus. And he does say very candidly about how, we're going to be spending a ton of money and our shareholders and our backers are going to have to just be patient because this is a major gamble, but we are betting on the future of the company. He said that the announcement made in August 2017, when Disney announced that it would soon launch ESPN Plus and Disney Plus, marked the beginning of the reinvention of the Walt Disney Company. And he said, we are now hastening the disruption of our own businesses. So that was interesting to me. But now, in terms of the sort of gossipy, juicy parts, he also gets very behind the scenes with the 4 in a row huge acquisitions that he steered. Pixar, Marvel, Lucasfilm, and looking back in hindsight, all 3 of those were huge successes. And then most recently, 21st Century Fox. Some of the stuff that stood out to me, he talks about how George Lucas said when Iger approached him, well, I want the Pixar deal. And then Iger writes in the book very candidly, well, Lucasfilm is not worth what Pixar is worth, and we knew it. And I basically said to him, you're not going to get that, buddy.
Which for the audience at home was over $7 billion. So.
Exactly right. And so he comes down on his price, but he still demands more than $4 billion purely as a symbolic gesture so that Lucasfilm gets more than Marvel got. So the Marvel acquisition was $4 billion. In the end, Disney buys Lucasfilm for $4.05 billion, just as a gimme to say, okay, see, George? So I really thought there was a lot of good juice in there.
But
and
also
man,
the Twitter
Disney
stuff.
is really in the news right now.
The Twitter stuff.
Declining to purchase Twitter.
Well, and it had previously been rumored that Disney had considered buying Twitter. Then 2 years ago, Iger confirmed we considered it, but he didn't get that into it. In the book, you find out they didn't just consider it. It was all set, good to go. The Disney board approved it, the Twitter board approved it, and he personally at the last minute decided this doesn't fit our brand, there's too many risks, and he called Dorsey, and he describes Jack Dorsey as stunned when he said we're changing our mind.
In hindsight's 2020, but would you say that's a good call? Because I absolutely think it's a great call.
Too risky, and Iger's reasoning is exactly right. It wouldn't fit with the Disney brand.
Absolutely.
Right. No, this is why Iger's comp is so high, and honestly, deservedly so. No, because we have talked about it before. He was at the helm of huge acquisition deals that were massive wins for Disney. He then, of course, declined to buy Twitter, which obviously, as we all know, was a really great decision in hindsight. Personally firing Roseanne Barr, that was huge in the news. And he did it at a time when a lot of other companies were really hesitant almost to really take on people within their own companies that were saying things that were not very popular.
It makes you think, what is Disney without Bob Iger?
Right.
What kind of company would it look like?
In 2021.
Exactly. So we've got to start thinking about that, guys.
One more nugget in the book. It had been rumored, another sort of rumored that hadn't yet been confirmed until the book, that he was considering a presidential run. In the book, he makes it very clear, not just considered, did a bunch of homework, reread the Declaration of Independence, the Constitution, the Bill of Rights. He was all set to run, but then the Fox deal happened, and Murdoch said, I'm not going to sell you Fox unless you stay at the helm of Disney until 2021. He said, forget it, no presidential run.
Maybe 2024.
All right, we'll be right back here at Wi-Fi AM after a quick break. Welcome back to Wi-Fi AM at Yahoo Finance. Let's take a look quickly at markets right now. You can see on your screen it is a mixed picture. The Dow is inching higher up 20 points, but the Nasdaq stuck in the red. Everything close to flat as we await Jerome Powell. That's right, we're just minutes away from Fed Chair Jay Powell testifying on Capitol Hill. You can see right there the room where it will happen. He is set to talk about the state of the economy. And of course, President Trump's latest calls for negative interest rates are likely to come up, and Trump's angry tweets about the Fed, which still keep coming. Brian Chung, our Fed watcher, is here to set the stage for us. Brian.
Yeah, so negative interest rates definitely something that President Trump hit on yesterday in New York City at a speech. He was saying, give me that money. I want that free money, saying that those that have loans in negative interest rate countries are being paid to take out loans. In the United States, we're still a little ways away from negative interest rates. Are currently between 1.5, 1.75%. Jay Powell probably expected to say the same thing that he said in the past, which is that we don't pay mind to what the president is saying. Right. But as far as what we do know headed into this hearing, we do have his prepared remarks already released. He was basically saying in there that the current stance of monetary policy is, quote, likely to remain appropriate for the time being. So translation, it sounds like the Fed is on pause for rate changes at the moment.
Now, what happens after his prepared remarks are read?
Well, after his prepared remarks are read, the Joint Economic Committee will have the opportunity to ask questions. This is different than the Humphrey Hawkins testimony that happens twice a year, so it's not just the Senate or just the House. The Joint Economic Committee is a mix of both. Actually, a lot of the members of this committee are not the same members as the House Financial Services Committee or the Senate Banking Committee, so a number of new characters that'll have the chance to pepper Powell with some questions today.
That's where it'll get interesting, the peppering Powell.
Right. I was going to ask, what types of questions do you think that he's going to be hit with today?
Well, in addition to what's the Fed going to do in the next meeting, keep in mind that there's only one more meeting, December 10, 11, for policy making for this year. Probably a lot of questions just about what is the broad stance for monetary policy in 2020 as they head into next year. Concerns about the recession appear to have abated for the time being, but there are still those political risks from the U.S.-China trade war and then slowing growth abroad. But for what it's worth, everyone seems to know that the Fed is on pause for right now. But the question is for how long? And I think that's what the questions will probably be focused on.
They will do what's appropriate.
Yeah. And the best part is that this isn't even like the most exciting thing on Capitol Hill right now. Usually the Fed chair going on Capitol Hill gets the attention of everyone, but like that's a huge room
What
that
else
they get
is
for the
going on
JEC.
Capitol Hill today?
Just that small impeachment hearing.
Oh, impeachment
Yeah.
hearing.
Did you forget about it already?
Jay Powell,
That
much
whole
more
thing.
exciting. All right, Brian Chung, thanks so much.
Yep.
Good stuff. And tomorrow, I want to let viewers know that I will be at the Paley Center here in New York for the annual summit there. We'll be interviewing Discovery CEO David Zaslav, MLB Commissioner Rob Manfred, and some other great names. And you can watch my interviews from the Paley event all day on our Yahoo Finance live shows right here on yahoofinance.com. That is Wi-Fi AM for today. Thanks for watching. Thank you, Heidi and Kristen. We'll see you right back here tomorrow at 10 a.m. But stay here for On the Move. That show is up next at 11, and I'm sure you'll hear more about what to expect from Jay Powell from our Fed guy, Brian Chung. Thanks.
All right, 11 a.m. in New York City, 90 minutes into the trading day, and moments away from Federal Reserve Chairman Jay Powell's testimony before the Joint Economic Committee on Capitol Hill. Now, ahead of the testimony, take a look at what's happening with stocks. The S&P 500 and the Dow are trading higher. The NASDAQ right now is off almost 5 points. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks so much for being with us. Well, Federal Reserve Chairman Jay Powell is set to testify before Congress's Joint Economic Committee any minute now. I want to bring in our panel to discuss. Yahoo Finance's Brian Chung and Jared Blickry are here. Jared, let's talk quickly about the market and what we're seeing here, because stocks are hovering near all-time highs. Not seeing much movement today.
No.
Are people looking for any kind of market-moving commentary from him?
Yes, I think they are. The big news is going to be trade, but there's going to be some give and take, I think, over the next few weeks before Phase 1 is signed, and I think Phase 1 has to be signed, but Trump has his back up against the wall potentially with the Chinese trying to bring some more concessions. I think that's the big story, but with respect to the Fed, yeah, we could see some market-moving headlines today. I don't think he wants to rock the boat. He's done it too many times in the past. We're near record highs. The last thing he wants to do is have another one of those meltdowns on his shoulders. Could come from Trump, and not necessarily the impeachment hearings themselves. You know, with markets so close to record highs, they're also kind of in the mood to sell off here. We got a couple markets like the transports, Russell 2000, European banks that reach an inflection point, and they're starting to roll over. Could develop a little bit of momentum to the downside. I think we're going to go higher into year end, but we might have to correct first.
I am curious, Brian. Help us understand the statement, or the opening statement from Jay Powell was released about 2 hours ago. At the end of it, he makes a big effort to say we're not doing essentially quantitative easing. Why did he go there?
Well, he's reiterated this in every public appearance so far. He made a big point of it in the last press conference on October 30 when the Fed cut interest rates for the third consecutive time. The central point that he's making is that the Federal Reserve is expanding its balance sheet. It is the first time it has continued to expand the balance sheet since it began the unwind process a few years ago. But the focus of this expansion is on short-term Treasury bills. And it's not even the 2-year Treasury. It's shorter term than that. The focus of this is because they want to make sure that the Federal Reserve balance sheet can allow for more bank reserves to flow in the system, so we don't have that weird repo episode, the flare-up that we saw in mid-September. But you know, those who might not be as familiar with the mechanics of how the Federal Reserve's balance sheet works might say this appears to be quantitative easing because it's asset growth. But what Powell is saying is that we're not targeting long-term, large-scale asset purchases like we did to battle the financial crisis, so it's not the same thing. This is not to target the yield curve or change anything about the yield curve. This is just simply us making sure that enough cash, enough money is flowing through the system.
But at the end of the day, 280 Bs is 280 Bs.
Right?
Yeah.
It's a lot of Bs.
It's a lot of Bs. I wonder also if he will get any questions about what President Trump talked about yesterday in terms of negative interest rates, because that was one of the really fascinating moments of the president.
And he's jealous.
Yeah, so, I mean, it was pretty thin applause where the president said, give me some of those negative interest rates, where in the past he said that the Fed is killing savers by cutting rates too much.
Yeah, well, the exact quote was great. He said, quote, give me some of that money. I want some of that money, referring to negative interest rates in countries like Germany, where in some cases loans actually pay out to those that are taking the money out. Now, I do want to emphasize that negative interest rate policy is strongly correlated with negative government bonds, but it doesn't always necessarily translate into consumer-facing negative interest rates on mortgages or loans and that type of stuff. But regardless, he says he would like the Federal Reserve to have negative interest rates, and told the room of those that were sitting at the Economic Club in New York that he would like to think that they would like the same thing, when I would probably say a majority of them would say we don't want negative interest rate policy because it upends the entire financial system by which they've been able to make risk-based pricing transactions to
He's
make
about
money.
to, he's about to start. You can see him pulling up to the microphone right there, Jay Powell.
Yeah, and just one more point on that. Kudlow kind of walked back that
He did,
statement towards the end of the day. So I don't think we're getting negative interest rates on purpose here. Might happen by accident.
Right, exactly. Well, and in any case, the president, as loud as his Twitter megaphone might be, is not setting interest rate policy.
He's trying to. He's pressuring them. They're listening.
He's setting HFT policy with respect to stocks, and that's about it.
I would argue that they are not listening. I would argue they're listening to the market. And it
Right.
just so happens that the president's desires are coincident with what the market
talk to these
wants.
folks.
Yeah, well, what I thought was interesting about Trump's comments is that he actually didn't strongly say that the Fed should cut interest rates further, maybe as much as I would have otherwise expected. He said, I wasn't happy with the interest rate hikes in 2018, and I think that they cut too slowly in 2019, but he stopped there. He didn't say that the Federal Reserve should cut further. So I found that kind of interesting because I think that President Trump, maybe similarly to markets, is understanding or at least reading the Fed commentary as they are on pause for the time being, and he might be settling for that.
several months, Powell has stood up to the president's Twitter storm and comments attacking the Fed, but you can't ignore the constant attack. Do they ever talk about the pressure they might be feeling? Because they get it also from members of Congress.
Well, the Bill Dudley op-ed in Bloomberg was the kind of breaking point where it was apparent to not just those inside the Fed, but those watching the Fed, that there is the downside risk of a Fed speaker coming out too strongly against the president. It's this kind of weird situation where if you defend the institution of the Federal Reserve too strongly, that actually gives the opposite reaction of maybe you having it inside your head too much.
All right, Lick Slick, we are starting out. We're seeing Vice Chair Carolyn Maloney, the Vice Chair of the Joint Economic Committee, who is speaking right now. Chairman Mike Lee appears to be late, so she is kicking off the hearing, and we are listening in.
Steer the economy through what in some ways are extremely challenging times. As you have said in your testimony, by some measures, our economy is strong. The national unemployment rate fell from 10% at its peak during the Great Recession to only 4.7% when President Trump took office, and it has continued to fall. It now stands at only 3.6%. The economy has continued to add jobs now for 109 consecutive months, more than 9 years. Inflation remains low, below the Fed's target. Wages are moving up, though not as fast as we would like. But it is weak in other ways. But other measures tell a very different story. GDP growth has slowed, falling below 2% in the third quarter. Job growth is also slowing. In fact, it has lagged behind the last years of the Obama administration. About 35,000 fewer jobs have been added per month during the first 33 months of Trump than the last 33 months of Obama. Manufacturing is in recession. Business investments have been shrinking for the past 2 quarters, and productivity fell last quarter for the first time since 2015. Some of these more troubling developments may be a sign of a possible end to our decade-long economic expansion or a slow fade from the sugar high of the 2017 tax cuts. But the most likely cause of economic uncertainty is the president's trade war. This leads to a fundamental question. How should the Federal Reserve act when one of the major challenges facing our economy is the erratic behavior of our president? So I won't ask you to answer that question, but it's on everyone's mind. You have an extremely difficult job, and not everyone has benefited from this economy. In past months, you have conducted a Federal Reserve listening tour called Fed Listens. And I want to thank you for taking the time to hear from Americans from all walks of life who experience our economy very differently. As you know, the economy as a whole can be very strong, while entire segments of the U.S. population struggle. Some regions still have not recovered from the Great Recession. Not all democratic groups have shared equally in the economic growth of the past decade. As members of Congress, we need to serve all Americans. You have shown that this is your concern, too. It used to be that a rising tide lifts all boats, but that has become less true, and we know that the tide lifts some boats much more than others. That's why I have introduced legislation that would give us insight into whom the economy is working for. My bill, with a lot of my colleagues, the Measuring Real Income Growth Act, would require the Bureau of Economic Analysis to report GDP growth by income and the top 1% alongside the top line number. It would tell us who is benefiting from economic growth. And that takes me back to the fundamental question before Fed policymakers. How low should unemployment go? How does the Fed weigh the benefits of very low unemployment versus the risks of inflation? We've had 11 straight quarters of an unemployment rate below what CBO tells us is the so-called natural rate of unemployment. Yet inflation remains comfortably below the Fed target rate, which raises the question, has the traditional relationship between unemployment and inflation weakened? If it has, then why? Is it downward price pressure from around the globe, or increased market concentration in certain industries in the United States, eroding worker bargaining power? Or are there other factors in play? And what if unemployment is extremely low, suggesting that we are at full employment, but the unemployment rate for African Americans or Latinos remains much higher? What if the unemployment rate for people in some communities or those who work in some occupations is stubbornly low? These are questions with wide-ranging implications for both fiscal and monetary policy. I look forward to your testimony, and I yield back, and our chairman is here. Great. Welcome.
Thank you very much for being here, Chairman Powell, and I appreciate your patience with our schedule. Votes in committee and on the floor are often difficult to predict. But welcome to the Joint Economic Committee's annual hearing with the chair of the Federal Reserve's Board of Governors. Chairman Powell, I'd like to extend you a warm welcome. I look forward to our discussion today. Our economy has finally recovered from the financial crisis of 2008. Unemployment has reached a 50-year low of 3.5%. It reached that in September and most recently stood at 3.6%. The share of working-age adults with a job has returned mercifully to pre-crisis levels. However, despite this welcome return to normalcy within our economy, and in terms of employment measures, many aspects of our economy remain unusual, and particularly so for central bankers. Inflation remains persistently low. In 4 of the past 5 quarters, inflation has been below the Federal Reserve's 2% target. Treasury yields also remain low, with a 10-year borrowing rate of just 1.9%. Interest rates that were once considered extraordinarily low have become a long-run expectation. These phenomena of low inflation and low long-term interest rates are not unique to the United States, but rather they're echoed in most of the developed markets around the world today. This moment brings with it some challenges, such as building a framework for fighting recessions in a low interest rate environment. However, it also brings some significant opportunities. With inflation still in check, we may have yet room to expand employment even further. As ever, it'll be important for the Federal Reserve Board to communicate how it addresses these challenges and these opportunities. In this regard, the greater transparency demonstrated by the Federal Reserve during your chairmanship, Mr. Chairman, is to be commended. In particular, the Fed has conducted a number of Fed Listens events around the country, including an historic conference held in June to hear feedback on current policy conduct, as well as to better understand the effects of monetary policy at the local level. Not only will these initiatives promote trust in the Federal Reserve and in its decision-making, they'll provide important information relevant to monetary policy from Americans who do not always get a seat at that table, and in the past haven't been able to understand how these things operate as well as they are able to today. I'll now introduce our witness. Mr. Powell is the 16th and current chairman of the Board of Governors of the Federal Reserve System, serving in that role since 2018. He first joined the Board of Governors in 2012. Prior to his appointment to the board, Mr. Powell was a visiting scholar at the Bipartisan Policy Center, where he focused on federal and state fiscal issues. Mr. Powell previously served as an assistant secretary and as undersecretary of the Treasury under President George H.W. Bush, with responsibility for policy on financial institutions, the Treasury debt market, and related areas. Prior to joining the administration, he worked as a lawyer and investment banker in New York City. So we thank Chairman Powell for attending today's hearing and look forward to hearing his insights. You're now recognized for your testimony, Mr. Powell.
Thank you, Chairman Lee and Vice Chair Maloney and members of the committee. I appreciate the opportunity to testify before you today. Let me start by saying that my colleagues and I strongly support the goals of maximum employment and price stability that Congress has set for monetary policy. We are committed to providing clear explanations about our policies and our actions. Congress has given us an important degree of independence so that we can effectively pursue our statutory goals based on facts and objective analysis. We appreciate that our independence brings with it an obligation for transparency and accountability. Today, I will discuss the outlook for the economy and for monetary policy. The U.S. economy is now in the 11th year of this expansion, and the baseline outlook remains favorable. Gross domestic product, or GDP, increased at an annual pace of 1.9% in the third quarter of this year, after rising at around a 2.5% rate last year and in the first half of this year. The moderate third quarter reading is partly due to the transitory effect of the UAW strike at General Motors. But it also reflects weakness in business investment, which is being restrained by sluggish growth abroad and by trade developments. These factors have also weighed on exports and manufacturing this year. In contrast, household consumption has continued to rise solidly, supported by a healthy job market, rising incomes, and favorable levels of consumer confidence. And reflecting the decline in mortgage rates since late 2018, residential investment turned up in the third quarter following an extended period of weakness. The unemployment rate was 3.6% in October, near a half-century low. The pace of job gains has eased this year, but remains solid. We had expected some slowing after last year's strong pace. At the same time, participation in the labor force by people in their prime working years has been increasing. Ample job opportunities appear to have encouraged many people to join the workforce and others to remain in it. This is a very welcome development. The improvement in the jobs market in recent years has benefited a wide range of individuals and communities. Indeed, recent wage gains have been strongest for lower-paid workers. People who live and work in low- and middle-income communities tell us, many of them at these Fed Listens events that the Chair and Vice Chair referred to, tell us that many who have struggled to find work are now getting opportunities to add new and better chapters to their lives. Significant differences, however, persist across different groups of workers in different areas of the country. Unemployment rates for African Americans and Hispanics are still well above the jobless rates for whites and Asians, and the proportion of people with a job is lower in rural communities. Inflation continues to run below the FOMC's symmetric 2% objective. The total price index for personal consumption expenditures increased 1.3% over the 12 months ending in September, held down by declines in energy prices. Core PCE inflation, which excludes food and energy prices and tends to be a better indicator of future inflation, was 1.7% over the same period. Looking ahead, my colleagues and I see a sustained expansion of economic activity, a strong labor market, and inflation near our symmetric 2% objective as most likely. This favorable baseline partly reflects the policy adjustments we have made to provide support for the economy. However, noteworthy risks to this outlook remain. In particular, sluggish growth abroad and trade developments have weighed on the economy and pose ongoing risks. Moreover, inflation pressures remain muted, and indicators of longer-term inflation expectations are at the lower end of their historical range. Persistent below-target inflation could lead to an unwelcome downward slide in longer-term inflation expectations. We will continue to monitor these developments and assess their implications for U.S. economic activity and inflation. We also continue to monitor the risks to the financial system. Over the past year, the overall level of vulnerabilities facing the financial system has remained at a moderate level. Overall, investor appetite for risk appears to be within a normal range, although it is elevated in some asset classes. Debt loads of businesses are historically high, but the ratio of household borrowing to income is low relative to its pre-crisis level and has been gradually declining in recent years. The core of the financial sector appears resilient, with leverage low and funding risk limited relative to the levels of recent decades. At the end of this week, we will be releasing our third financial stability report, which shares our detailed assessment of the resilience of the U.S. financial system. Turning to monetary policy. Over the past year, weakness in global growth, trade developments, and muted inflation pressures have prompted the FOMC to adjust its assessment of the appropriate path of interest rates. Since July, the committee has lowered the target range for the federal funds rate by 0.75 percentage point. These policy adjustments put the current target range at 1.5 to 1.75%. The committee took these actions to help the U.S. economy keep the U.S. economy strong and inflation near our 2% objective, and to provide some insurance against ongoing risks. As monetary policy operates with a lag, the full effects of these adjustments on economic growth, the job market, and inflation will be realized over time. We see the current stance of monetary policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook of moderate growth, a strong labor market, and inflation near our symmetric 2% objective. We'll be monitoring the effects of our policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. The FOMC is committed to ensuring that its policy framework remains well positioned to meet its statutory goals. We believe our existing framework has served us well. Nonetheless, the current low interest rate environment may limit the ability of monetary policy to support the economy. We are currently conducting a public review of our monetary policy strategy, tools, and communications, the first of its kind for the Fed. With the U.S. economy operating close to maximum employment and price stability, now is an especially opportune time to conduct such a review. Through our Fed Listens events, we've been hearing a diverse range of perspectives not only from academic experts, but also from representatives of consumer, labor, business, community, and other groups. We will draw on these insights as we assess how best to achieve and maintain maximum employment and price stability. We'll continue to report on our discussions in the minutes of our meetings and share our conclusions when we finish the review, likely around the middle of next year. In a downturn, it would also be important for fiscal policy to support the economy. However, as noted in the Congressional Budget Office's recent long-term budget outlook, the federal budget is on an unsustainable path with high and rising debt. Over time, this outlook could restrain fiscal policymakers' willingness or ability to support economic activity during a downturn. In addition, I remain concerned that the high and rising federal debt can, in the longer term, restrain private investment and thereby reduce productivity and overall growth. Putting the federal budget on a sustainable path would aid the long-term vigor of the U.S. economy and help ensure that policymakers have the space to use fiscal policy to assist in stabilizing the economy if it weakens. I'll conclude with a few words on the technical implementation of monetary policy. In January, the FOMC made the key decision to continue to implement monetary policy in what we call an ample reserves regime. In such a regime, we will continue to control the federal funds rate primarily by setting our administered rates and not through frequent interventions to actively manage the supply of reserves. In the transition to the efficient and effective level of reserves in this regime, we slowed the gradual decline in our balance sheet in May, and we stopped it in July. In response to the funding pressures in money markets that emerged in mid-September, we decided to maintain a level of reserves at or above the level that prevailed in early September. To achieve this level of reserves, we announced in mid-October that we would purchase Treasury bills at least into the second quarter of next year and would continue temporary open market operations at least through January. These actions are purely technical measures to support the effective implementation of monetary policy as we continue to learn about the appropriate level of reserves. They do not represent a change in the stance of monetary policy. Thank you. I will be glad to answer your questions.
Okay, we've been watching Federal Reserve Chairman Jerome Powell reading his opening statement before Congress's Joint Economic Committee. This all taking place on Capitol Hill. Before we go to break, take a look at shares of Facebook right now. They're trading lower just one day after announcing Facebook Pay, a new payment system for Messenger, Instagram, and WhatsApp. The company says Facebook Pay will be available as early as this week for U.S. customers, and it will run separately from the Calibra wallet. We're going to be right back and go back to the hearing on Capitol Hill with Jay Powell.
Welcome back to On the Move. I'm Jared Blickery. We got the Dow doing a big fat nothing, up 4 points as Jerome Powell speaks to Congress here. He's going to answer questions just in a few minutes. We have the S&P 500 at 0, and then we have the NASDAQ Composite down 7 basis points. Let's take a look at the intraday price action. And here we go. We started out a little bit down, climbed into the green during the 10 a.m. hour, and we're just hovering around the flat line right now. Also looking at the Russell 2000, it is down the most at 0.6%. We are seeing the 10-year T-note yield. That is down about 3 or 4 basis points, and that is contributing to some reverse rotation that we have been seeing lately. So we've been seeing this reflation into into value stocks versus growth, out of momentum, and now we are seeing the opposite today. So we're seeing bond proxies like utilities and REITs up, and we're also seeing financials under pressure. So we got to keep an eye on and see if this trend continues, because we were down yesterday as well. We have a very well advertised potential breakdown in stocks underway, but we have to see if it materializes. It's still holding support. We're going to take a look at gold futures because those are up and pretty interesting. We got copper down, gold up, and that is on the backs of the trade talks potentially meeting some friction overnight, and that has to do with those remarks that President Trump was making. So we're going to take a look at our Wi-Fi interactive heat map. This will be the NASDAQ 100. We can see a pretty mixed picture here. We can see Apple is up 0.75% at or near another record high. Microsoft just hovering around the flat line, the unch as they call it. Alphabet barely up, and then Amazon is down 1%. Just talking about Facebook down 0.5% after yesterday's announcement of Facebook Pay. And we're going to close out right now, but we are going to be back in a moment to listen to Powell.
Let's take a quick look at the markets. We've seen stocks bouncing around between positive and negative today. Basically, little changed as Federal Reserve Chairman Jay Powell testifies before Congress's Joint Economic Committee on Capitol Hill. Right now, he's taking questions from New York Congresswoman Carolyn Maloney, the vice chair of the committee.
My questions today primarily on preparing for the next downturn, whether it be 3 years from now, 5 years from now, whenever it comes. Historically speaking, is the Federal Reserve positioned as well as it has been positioned in past recessions when the Federal Reserve was the primary go-to agency where the federal government said, you know, we need help from you to stimulate the economy. Are we positioned there, or are we out of position?
Well, if you look at post-war, typical post-war recessions, where what the Fed has done is it's cut interest rates, and on average, the amount of those cuts has been 5% or so. So with the federal funds rate having peaked at about 2.4% and now being at about a little above 1.5%, we don't have that kind of room, and there are a couple of reasons for that. Just if you look at the longer-term interest rates, which are not directly affected much by our policy, they've just been declining for 40 years now, and that is because of inflation being lower and under control and less volatile, and also just the aging demographics means higher saving, means more savings relative to investment, and that puts downward pressure on interest rates. So I think the new normal now is lower interest rates, lower inflation, probably lower growth, and you're seeing that all over the world, not just in the United States. You're seeing it to a much greater extent in many parts of the world than we're seeing it here. So, knowing that, that is one of the main reasons we have, really the basic reason why we are having this public review of our monetary policy framework to see if there are ways we can alter our strategies, our tools, and our communications in ways that would make us more effective in this world where we're too closer than we would like to zero when we kind of run out of options. So that's one thing. Fiscal policy will also be important, though. I mean, I think from the standpoint of monetary policy, we're looking hard at ways to make sure that we can use our tools even after rates go to zero. Ultimately, fiscal policy has been a key part of the countercyclical reaction as well, though.
And next question, the disruption in the repo market that took place in September. Anticipated, not anticipated? Do you anticipate keeping the expansion at the level it is until you're sure that won't happen again?
Well, so anticipated or not, it's a different world post-crisis, and really because of all the expansion in our balance sheet and essentially what we've done now is we've now required financial institutions to have a lot more liquidity on their balance sheet so that the Fed doesn't have to run in and with our own liquidity. So that's I think a big benefit to the financial system. But a lot of that liquidity is held in our reserves. We used to manage the interest rate by keeping reserves scarce, and we had a total of $20 billion. Right now, we have in excess of $1.5 trillion in reserves, and so that means that we're trying to find that level as we allowed the balance sheet to shrink, where reserves would become scarce, and there was really no way to know. I think the data that we had suggested that we were not close to that point until September. I think we're still very much looking at what happened in September, but I think we learned in September that we needed to make sure that reserves didn't go under that level that we were at in mid-September, which is a little bit shy of $1.5 trillion. So that's really what we're doing. It's technical. I think we have it under control. We're prepared to continue to learn and adjust as we do this, but it's a process. I would say it's one that doesn't really have any implications for the economy or for the general public, though.
Thank you.
Representative Beatty for 4 minutes.
Thank you. That was Federal Reserve Chairman Jay Powell taking questions from Texas Congressman Kenny Merchant. And before we go to break, take a look at shares of Alphabet. Right now, they're trading about actually very little change. Google revealed its new banking endeavor. The Wall Street Journal is reporting plans to team up with Citigroup to offer checking accounts to customers as early as next year. We'll be right back.
So let's take a look at the markets right now as we get ready to go back to Jay Powell testifying before the Joint Economic Committee. You can see that the Dow is still in positive territory. The S&P 500 has slipped barely into negative territory. The Nasdaq is also trading down. We're going to go right now back to the hearing, and questioning Jay Powell is Joyce Beatty, the representative from Ohio.
Can you discuss how the Federal Reserve views the impact of climate change on our economy and monetary policy, and how the Fed's views have evolved over time?
So I guess I would say climate change is an important issue, but not principally for the Fed. It's not. It's really an issue that's assigned to lots of other government agencies, not so much to the Fed. Nonetheless, over time, it can affect us in some ways, which I'll mention. One just is that we require financial institutions and financial market utilities, the large utilities that are so fundamental to the financial system, we require them to be resilient against all kinds of things, including severe weather. There's a link between severe weather and climate change. So in a sense, we're already, to the extent severe weather is becoming more common, we're already incorporating that into our supervision. And we'll have to think ahead. We're doing a lot of research in this area to think ahead about sort of from a risk management perspective. Our perspective is not, we're not going to be the ones who decide society's response to, that's going to be elected legislatures, not us. In terms of monetary policy, it doesn't have any near-term implication for monetary policy. Over time, climate change could have effects, but it's not something that we'd be considering.
Okay. And only because of my time, my last question is, there was a 2018 report by Price Waterhouse that found that 80% of the venture capital investments went to just 4 states, California, New York, Massachusetts, and Texas. I'm from the great state of Ohio. And so I guess my question is, startups throughout the rest of the country, especially the Midwest, are overlooked. Are there any thoughts on the fact that an overwhelming majority of the venture capital is going to 4 states? What effect is this having on the regions like the Midwest?
I'd have to look at that study. I think, a company that's in San Francisco can invest in a company that's in Ohio, though. So I would hope that they're not just investing in companies in San Francisco, but.
So we should maybe look at some partnerships and how that works.
I do think, many of the successful companies in which venture capital firms invest are not located in those areas. Some of them are, but some are located anywhere in the country, really, where they're entrepreneurs.
Okay. Thank you.
Representative Schweikert, 4 minutes.
Thank you, Madam Vice Chairman. Chairman Powell, can I ask, I'm going to more of a global question. If you look at much of the data from the Fed, from the BLS, from others, our society is actually in many ways a sweet spot. A, do you agree with that? B, what do we do policy-wise to stay there? And for those of us up here, how do we not screw it up? And then how do we actually bias it towards the positive? What would you do?
So as I mentioned, 50-year low in unemployment, inflation low and under control, labor force participation ticking up, consumer confidence high. The outlook is good. I think households generally are focused on, according to the surveys, are focused on this healthy job market and wages going up. So it's actually a very good place from that standpoint. That's not to say that every community has benefited. We know that that's not the case. How do we keep it there? So the key to this, given the risks that we see are slowing global growth and particularly weaker manufacturing, and that affects U.S. manufacturing. So the key to keeping this going and to it continuing are that we keep job creation at a solid level, that households retain their confidence, that wages keep moving up. That seems to be the engine that's driving the U.S. economy forward at this time. But I want to go longer term with an answer. I mean, the U.S. faces longer term issues that really need your attention around labor force participation and productivity. Those are the two things that we really, where we in labor force participation, we lag most other advanced economies. And that's something we can do something about that really the Fed can't do much about. It's more about fiscal policy that's support attachment to the labor force.
So much of the policy that we all engage in here could be pushing up labor force participation. We're right now, what, about 63.3?
That's right.
Which for some of our models of testimony we had as a committee a couple of years ago, we didn't think we'd get that far. but we've demonstrated that there is slack out there. Could you touch on what we could do in that demographic headwind that is where we are in the United States to also encourage that labor force participation? Incentives for someone that's older to stay in the labor force, getting millennial males to actually start to equal millennial females in the labor force.
Well, I think
what would you do?
There's a range of policies, and they would appeal, I think, across the political spectrum. Some of them are about labor demand, some are about labor supply, and I think many of them would work. That's the great thing and I think for young males, it's going to be addressing the opioid problem. It's going to be skills and training and internships. We had a great meeting with a bunch of experts on internship programs recently. I think you're seeing older people stay in the labor force more and more. Their participation is moving up. But you also see, I think there are lots of programs which are pulling people, for example, women who've been out of the labor force back in after their kids are grown up. You see that happening at places as well. So I think there are just so many things that can be done. And we lag just about every other wealthy country in the world in labor force participation for prime age workers. This is not where we should be, and I think there are things we can do about it.
In my last 20-some seconds, slight non sequitur. Okay, with the dual mandate, how often in your conversations with your economists do you get into the discussion of currency differentials and the headwinds that actually creates both in export and capital coming into the country? Where are we currency-wise in your conversations?
So, exchange rates are one financial condition among many, and it happens to be one that is assigned to the Treasury Department for management. So the Treasury has full responsibility for exchange rate policy. We don't. It's just it's in all economic models when we change policy.
So it's just a model input?
It's just a model input. It's in no way is it a principal driver of the way we think about policy or the way other central banks do.
Thank you, Mr. Chairman. Madam Vice Chair.
Okay, that was Federal Reserve Chairman Jerome Powell taking questions from Arizona Representative Republican David Schweikert. Before we go to break, take a look at shares of Nike. Right now, they're trading higher after the company announced it will no longer sell its products on Amazon. Nike says its new retail strategy is part of a push, and this is a quote, to elevate consumer experiences through more direct personal relationships. We're going to be right back.
We've got two big movers for you, one up, one down to highlight right now. On the upside, we've got Datadog. This is an infrastructure software company, and it's made its first earnings report since its IPO back in September. The stock has done very well since that IPO, by the way, up more than 25%. And it continues to go up after revenue topped estimates. It also broke even in the third quarter, which is better than the loss that analysts estimated. And it forecast a continued smaller loss than estimated going into the fourth quarter. On the flip side, we've got Smile Direct, the maker of those transparent brace replacements, so to speak. Also, it's an alternative to Invisalign. Those shares are trading lower even after third quarter numbers beat estimates. The forecast for the full year did actually beat, but some analysts were looking for even better numbers. The implied fourth quarter EBITDA also missed estimates according to Citigroup, so those shares are trending lower. We'll be right back. Let's take a quick look at the markets now. Stocks are trading slightly higher as we hear from Federal Reserve Chairman Jay Powell testifying before Congress, the Joint Economic Committee. He's doing that on Capitol Hill. Let's watch. He is being questioned now by Florida Democratic Congresswoman Lois Frankel.
Really just those two things. In the United States, the trend growth of our labor force has been very slow. It was 2.5% in the 1960s. Now it's about 0.5%, and about half of that is immigration. So immigration is a key input into our longer-term growth rate. And I would say if you look to population growth as a way to support higher growth for the United States, then immigration would need to be in your thinking. But again, something we don't comment too much on.
Thank you. I yield back.
Thank you, Representative Tron.
Thank you, Madam Vice Chairman. Chairman Powell, thank you for being here today very much. I had some questions also on labor market participation, and I think you've addressed those, and also on immigration, how that could help us increase our labor pool. But I was thinking about the status of across the country now. We've got over 30 states have put in minimum wage laws from $13 to $16, and there's something businesses affected with everywhere. How do you see that's going to address the situation on the mismatch between labor scarcity and yet this very low wage growth that we see, and how does that tie into inflation?
Well, we don't take a position on minimum wage. It's really an issue you have to balance. There are two things to balance, and if I were you, I'd look at a broad range of research. Research comes to different perspectives, but in essentially all the research you see, when the minimum wage is raised a significant amount, you'll see some job loss, and you'll see some wage gains. And I would look at a range of that research, and I would try to think what the right policy is. That's how I would do it. In terms of inflation, it doesn't really play much into it. First of all, our mandate is price inflation, not wage inflation. We don't see wages moving up in any kind of way that suggests that they would put unwelcome upward pressure on prices. So I don't really think it is an important part of the inflation discussion right now.
And trying to translate this labor scarcity that we have into higher wages for the American workers. From 2012 to 2016, we had about a $120 increase per month in average wages. And then in 2016 to current, that's been cut in half, about $56 a month. And yet this is in the time of the lowest inflation, as you said, in 50 years, these last 18 months. So what does that mismatch between wage growth and lower unemployment mean to our economy?
Well, so we look at a wide range of wage and compensation measures, and what they tend to show is if you go back 5 years, wages and compensation were going up about 2%. That has gradually moved up to about 3%. And so that's really the trend has been upward. And that's consistent with the thought that a tighter labor market, lower unemployment, and surveys that suggest the labor market is tight. It is consistent with that. But we've seen wages moving up. We look at I could tell you the principal ones we look at, but I think that's true across all major measures of wages over the last, let's say, 5-6 years.
But why do you think they've slowed so dramatically the last 2 years?
You know, I think it's hard to say. I think average hourly earnings is an important one, which peaked at 3.4% earlier this year or at the end of last year, and has been sort of trickling down. It's right at 3% now, so it's a fairly modest one. I'm not at all sure why that is. It may be compositional effects. Some argue that as older workers retire, younger workers come in and they have lower. But in any case, you know, it's consistent with this idea that we're not seeing excessive tightness in the labor market that's generating outsized wage gains. We're seeing kind of nice wage gains given inflation and productivity, but nothing that's at all out of line with that.
Thank you.
Chairman Powell.
That was Federal Reserve Chairman Jerome Powell taking questions from Maryland Congressman David Trone. Now, coming up, flooding in Italy's famed Venice threatens to break an almost 50-year-old record. Plus, the Democrats have a new frontrunner in Iowa as they race for the presidential nomination, and it shifts into gear. Impeachment hearings are underway in the House of Representatives. First to testify before the committee, Bill Taylor, the top U.S. diplomat in Ukraine, and George Kent, the Deputy Assistant Secretary of State for European and Eurasian Affairs. The House Intelligence Committee is investigating if President Trump's dealings with Ukraine were illegal. President Trump will meet today with Turkey's President Recep Tayyip Erdogan at the White House. It is the first meeting between the two leaders since President Trump gave Turkey the okay to invade northern Syria and attack Kurdish soldiers who had been allies of the United States. Turkey considers the Kurdish forces terrorists. The mayor of Venice, Italy, says the highest tides in 50 years to flood the famous Italian city are signs of climate change, and the Italian government must pay attention. The recent flood reached 6 feet, the second highest since Venice began keeping records in the 1920s. The highest flood was over 6 feet, reached in 1966. Monmouth University released a new poll that shows South Bend Mayor Pete Buttigieg leads the race heading toward the Iowa caucus. 22% of those polled say they will support him in the Iowa caucus. Joe Biden came in second with 19%, Elizabeth Warren was third with 18%, and Bernie Sanders fourth, 13%. The poll shows Buttigieg gaining ground among every major demographic group. We'll be right back. All right, we are back in the green. Take a look at the markets right now. Stocks trading higher as Federal Reserve Chairman Jerome Powell testifies before Congress's Joint Economic Committee. Right now, he is taking questions from Committee Chairman Senator Mike Lee, the Republican from Utah. Let's watch.
Thank you very much, Mr. Chairman. Thank you to you, Mr. Chairman, for being here today. Some of the issues that I was going to raise have been discussed, the challenges ahead with our economy, including the deficit, which I will note was greatly exacerbated by the last tax bill, and as well as problems in some sectors such as agriculture, which is very important to us in the Midwest. But I wanted to focus on a third issue I have, which is income inequality, and even if people have jobs, it's often hard for them to afford things, and then you have the added problems and strains. Washington Post reported this year in September that income inequality in America is the highest it's been since the Census Bureau started tracking it more than 5 decades ago. The top 1% have experienced income growth of over 200% in the last decades. And between 2007 and 2016, the median wealth of lower income families fell by 42%. In your opinion, will widening inequality lead to lower growth expectations over the long term? And what should we be doing about this?
So I guess I would start by saying that I think we probably would all agree that prosperity should be as widely shared as possible. And so I would just point to 2 aspects of the broader problem that I think are important and need attention. The first is just the relative stagnation of incomes below the fairly high part of the distribution, and that's even after allowing for taxes and benefits and things like that. That's one thing where we want to see incomes moving up broadly across the income spectrum. The second is mobility. I think you want to see people moving from the bottom to the top, and vice versa, by the way. It has to happen just as a matter of arithmetic. So For example, the bottom 20%. What are the chances that if you're born in the bottom 20% of income or wealth, you'll make it to the middle 20% or the top 20%? The United States actually lags most other wealthy countries in that measure now. This is very much not our self-image as a country, and those are things we need to address. So I think those are important.
That's one. And I think increasing the minimum wage, I have my own views on this, would be helpful. But as you talk about that, one of our challenges right now is hooking up our education system with the jobs that are available right now and making sure everyone has access to those jobs. And I don't think it always means a 4-year degree. Some of the fastest growing job areas are 1- and 2-year degrees. I think we're going to have 64,000 or 74,000 openings for electricians. And one of the things I'm really focused on is apprenticeships and trying to make it easier for people to access those kinds of degrees. Could you briefly talk about that?
We just met last week with 6 people who run apprenticeship programs and funding of apprenticeship programs around the country in our boardroom, and I have to tell you, it's very, very impressive what they can do. They're focusing on low and moderate income communities. They're getting them in high schools and out of high schools and matching them up with employers who need those people. They're getting good jobs. It's really working. And the thing that limits their ability to do this on a much wider scale is funding. So,
Exactly.
yeah, it's I mean, it's very impressive what they can do.
I think a lot of this is how we use our resources for education and matching that up. I'll ask you in writing a question on retirement. I just think it's becoming such a challenge in our new economy and Senator Coons and I have a bill to address that called Up Savings Accounts, which I think is a great idea for small and medium businesses. But my last thing is back to the income equality very briefly. How would reporting economic statistics by income bracket benefit our understanding of the economy? We don't have that right now.
We're actually doing something with that at the Fed. You know, we like to cut data up and look at it in new ways, and this is one of the things we're doing is combining a couple of data sets that we had. We're quarterly publishing a distributional financial account.
And when will we get that then? By the next?
The next one comes out every quarter. So it's a new thing that we're doing. And again, it's just a combination of 2 existing data sets that we have. But we think it's an interesting insight into the economy. There are a lot of different ways to look at what's happening in the economy, and that's an important one.
Thank you.
That was Federal Reserve Chairman Jay Powell taking questions from Minnesota Senator and presidential candidate Amy Klobuchar. Before we go to break, take a look at shares of Tesla. Right now, they're trading lower. That's after CEO Elon Musk announced the company will open a new gigafactory in Berlin. Musk says the factory will be used to produce batteries, powertrains, and vehicles, starting with the Tesla Model Y. We'll be right back. It's just afternoon here in New York City. We're 2.5 hours into the trading day. Stocks are little changed, slightly to the upside, as Fed Chairman Jay Powell testifies on Capitol Hill. We're also taking a look at the 10-year Treasury as he speaks. Of course, his commentary could be relevant to monetary policy. We're seeing a 3 basis point pullback, though, in that 10-year. 1.88% is where we stand. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We're going to head back to Capitol Hill as we watch Jay Powell answer questions from Washington Democrat Congresswoman Jaime Herrera Beutler.
Be addressed, particularly as it relates to expanding or at least not contracting the economy?
So I think it's a longer term issue that I imagine we all realize will have to be addressed over time. It's just the case that now that the debt is growing faster than the economy, than the nominal GDP. And ultimately, in the long run, that's not a sustainable place to be. Now, how to fix that? It's easy to say that, and how you do that and when you do that is an issue that is up to you and not to us. But I would be remiss in not pointing out that the consequences of not addressing it are just that we'll be spending more and more, our kids really, and grandkids, they'll be spending their tax dollars servicing debt rather than on the things they really need, as I mentioned earlier, education, healthcare, security, all the things that we need, that they'll need, they'll be spending more and more of their money on tax. But you don't need to balance the budget or pay down the debt or anything like that. You just need to get the economy growing faster than the debt. And that should be I think, the goal. And by the way, the successful programs for countries to get back on a sustainable path tend to take place over a long period of time and be relatively gradual. And I would be looking at something that would work over time, but really would not be giving you a lot of advice on how to do it.
With my final 30 seconds, do you anticipate maintaining the current Fed rate through the next year?
No, I wouldn't say that at all. What I've said here, and I'll go right to the actual language, is that we see the current stance of monetary policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook of moderate growth, a strong labor market, and inflation near our symmetric 2% objective. So that's a very data-dependent statement. We do think monetary policy is in a good place, but we're going to be watching very carefully incoming data, and if developments emerge that cause a material reassessment of the outlook, then we'll act appropriately.
Context, context, context. Thank you. I appreciate it. With that, I yield back.
Representative Beyer.
Mr. Chairman, thank you very much for your equanimity, your strong and stable leadership, and for providing about the most straightforward answers of anybody we talk to. Yesterday at the Economic Club in New York, the president continued his criticism of the Fed, saying it had put the U.S. at a competitive disadvantage, and he also floated the idea of negative interest rates. Do you take comments from public officials into account when implementing monetary policy? And is there any precedent in U.S. history for this kind of criticism or praise from an American president?
So we look exclusively at the data, at the research, and at the performance of the U.S. economy. Those are the things we have a very careful, thoughtful process that's been developed over decades, over a century really, and that's how we try to set interest rates. We don't consider political factors and things like that in what we do.
Thank you. I have a friend in Switzerland who went to borrow $10 million and got a negative interest rate, negative 0.3%. So they're paying him $30,000 a year to borrow $10 million. Do you see any prospect for negative interest rates in the U.S. economy?
Well, negative interest rates would certainly not be appropriate in the current environment. Our economy is in a strong position. We have growth. We have a strong consumer sector. We have inflation that's a bit below target. So the very, very low and even negative rates that we see around the world would not be appropriate for our economy. You tend to see negative rates in the larger economies at times when growth is quite low and inflation is quite low. That's just not the case here. It's different for some of the smaller European countries. It's really about keeping their currency from appreciation, which is the case with a number of those countries.
Yeah. From December 15th through December 2018, there's slow, consistent increases in rates, and we've turned that around with recent cuts this year. Is there enough room to cut rates further if we get another slowdown or recession? Have we given up monetary policy as a tool at the moment for dealing with that?
Well, the typical post-World War II recession has involved rate cuts of close to 5%. The current federal funds rate is in the mid-150s, so we're well short of that, 1.5%. So I think it's a fact, not just in the United States, but around the world, that central banks are going to have less room to cut in this new normal of lower rates and low inflation. So that's why we are conducting this external review of monetary policy at the Fed. We're looking for ways to make sure that we have the tools to do what we're assigned to do by you, which is achieve maximum employment and stable prices even in downturns. And that's what we're going to be doing. I will say also, though, that fiscal policy is often, part of the answer, often a big part of the answer when there's a severe downturn. And we would certainly look for that to be the case if needed.
Thank you again by bringing up the challenge that the public debt faces all of us here. I was raised to believe that money supply and growth were causally related, that if our money supply grew more quickly than our economic output, that inflation was the inevitable result. But we're less than 2% this year. You have muted expectations. Is there no longer a connection between money supply growth and inflation?
I think
Should I pay any attention to modern monetary theories, for example?
Well, so the connection between monetary aggregates and inflation, that's something we all learned in Econ 101. I did. It was important. It was generally thought to be, and empirically, it was a good relationship. I think about 40 years ago, as the financial system developed all kinds of alternative forms of money, the relationship between monetary aggregates and growth has just gone away. And so we of course look at those aggregates, but they no longer are a driving part of the theory. It's really the price of money as opposed to the quantity that we look at, which is interest rates.
I'm out of time, but thank you very much. Mr. Chairman, I yield.
Senator Cotton.
Thank you, Mr. Chairman. Chairman Powell, welcome back. I want to start off by talking about China's economic growth. Maybe I should say China's economic growth, in quotes. They've reported most recently 6.5% growth. That's down from most of the last 30 years, but still probably somewhat inflated. In fact, Michael Pettis at the Carnegie Endowment for International Peace says that Chinese industrialists and economists find it hard to find any economic sector in China enjoying any growth. He had a few findings that I found to be quite interesting. First, GDP is not a particularly useful measure for determining Chinese growth because they have such massive investments in non-productive activities. Second, that China likely distorts its GDP data significantly in a way that's systematically pushing it higher. And then third, that increasingly GDP, as reported in China, is not so much a measure of economic output, but a measure of political intent, given the benchmarks that China imposes on local governments as well as many state-owned enterprises. As long as they have debt capacity and can postpone the writing down of non-productive assets, they could essentially achieve any growth target they wanted. What are your thoughts about this general question of Chinese growth and the specific points that Mr. Pettis' research had found?
I think it's very hard. I certainly feel that it's very hard to understand China. You can read all you want, you can visit it all the time, but nonetheless, it's still very hard, I think, for me anyway, to really feel like you understand the way the economy works, the way the society works. So I think that I think you have to, as a general matter, just accept that it's really hard to know. I think on economic data in particular, we don't, I'm familiar with Michael Pettis and his research and all that, but we haven't taken a view as an institution about that. I think a couple of things are worth noting. One is that, it may be that there's more information in the change than there is in the level, if you know what I mean. Another is that we've noticed here in the last few years that the volatility of their economic reports has declined substantially, which just kind of suggests a little bit more management. Nonetheless, we don't really know. The truth is we don't really know. We have to take the data, and we do take it with a bit of grain of salt.
You spend, at the Federal Reserve, and you're many capable economists there, a lot of time looking at a lot of underlying indicators and statistics to try to assess the direction of our economy. When you look at not just how the Chinese leadership in the Communist Party behave, but when you look at some of those indicators, well, how their people are behaving or how other things like, say, maybe energy inputs or shipping, so forth, do you see a country behaving as if they have almost 7% growth right now?
It's hard to say. I would say that one thing that's notable is that they have not responded with massive stimulus to this current situation. They've had, obviously, over a longer period of time, growth has been slowing from 3 decades of 10% as an economy matures, and I think they're trying to manage that decline. They did put an awful lot of stimulus to work after the financial crisis, and that supported their growth. I think they have been much more cautious and careful. They have a deleveraging campaign, as I'm sure you know, that's been going on now for 1 or 2 years, and they haven't really backed away from that. And that's part of, by the way, I think that is part of the global slowdown, actually, is trying to at least stop debt from growing inside China, where they have unusually high debt as a society for any emerging market nation. So I would say that they're behaving relatively thoughtfully and responsibly in response, they appear to be, in response to this current slowdown.
All right, thank you. My time has expired.
Senator Hassan.
That was Federal Reserve Chairman Jay Powell taking questions from Arkansas Republican Senator Tom Cotton. As we go to break, take a look at shares of Alphabet after Google revealed it's getting into the banking sector with plans to team with Citigroup on checking accounts next year. Shares, though, not much changed in reaction. Also, take a look at some of today's winners on Wall Street. As we watch stocks little change but slightly higher, we see the likes of Datadog surging higher after its earnings report.
Welcome back to On the Move. I'm Jared Blickery, and we're looking at WTI crude futures here, just up a little bit, having given back a lot of those gains. But we're going to take a look at some of the major markets that we look at over the day. Dow Jones Industrial Average is now positive, as is the NASDAQ and the S&P 500, but just barely. We're talking 17 basis points, 6 and 10, respectively. Let's take a look at the S&P 500 intraday price action. We can see, although we gapped down, we have headed higher throughout the entire day, and now we have this little bitty trend in place here. Have to see what happens as Powell continues his testimony before Congress. Let's take a look at a 3-month candlestick chart, because this is the one we've been looking at. Look at this uptrend that's been in place since October. We are just slightly in danger of violating this uptrend, and we have a lot of traders who think it's going to happen. We got some dojis, we got some spinning tops, whatever you want to call them. Some candlestick action suggests that we are rejecting potentially the 3,100 price level, but until it actually happens, we're not going down. So we got to be careful there. Also, market internals a little bit flat to down over the last few days, not kind of confirming the upward trend that we've seen over these last couple weeks here. So let's take a look at the CBOE Volatility Index. That is now rising just a little bit. We still have this support down here by 12. If we break above 14, that's a more significant indicator that we have a potential short-term top in the market. Also going to take a look at the U.S. dollar index. This has been on the rise since the beginning of November. We got to keep an eye on this because, of course, that puts pressure on emerging markets, on China, multinationals, as we head into the close, the final chapter of the year here. That's going to be very important to watch. So we're going to go back to break, but we're going to come back in a couple minutes and listen to Powell's testimony.
Welcome back to On the Move. Take a look at shares of Disney. They are jumping after the company unveiled its new streaming service. Disney Plus has 10 million subscribers. That's after 1 day since its launch. Let's head back to Capitol Hill, where Fed Chair Jay Powell is being questioned by Congress's Joint Economic Committee.
Please have that.
Clearly, that's the case. I just want to understand if we're looking in a broad way at risk and understanding the data from that sort of lens.
So I think that is the right lens. The lens for us is risk management. So there are researchers all through the Federal Reserve System who are thinking about the longer run implications of climate change for the economy, for financial institutions, and for all kinds of things. And I think that's appropriate research. We're just globally at the beginning of understanding that, and there's a lot of research going on, including a significant amount at the Fed. I think, honestly, for monetary policy, it's not a current consideration. It would not be something that would have any effect on the current setting of monetary policy. Over time, though, it could, for example, affect the neutral rate of interest or the volatility of economic activity and things like that. Those are things that we're thinking about for the longer term. I think the public will expect us to assess any risk and use that assessment in the way we supervise, regulate financial institutions, and also just potentially over the longer term in terms of monetary policy.
Do you have an opinion on robustness of how U.S. banks broadly are analyzing that risk? And basically what I'm asking is, do we need to start thinking through whether or not we need to either self-impose or at some point impose some sort of stress test to look at the assets that banks are holding and whether they're not, whether they don't have some concentration of risk if they're not thinking through that appropriately?
What we're doing now is we are trying to make sure that financial institutions that are in regions that may be subject to severe weather have plans to have redundant systems and be able to be resilient to that. That's the main thing we're doing. I think, so the Bank of England, as it sounds like you're aware, is doing a stress test based on climate scenarios, but it's not it's a stress test that's meant to be purely informative. It wouldn't do what our CCAR stress tests do and potentially limit distributions and that kind of thing. That's an interesting idea. We'll be monitoring it. I think we're going to benefit from some of the activity around the world that we're seeing with other central banks. We'll try to learn from what they're doing.
Yeah, we're obviously already seeing some places where it's harder to turn over a house in flood-prone areas. And if you had a concentration of mortgages that you were holding in areas like that, obviously that could pose a real financial risk. Do you think that GDP data adequately gives us enough of a picture about who is benefiting from the economy? And I guess, in other words, should we be looking at how economic growth is being distributed across the quintiles of the economy?
I think it's really hard to capture gross domestic product in a $22 trillion economy. I think the people who do that do a great job at it, but it's quite difficult. We actually, it's interesting to try to cut the income data. So we're doing some of that now with our distributional financial accounts. Other agencies are doing the same thing. I think when you have the data, we have a tendency to want to cut it up different ways and see what we learn. And so we're doing that now, and I think it is informative about the way income and wealth are shared, broadly speaking, in the country. It's an important perspective.
We're certainly looking forward to seeing that data.
Great.
Thank you.
Senator Cruz.
Thank you. All right, we've been watching Jay Powell testify before the Joint Economic Committee on Capitol Hill. We're going to come back to this in a second, but as we go to break, take a look at shares of Nike. The company is trading higher right now. It will no longer sell clothing. This was the announcement today. It will no longer sell products directly on Amazon. Take a look at also how cryptocurrencies are faring today. We're going to be right back and head back to Jay Powell. Welcome back to On the Move. The stream is green. Take a look at markets right now. All three indexes trading higher as Federal Reserve Chairman Jerome Powell testifies before Congress's Joint Economic Committee on Capitol Hill. Let's go back to that testimony.
Those allocating capital look at the political scene and look at some of the economic proposals being put forth by Democratic candidates for president. And I have concerns that that may cause people to tap the brakes in terms of deploying capital until at least after the election and finding out whether these policies might possibly be implemented. In your judgment, what would the likely economic impact be of the federal government implementing a massive tax increase?
Senator, I'm pretty reluctant to be pulled into the 2020 election, if you will forgive
and
me.
I certainly don't expect you to comment on the election, but you can't comment on the economy, and if a massive tax increase is good or bad for the economy.
That's indirectly where, as you started at your question, it's about proposals of candidates, and I just, honestly don't want to get into that business, if you'll forgive me.
Well, let me ask you, a number of candidates are proposing a wealth tax, not just on income, but on wealth. Do you have any views on the economic behavior that would likely follow from a wealth tax scaling as high as 8% annually?
It is really not our role to score or evaluate campaign proposals, and that's what the CBO does. That's what lots of other people do. We really try to stay out of that business.
All right. Well, let's try a different thing. Former Chairman Ben Bernanke in 2014 called the shale revolution, quote, one of the most beneficial economic developments in the country. Do you share that assessment? And conversely, do you have concerns about the impact on the economy if the federal government were to ban fracking and shut down the shale revolution?
I would certainly agree. I think that the energy independence of the United States is something that people have been talking about for 50 years, and I never thought it would happen, and here it is. It's in the nature of a miracle, it seems to me. So it's a great thing, I would say. It's not to say there aren't issues to manage, environmental issues, all kinds of other issues, but I think it's been a great thing for the country.
And would it be harmful to end it economically?
Well, I wouldn't be looking. I wouldn't be. I think to shut down the shale industry, yeah, that would probably not be a good thing for the economy.
Thank you.
Thank you very much, Mr. Chairman. We know you have a hard stop here in about 2 minutes. I wanted to use my prerogative as chairman to ask one final question. We're in the middle of some pretty strong economic activity, very low unemployment. Almost unprecedented economic stability. What policy or policies should we pursue to keep that going?
Well, I think that if you're asking for my views on that, I think that the thing to focus on, if I were in your shoes, are the longer run issues that we face, particularly around labor force participation and growth. It's about the potential growth of the United States. We are seeing now how important it is and how good it is to have a long expansion with a lot of growth and how it benefits people across the income spectrum. So I can't overstate the importance of that. I think in the longer run, the things we need to address are labor force participation and productivity, which is closely linked to education. So I think our workers need to have the skills and aptitudes to win in a global economy. And those are the things that are going to matter for our children and our grandchildren is what can we do now to keep the U.S. sustainable longer-term growth rate as high as it can be going forward.
Thank you very much. Thanks so much for joining us today, and thanks for your service on behalf of our country. Record will remain open for 2 weeks. We stand adjourned.
That was Federal Reserve Chairman Jay Powell testifying before Congress's Joint Economic Committee, closing out there with the chairman of that committee, Senator Mike Lee, Republican of Utah. I want to bring in our panel to discuss. Yahoo Finance's Brian Cheung and Akiko Fujita are both here with us. So Cheung, Brian.
Also Cheung.
So we call you behind the scenes, right?
Nickname.
Any surprises here in this testimony for you?
No real surprise. I think that for those that are watching the monetary policy side of things, the big buzz note is that he thinks that policy right now is, quote, likely to remain appropriate for the time being.
Some sort of confirmation.
Yeah, confirmation that they're on pause for right now after cutting rates consecutively by 3 times. I think that the markets are expecting this. If you look at Fed funds futures, it's basically a done deal for right now that they will not move in the next meeting. But at the same time, the risk for Powell to kind of disrupt markets wasn't really all that high going into this particular hearing, because he had said in the last press conference after they cut rates on October 30 that there's no real consideration with the Fed right now, bless you,
Thank you.
To cut or rather to raise interest rates at any point in time. So there was no risk that he was going to become too hawkish in this hearing. So nothing crazy there.
He was also asked about the president's comments yesterday regarding negative interest rates. He said negative interest rates would certainly not be appropriate in the current environment. You tend to see negative interest rates in larger economies at times when growth is quite low and inflation is quite low. It's not just the case here. That's just not the case here.
Yeah, I mean,
surprise from
I
him.
don't think that's necessarily surprising coming from Jay Powell. I mean, you know, look, the president has been putting the pressure on the Fed. We heard yesterday he said the markets would be 25% higher if the Fed was much more accommodative. So I don't think that's necessarily a surprise, but I do think that one of the things that kind of stood out to me was that at a time when we're hearing about a Fed pause, there's been a lot of discussion about, well, what's the fiscal side going to do? And he did raise the debt issue being a concern moving forward in terms of what that means for investments down the line. So I do think that that was kind of interesting.
They always raise the debt issue, though.
He's done that before, right?
All of them do.
And
Bernanke, Yellen,
nobody's
all
listening
had
to
that line
it.
for years.
Yeah, and for what it's worth, though, there was kind of an interesting brief exchange where there was a question, I forgot from who it was, but asking Jay Powell that, well, with negative interest rates so low, though, in theory, shouldn't we not be as worried because it doesn't cost the government as much to issue debt? And Jay Powell said, look, yes, it's true that interest rates are near historical lows. I mean, you know, we're not at zero anymore, but we're not far from zero at 1.5 to 1.75%. But he said that doesn't mean that we should not be concerned about the deficit. That's in direct contrast to some on Capitol Hill that have been arguing for the modern monetarist theory kind of approach, which is that deficits aren't as important, that as long as there's no inflationary pressures, we don't need to worry about government debt. Jay Powell is saying, look, I think that right now debt is outpacing economic growth in the United States. And that's something that at some point in time, we don't know when, but at some point in time could end up biting us back.
All right, let's shift gears a little bit real quick. It's still somewhat regarding financials and banking, because Google wants to cash in on its newest endeavor, checking accounts. The tech giant introduced Cash. The accounts will be run by Citigroup and Stanford Federal Credit Union, but we'll have to wait because not expected to launch until next year. So let's turn to the panel on this one. You got Apple, you got Amazon, you got Facebook. All these major companies are looking to branch out into finance. I think I know the answer, but I'll probably get it wrong. So tell me, why?
Well, I mean, there's huge potential, and it's all about data, right? I mean, if you think about, you find that partnership, your checking account says a lot about you as a user. So Google clearly wanting to go after that data. What I do think is kind of interesting here is that Cesar Sengupta, who's in charge of payments for Google, he's kind of leading this effort. And you know, he's done a lot of work outside of the US in places like India on the payment system. And if you look at the play that Google has made here in the US, whether it's Google Wallet or some other efforts in the past, I keep wondering if Google, just like Facebook, is really pushing for sort of this all-inclusive platform like a WeChat that would allow users to stay in the app to do their payments as well. And that's a huge opportunity. It's just much harder to do that, I think, here in the US.
How successful has Google Pay been, especially versus an Apple Pay, for example? Do we know? Have they given us any visibility on it?
I don't have the numbers, but I would argue that Apple Pay is probably a lot more used than Google Pay.
I would think so.
Yeah.
I mean, on the financial services side, I think it's so fascinating because Google is actually behind the ball if you think about it. Goldman Sachs, which is a financial services player, but they've only just recently nudged into consumer financial products by offering their Marcus deposit accounts, and then also recently teaming up with Apple to launch the Apple Card. So the digital race between these companies has already been taking place, and Google is actually kind of lagging behind Apple in that respect, despite the fact that checking is different from credit card accounts. But it raises questions for U.S. regulators. At what point do Apple and maybe Google, offer these types of products that would actually require a banking charter? That would create a whole new level of legal kind of complexity to this whole operation.
We saw them issue those charters during the financial collapse when they brought those who had not been commercial banks into the fold. I am curious, and this may be decades out, when do we stop having checking accounts? When do we stop moving from paper checks and these routing numbers and go to routing numbers that are all digital? Because there are already countries where that's essentially the way you transact.
I mean, I just think that there's so many different friction points here in the U.S., and it's just a tougher sell in a market that has been so reliant on that check, right? I mean, that's one of the conversations I was having a few days ago about. That was kind of, to me, sort of the cultural transition I had to make after living abroad for so long, is still having to deal with a paper check.
It takes 2 to 3 days sometimes to transfer money.
And yet this is the step to get us there, whether it's Google, whether it's Facebook, right?
Well, in theory, real-time payments is really the name of the game here. The Federal Reserve is trying to create its own infrastructure. That wouldn't come until 2023, 2024. But you're right, we're behind the ball. Mexico and Thailand and Singapore all have infrastructures that are a lot better and more updated than the United States. Now, you could argue that if the Federal Reserve or another party had already created that infrastructure here, Google or Libra wouldn't need to be creating these innovations right now because we'd already have that infrastructure to begin with.
Right, exactly. It seems like it's the regulators who have to move.
Right.
Rather than Google making it happen. All right, Elon Musk has picked Berlin for Tesla's European Gigafactory. Those shares up a little bit today. Inez Ferre is on the floor of the New York Stock Exchange with details.
Julie, earlier this morning, Tesla was up more than 2%. Now the stock is up fractionally. Elon Musk chose Berlin as the site for their European Gigafactory. This announcement came from Musk at a ceremony in Germany, and the new Gigafactory will be located near the new airport in the Berlin area. And Musk tweeted out that they will be making their batteries, powertrains, and also vehicles, starting with the Model Y. Earlier this summer, Musk said that he's expecting the European Gigafactory to be producing by the end of 2021. And we've talked so much about IPOs this year. I want to show you what's happening with a couple of names, a couple of stocks on the heels of their earnings. Luckin Coffee, you'll remember that they went public back in May, pricing their IPO at $17 a share. Well, their revenue for their latest quarter was a beat. The company says that they're on track to becoming the biggest coffee player in China by the end of the year. Luckin Coffee today is up around 14%. Also, Datadog, which went public in September, they had priced their IPO at $27 a share. Look at what they're trading at right now. This is after their first earnings report since going public. They're seeing a pop today, up around 14%. This is after a revenue beat, also after breaking even for the quarter, and the company raised its revenue guidance for the current quarter.
Thanks, Inez. Well, there's a major breakup in the retail world. Nike is announcing it's going to stop selling its sneakers and apparel directly on Amazon's website. This split comes amid a massive overhaul of Nike's retail strategy as the company recalibrates to focus more on selling directly to consumers rather than via third parties. Let's turn to our panel. It's also interesting timing, right? Because the company has a new CEO after the departure of Mark Parker. We've got Tom Donohue, who's now heading it, ex-eBay and ServiceNow CEO, although presumably this was already in the works before the CEO change, because it's something that takes a little while. But is this the right thing for Nike?
I mean, I think it speaks directly to the new vision that the new CEO coming in will bring to the company. Mark Parker, for what it's worth, has not left the company yet. He's still on until January, I think mid-January it is. But regardless, you have Donohue, who is basically a guy who comes from the e-commerce world as he brings his tenure from eBay to the company. The Nike distribution channel, I don't want to say it's been the part that has been a point of struggle for Mark Parker, because I mean the stock has been doing relatively well, in the past few years. But you do wonder to what degree Nike fumbled around with its distribution strategy, because they kind of reluctantly signed that deal, or rather that partnership with Amazon some time ago to distribute on the platform, because it was just too large to ignore. They could not be part of that platform, or they could not exist without that platform pushing some of its products. But I think now Donohue's saying, hey, look, we have a network of brick and mortar stores around the world. We need to do and execute on that strategy better to make sure that we don't need to rely on these other companies.
I don't know if this is part of Nike's strategy, but there are ways to execute on that, because UPS, its Worldport headquarters, has warehouse after warehouse after warehouse, where major retailers or companies like Nike, rent space where product is either aggregated or put together and then shipped out directly from Louisville, Kentucky for delivery. So you can bypass the entire Amazon infrastructure if you've got that kind of deal in place.
Yeah, I mean, I wonder if this is just a Nike-specific strategy or if you see other retailers follow suit, right, without having to use Amazon. I mean, my hunch would be that this is a company as big as Nike can build its own infrastructure. So this says more about Nike's strategy than some of the skepticism retailers have with increasingly partnering with Amazon, but we'll see.
I think at some point there's going to have to be a quality control reckoning for Amazon.
Because of all the counterfeits.
Right. All the counterfeits, and there's just a lot of
pushing of their own
trash
product.
on there, to be honest.
And the listings are a mess.
Yeah, exactly. So at some point maybe they'll clean it up.
It's still very convenient.
That is true.
Boom,
That's why
you get it.
I and everybody else uses it. All right, as we go to break, take a look at shares of Visa and MasterCard. We've got a Federal Trade Commission inquiry into the company that is rearing its head again. U.S. antitrust regulators are looking at policies, alleged policies at those card companies that can prohibit merchants from routing card transactions over alternative debit networks. Originally, after these headlines came out, both those stocks took a little bit of a hit, but now we're seeing them not much changed. Plus, let's take a look at some of today's losers on Wall Street. If you look there, you've got Smile Direct falling after that company's earnings report. We've got some trending tickers for you from yahoofinance.com, and Canada Goose is first up, if we can get it going here on the touchscreen. There we go. Canada Goose is down 13% here. The maker of Coach you would think would be doing well amidst an Arctic freeze here in the Northeast and across much of the U.S., but it just reported earnings. Sales look good, up 28%. Earnings per share beat estimates, although some analysts said gross margin missed estimates. It's been spending a lot, opening new stores in places like Beijing and Hong Kong, so the Hong Kong store might have also taken a hit amid the recent protests. So that could be why the shares are trading lower today. We're also looking at Luckin Coffee. It is going in the opposite direction. The owner of a coffee chain in China says it's going to overtake Starbucks in terms of the number of stores by the end of the year in China. Revenue beat estimates. Its net loss did widen, and it says it's going to break even in the third quarter of next year. And then finally, we are taking a look at Party City today. Party City continues its tumble here. It has really been under stress recently, saw weak selling during the Halloween season, and now there's a report that funds affiliated with Thomas H. Lee Partners, its largest shareholder, have made a distribution of their entire stake of 35.7 million shares. There's a 15-day lockup period, but nonetheless, we are seeing a lot of selling in Party City. If you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
The House is holding the first public impeachment hearings in more than 2 decades. Democrats are hoping they can show the public that President Trump abused the power of his office in his dealings with Ukraine. Let's go to Washington and Yahoo Finance's Jess Smith, who's got details on what's already transpired. Jess?
Yeah, about 2.5 hours later, we've made it through the opening statements and the first round of Democratic questions. Republicans are just starting their questioning of the 2 witnesses. So far, George Kent, who is a State Department official in charge of Ukraine, has testified that there were efforts to gin up politically motivated investigations that were infecting U.S. policy toward Ukraine. The acting ambassador toward Ukraine, Bill Taylor, also testified that he understood that aid for Ukraine and a White House meeting was contingent on the Ukrainian president publicly announcing that he was investigating the Bidens and the 2016 election. Taylor said he found that very alarming. Taylor also had a new piece of information in his testimony that we have not heard before. He says that one of his aides was with Ambassador Sondland. When Sondland took a call from President Trump, the aide overheard the call, and here's what he says happened next.
Following the call with President Trump, the member of my staff asked Ambassador Sondland what President Trump thought about Ukraine. Ambassador Sondland responded that President Trump cares more about the investigations of Biden, which Giuliani was pressing for.
Taylor says he didn't know about that incident when he talked to the committee back in October, so he wanted to bring that to their attention. Chairman Adam Schiff started out his questioning asking about that incident, and Taylor clarified, saying that Sondland was telling the aide that President Trump cared more about investigating Biden's than he did about Ukraine. Now, as this hearing was ongoing, as it's going on, Democrats have announced another round of closed-door depositions, and that reportedly includes the aide that overheard that call. Those depositions are set for Friday and Saturday. Now, President Trump has been talking to reporters in the Oval Office. He said that he's not watching the hearings. He says he has not been briefed on them. He's too busy. But he added that he saw Democrats were using what he called television lawyers to ask questions, and he said that he wasn't surprised because he says Schiff can't do his own questions. So as I said, Republicans are asking questions now, so we'll be sure to keep you updated on how this goes throughout the day.
Thank you, Jess. Tesla has chosen Berlin as the site for its first European factory. CEO Elon Musk made the announcement at an awards ceremony in Germany yesterday. The Gigafactory will make batteries, powertrains, and vehicles, including the Model Y SUV. No word yet on how many people will be hired at the plant. Pras Subramanian joins us now. And Pras, this is a big move for Tesla. The only other non-U.S. factory is in China. And so what's the strategy here? Are they selling a lot of Teslas in Europe, presumably?
You know, they're pretty popular in Europe, but in Germany in particular, the Germans like to stick with their own kind of, luxury cars. But, the Made in Germany label is a nice thing to have. I think it's a good thing for Tesla, quality-wise. That region is great for talent in terms of workers and factory workers, people like that. Most of those factories are in the south of Germany. This is a new kind of, area that's being developed in Berlin. A lot of tech companies out there. It's like their Silicon Valley. So a good move by Tesla, and I think that, Musk had mentioned that they're looking at the UK.
Yeah.
And they say, Brexit is a risk. We're not going to do that.
Okay, but let me ask you this. There are 2 headwinds for Tesla, and correct me if I'm wrong, incredibly expensive for them to manufacture in Germany, and VW is making strides towards an all-electric vehicle. It's partnered with Ford, and it's huge. It's one of the largest auto manufacturers in the world. Tesla really thinks they're going to compete with that?
I mean, I think they have their own space there, right? They have their own fans. Not just for Germany, it's the rest of Europe. They're going to be building there and then exporting to different countries. It's actually near Poland, which actually is cheaper labor. The Berlin site is near, they can actually bring labor in from Poland, so that can kind of save costs there. So it is going to be a bit more pricey than, say, building in China, but I think they need to do that. They're going to save on, there's tariffs of 10% on U.S. imports to Germany, so you get to save on that too.
I was going to say that where in Germany again?
It's near Berlin.
Near Berlin. Okay, so that's not in the Bavarian region.
Exactly.
I mean, is there anything to be spoken to about why within the European region they decided to land on Germany as opposed to maybe in another Western European country where it might actually be cheaper from a labor standpoint?
I think it was a combination of the fact that it's closer to Poland, and that they wanted to be close to the tech hub of Germany, which is in this case Berlin, not so much the Bavarian region. But you're right, Mercedes, BMW, Audi, they're all in that the Bavarian region of Germany.
It's not the best way to show it. There's Stuttgart,
Oh my
that's southern
goodness.
Germany, and that's where most of the auto manufacturers are. And then you've got Berlin right there, and there's Poland.
I mean, it's a good 6-hour drive. You can still maybe entice some workers from there, right?
VW right down here. You want to take that check out there? VW's there.
That's Lower Saxony.
Berlin is right there, and literally Poland is right there. So, okay.
A little geography lesson along with Tesla.
Not a graphics maker. As we go to break, the streaming wars kick off. Disney shares are trading higher after the company revealed it already has 10 million subscribers for its new streaming service, which just launched yesterday. Let's take a look at some of today's trending tickers on Yahoo Finance. Hey, let's take a look at the top trending stories on Yahoo Finance right now. Google is pushing into finance. The tech giant is expected to offer checking accounts for consumers. Now, the project, nicknamed Cash, is expected to launch next year. The accounts will be run by Citigroup and a credit union at Stanford University. Speaking of Facebook, the social media giant is being accused of censoring posts that named the alleged Ukraine whistleblower without any explanation. In the plaintiff's complaint, the plaintiff says that they shared 3 posts on the social media site calling the whistleblower a hero, a dirty rat, and that he had conflicting thoughts. He says all 3 posts were removed within hours. And Starbucks is making a big splash in Chicago. On Friday, it opens its largest location in the world right on Michigan Avenue. It used to be a Crate and Barrel. The 4-story, 43,000 square foot Reserve Roastery features artwork from local artists and even a cocktail bar on the 4th floor. All right, let's go to the buzzer beat around. 3 stories, 1 minute each. We start with this. Free agent quarterback Colin Kaepernick will take part in a private workout organized by the NFL this coming Saturday. Kaepernick tweeted about the development, saying in part, and this is a quote, "I've been in shape and ready for this for 3 years. Can't wait to see the head coaches and GMs on Saturday." Will Kaepernick find his way back to the league? Here's Sports Nut.
I'm going to say yes. But in what capacity, I don't know. I mean, the fact that the NFL is allowing him to do this workout, a lot of teams are going to show up, is at least a sign or a step in the right direction. Earlier, or last month, I think his representatives came out and said they've gotten no response really from the NFL and other leagues. So I don't know, I say we watch it. I am indifferent here because I'm not of the camp that thinks Colin Kaepernick was an amazing quarterback in the first place, if I'm allowed to say that. But, but this is a good sign. I think the fact that the NFL is at least giving him an opportunity here.
Yeah, and I think we just need to remind everyone, I mean, because it's so long ago that the protests happened, that it was about police brutality and racial injustice. And if teams are willing to take him on, they should be willing to take on those issues and take a stance on those issues as well.
All right, an Arby's in Minnesota is creating controversy after posting a sign which read that only well-behaved children are allowed. Kids had to sit in their seats and eat their food. Anybody have a view on this?
What's wrong with this? I mean, it's a little rude the way they did it, but you know, it is also fast food. But
You're taking out a lot of customers, though, right?
yeah, well, the fast food you're
Saying that. I
bringing
mean,
the kids.
especially an establishment like Arby's, they've got to have a lot of families that come through. I do wonder what the backlash is going to be, but
I wonder what the backstory is too. Were they really having that
right.
many people come in with unruly children that they had to post a sign?
Right.
And like this is one of the sort of everybody knows this rule. And I, as a parent, my kids frequently do not behave, and I take them out or I do whatever you need. I mean, it's just.
But not everybody
if you
knows
need,
that rule.
Of course they know that rule. If you need a sign to tell you that rule, then you're, you know, that's.
There are restaurants that don't allow children under a certain age, but they're more
That's
upscale.
different, right? Because they have like alcohol or something. Not
You
at
can keep
Arby's.
going. We got a little extra time.
Not, sir, this is an Arby's. They don't ban children.
Yeah, no, I was just saying. I don't think a parent and their kids would turn around all of a sudden because it's like, oh, I guess only well-behaved children in this store, so I'll go kick it to Chick-fil-A instead. This won't change anything.
All right. More than 10 million users signed up for Disney Plus in its first day. Those subscribers now have access to more than 500 movies, and some of those films are coming with cultural disclaimers. Disney is warning viewers of outdated cultural depictions in some of its older films like Dumbo. I actually was watching some of Dumbo yesterday, and I was thinking, wow, I forgot about some of these things. Jungle Book, Lady and the Tramp, they're among the films that get warnings added to their Disney Plus descriptions. Bedknobs and broomsticks, by the way, totally safe.
I don't know. It's tough, right? I mean, there's so many movies that were made at a time when it wasn't quite PC. I guess Disney's just trying to protect themselves by saying that, look, we're aware of the time and place with which this movie was made, and we don't necessarily agree with it. But I don't know if you need a label to tell you that if you're watching The Jungle Book, you know that it was made decades
Right.
ago.
Yeah, and some of these movies are from the 40s, and it's kind of, you wonder to what degree. You can't ask Disney to remove all that content, but I think, if anything, it's good to keep that content in there as a reminder for those that are watching it that the standards were different back then and that we've evolved from those standards. So I think keeping it in there is actually, if anything, maybe an educational opportunity.
Yeah, I don't think it's a terrible thing. All right, let's take a last look at the markets here. We are seeing stocks little change. So not only, although we're seeing a little bit more of a lift than we did earlier, so not only not a huge reaction to Powell, not much of a reaction to the onset of the impeachment hearings, right? And investors that we've talked to, certainly Adam, have said we don't expect to see much reaction, perhaps unless things progress at some point down the road where actual impeachment looks more likely.
What was it during
Well,
Watergate?
he won't be removed from office, right? At the end of the day, that's kind of where the market.
There's not going to be, at least nobody expects, an Alexander Butterfield, who was the person who tipped off the Capitol Hill about the tapes, the Nixon tapes. No one's expecting that kind of moment in these hearings.
No, I mean, the impeachment story is the biggest story of the day right now, even for markets, I think, which is unusual. As a Fed reporter, usually Jay Powell or the chair going on the Hill is the big event. But, I feel like no one's really paying attention to that right now because this is the big political risk as we head into the election.
But they're not trading on it.
They're not trading on it.
It doesn't.
Not yet.
It doesn't appear so anyway. And then I think focus will shift to the holiday season as we get closer and closer to Thanksgiving, which is closer than ever to Christmas. So.
And we'll be talking about e-commerce sales, the numbers. What are we, 2-3 weeks away? Let's take a look real quick at markets before we give it off to Wi-Fi PM. You can see right there, Dow, S&P 500, NASDAQ, all trading in the green. Wi-Fi PM is going to take you through the next hour of trading.
Welcome to Wi-Fi PM. I'm Zach Guzman. Fed Chair Jerome Powell just finished testifying before Congress on America's economic outlook. We're going to get to the highlights of that testimony in just a moment, but first, I want to check the market action we're seeing right now. In the Dow is up by about 72 points. The S&P and the NASDAQ also in the green. You can see there the NASDAQ only up by about 0.1%. We'll see where things go throughout the hour. But also with me today is Yahoo Finance's Sabeel Marcellus, along with CampusReform.org Media Director Cabot Phillips. Cabot, good to see you again, man.
Great to be here.
Welcome back. Want to start with the highlights, though. As we mentioned, Fed Chair Jerome Powell discussed everything from global risks and consumer outlook to the central bank's rate cut policy. Let's watch.
We see the current stance of monetary policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook of moderate growth, a strong labor market, and inflation near our symmetric 2% objective. So that's a very data-dependent statement. We do think monetary policy is in a good place, but we're going to be watching very carefully incoming data, and if developments emerge that cause a material reassessment of the outlook, then we'll act appropriately.
All right, so joining us now for more insight on that is Yahoo Finance's Brian Cheung. Brian, a lot of what he said was kind of to be expected here in kind of a wait-and-see approach.
Yeah, I mean, nothing really moving markets here, and I think that was the expectation going into this particular speech. In fact, this isn't even the most exciting thing happening on Capitol Hill right now. He's being overshadowed by the impeachment hearings. But
how dare you, as the Fed reporter, how dare you?
Hey, look, I just got to call it like I see it. But I think from a monetary policy standpoint, the big takeaway was the language that he used. He said that current policy is, quote, likely to remain appropriate. So that seems to hint at a pausing bias for the time being. Again, the Fed has cut consecutively in 3 meetings. So now we're at a current target range of between 1.5%, 1.75%. And the tone of his appearance on Capitol Hill today was that they're probably going to remain on pause for right now. Now, the question is, how long are they going to remain on pause? Powell saying they're going to continue to watch the data, kind of using that buzzword again, saying that that will guide them on future moves. On the other hand of things, kind of interesting to hear him take a shot back at President Donald Trump. He made an appearance at the Economic Club yesterday, President Trump being, where he said that he would like negative interest rates, but said, you know, our Federal Reserve won't do it. Chairman Powell saying today, we won't do it. He said that it's something that they're not considering right now. For what it's worth, the Federal Reserve has interest rates well above where they are around the world in Japan and in Europe, where rates are negative for the time being.
You also think, I mean, I was reading into the description of the national debt as well, deficits, bringing that up. It was interesting to figure if that might be shots fired back at the president as well. But Jay Powell did address whether or not he thinks that the Fed is prepared for a recession. Take a listen to what he had to say on that.
We're looking hard at ways to make sure that we can use our tools even after rates go to zero. Ultimately, fiscal policy has been a key part of the countercyclical reaction as well, though.
That's kind of the issue here. I bring up the debt for that reason when we think about fiscal policy potentially being a tool at the country's disposal when we're thinking about what might happen if you enter recession. Kind of stress the fact that monetary policy is a tool that could be used here in the positioning that they have, but also on the debt side, you worry about what fiscal policy might be able to be used as well.
Yeah, well, here are the numbers. Post-war recessions, the Federal Reserve has usually had to lower interest rates by around 5%.
Yeah.
Coming out of the 2008 financial crisis, we raised interest rates by 9 times to a peak of around 2.5%. So that means that you had half of the ammunition to work with to fight whatever the next recession might be. Right now, we're already at half of the level that we got up to heading into this year. We're at, again, between 1.5, 1.75%. That's not nearly enough to battle that. So the question is, okay, you can try to repeat the same playbook by pursuing quantitative easing again, or you're going to need to ask for help from somewhere else. And I think that his commentary on Capitol Hill today, which is not new, he said this many times, which is that you guys are Congress. You have the ability to enact fiscal policies to provide some sort of macroeconomic stimulus to the economy that, is in danger maybe of, going into recession. We saw that yield curve inversion earlier this month, which tends to precede a recession within 18 months. People saying, look, we hope and we don't think that things are going to happen in 2020, but you still have these policymakers wondering, hey, we might have to have some insurance against this just in case, hence why the 3 insurance cuts that we got this year.
Yeah, and looking at this from a political perspective, you mentioned President Trump going after Powell earlier.
Yeah.
And I think a lot of this is simply because he's looking for a fall guy, if you will. He knows the economy is his baby. He said all along when the economy is going well, this is the Trump economy, you don't want to mess it up. And he's kind of preparing ahead of time, knowing that if it does slow down, I want to have someone that I can point to and say, this is the problem. To quote Michael Scott in The Office, I want all of the credit and none of the consequences. That's kind of what this is here. And in a way, Powell and the Fed are the perfect person to go after because they can't respond with a bunch of strong language. They're not going to come out and issue a bunch of tweets at Trump. Powell has to be reserved in the things he's saying in hearings publicly. And so Trump can go after him all he wants, like we saw last night. And he knows that the shots back at him are going to be tepid. They're going to have to be. And so this is kind of him setting the scene to where if things do start to slow down ahead of the economy, he can say, well, it wasn't my doing. The Trump economy was booming. This was the Fed's
Which is
fault.
the irony of it, too, because he put Jay Powell in this position.
Exactly. That's the other point.
He's the nominee.
Yeah, I think Powell, he's reserved, he's the Fed chair, but I think he's doing his best to kind of distinguish himself and say, you know what, I'm not going to take the blame here if the economy goes south. If there's further risk, we need fiscal stimulation. And he also pointed out that the debt, when it comes to federal debt, it's at record highs. We're talking about $1 trillion annually federal deficit under Trump's administration. He doesn't want to be responsible for that. He's saying, you know what, Washington's going to have to get their act together and they're going to have to really sustain the economy. We're doing our best as in terms of cutting rates as insurance against a recession. But if there actually is a recession, then Washington's going to have to do something.
And this is the most terrifying graphic I think we ever show here on the show, just the national debt clock continuing to tick higher and higher. Nonetheless, when we're talking about recession, Jay Powell did talk about potentially, as those risks continue to grow, what he thinks might be key to maintaining a strong economy. Here's what Jay Powell had to say about that.
The key to this, given the risks that we see are slowing global growth and particularly weaker manufacturing, and that affects U.S. manufacturing. So the key to keeping this going and to it continuing are that we keep job creation at a solid level, that households retain their confidence, that wages keep moving up. That seems to be the engine that's driving the U.S. economy forward at this time.
Here's the interesting thing for me, Brian, when we look at it, because President Trump was asked about this yesterday, and he kind of dodged the question about CapEx spending and businesses looking to invest right now. We've seen that decline twice over the last 2 quarters. Kind of shaky ground there. He dodged the questions, didn't really want to talk about it.
Totally dodged it.
But I mean, as we're talking about the Fed here, that's a very serious issue when we think about those numbers continuing to decline and what a backtrack in trade talks and in the way that those negotiations have gone, what might happen if the Fed sees that play out?
Yeah, well, the frequent talking point from the Federal Reserve is that, yes, manufacturing has come down a lot, but 70% of the economy is consumer-driven, and the consumer has appeared to look pretty okay. Yeah, there was a slight downtick, or actually a pretty significant downtick in retail sales in the last month, but that's just one reading. We're going to get another one, I think, the end of this week. So we're headed into the holiday shopping season. That might be kind of the tell-all for how strong the consumer really is right now. But as far as Fed policy making, they said that the consumer is really the driver of this economy right now. But the question is, what's the inflection point at which producers and manufacturers end up facing these pressures from the tariffs and from the trade war that President Trump has put into place, where they have to start raising prices, or the products and the R&D that they're releasing for, what have you, ends up becoming a ripple effect that actually inspires the consumer to maybe pull back on spending, keep some more money because they're worried about a recession coming. That might be a story that's actually intertwined with the consumer as opposed to what the Fed is saying right now, which is that, look, the consumer is completely insulated from all those factors. Well, it's like, at what point does it maybe spill over?
Yeah, I mean, at what point does investment for down the line become tomorrow's problem, become today's problem, especially when you think about maybe businesses not investing, leading to layoffs at some point when we talk about recession risks all of the time.
The L word.
Yeah, that's what we're talking about there. But it's not the only thing that we're talking about. Coming up, we're going to talk about a U.S. household debt reaching record levels with loans in delinquency ticking higher, why the $14 trillion problem is getting riskier and riskier next. Plus a programming note that tomorrow MLB Commissioner Rob Manfred will join the ticker at 2:30 p.m. Eastern Time. You won't want to miss that. Wi-Fi PM back right after this. All right, well, U.S. household debt is reaching a new record. Overall debt rising $92 billion in the third quarter, now nearing $14 trillion, according to the Federal Reserve Bank of New York. Brian, it's being led by an increase in mortgage debt. Of course, anytime we talk about record debt levels, that becomes a problem. We're going to get into that later when we talk about student loans. Right. But what do you make of this?
Well, no surprise. Interest rates are at historical lows, even though they're not at zero anymore like they were in the years following the financial crisis. But they're at, what, 1.5, 1.75 right now as far as where interbank lending goes, and that bleeds into the system still in the form of relatively low mortgage debt, mortgage rates. So that means that it's really cheap for people to get a mortgage, and it's also really cheap for people to refinance their mortgages. So that's why you're seeing a lot of the volume. What's interesting about this too specifically is that millennials, when you unpack by demographic, have actually been a big driver in that mortgage debt as well. So you talk about, yeah, well, millennials maybe are interested in renting, especially in these expensive cities, but maybe in cheaper parts of the country or more growing parts of the country, it's actually the case that millennials are being inspired to take a mortgage on a home or an apartment or a condo because it's been so cheap to get the financing for it.
But the worrying piece of this, too, though, is delinquency rates. And you think about that ticking higher as well when you look at people who are behind on their payments. Not exactly a positive development on that front either.
No, absolutely not. And when it comes to delinquency, it's actually student loan debt that's kind of leading the charge here. So we're facing a $1.5 trillion student loan debt crisis, and we're seeing a lot of people not being able to keep up with those student loan debts. So what do you think in terms of the risks this presents to the U.S. economy moving forward? Well, again, we keep talking about the health of the U.S. consumer,
is so great.
But the consumer is often spending on borrowed money.
Well, when you think about, especially with millennials, right? And the story here is that wages have also been going up in this post-crisis recovery. That's a good thing. But the problem is that home valuations and asset valuations for real estate have gone up way faster than wages. So if you think about those two levers, people are making more money, but the cost to actually rent or own any real estate is even higher. If people are taking out these mortgages, even if it's cheap, they're taking a mortgage out on what is supposed to be actually a higher principal cost of the underlying asset that they're buying to begin with, which means that you're crowding out the other, money that you could use to spend on food or on goods or clothing and what have you. So there's a serious crunch here that some might worry that if the continued pace of wage growth continues to go at the trajectory and getting overpaced by the growth in asset prices, that they're not going to have much money to spend on anything else in the future. And especially without any sort of social security net to help them once they get into later age, you do wonder if maybe there's a serious crunch in consumption in the future, which would have a huge macroeconomic impact.
Yeah, and we talk about millennial debt, and I think people forget how old millennials are getting now. It's no longer just college kids. We're talking about people well into their
older every year.
They're late
exactly.
30s, late
It's funny how that works. But I'm looking at debt now with Generation Z people. We've got 18-year-old kids now that are taking out $10,000, $20,000, $30,000 in loans as young 18-year-olds without the knowledge of what that's going to look like in the future. And I think if we're talking about reducing student loan debt moving forward, it's going to continue unless we find a way to incentivize universities to lower costs in the first place, which right now they just don't have, because universities know we can charge whatever we want. Students are going to take out these loans because they know, well, I have to get a college degree. There's no other option. That's what I've been told. And so they're going to take any student loan out. The government's going to continue to back high-risk loans that they would never give to other people in the private sector, but when it's government.
But that's also kind of the concern when we talk about subsidizing college or free college for everybody, and you hear about that on the campaign trail. Right. It's also an issue here because of the point you just raised, which is colleges know that this money is going to be coming to them, so they have no reason to cut costs. Yeah. And if the government's going to foot the bill, then why charge less? We
just saw the first instance, I believe it was University of Chicago, where the projection is by, I think it's 2030, it's going to be $100,000 annual tuition.
Jeez.
And it's the first college to reach that rate. And I think we're going to see more and more of that. And again, when students know, or when universities know, well, they're going to get the money, let's just throw a random number out there.
Yeah.
And for a lot of these students, I've talked to thousands of students in the last 3 years with Campus Forum. I've interviewed them personally.
Yeah.
Whenever I bring up student loan debt, it's kind of this thing that's way off in the future, this distant thing they say, well, we all have student loan debt. They don't know anything about it. They don't know anything about the fundamentals of taking out a loan. And I think that's a different element of it when you've got 18 to 22-year-old kids that are racking up this loan debt. And it's actually going to affect all of us when you look at the numbers of students that are going to start defaulting on these moving forward.
Yeah, 10.9%. It seems very high. 10.9% of the record $1.5 trillion number that you mentioned when we're talking about student loan debt. That's up from 10.8% delinquency in Q2, so ticking higher becoming a more serious problem.
And you know when reality really sets in for those college students that are taking those loans and don't really know how much it's going to take them to pay it every month is that first job, that first paycheck, and they go, whoa, way too small. My debt is way too high.
Yeah, your debt is way too high. You need to cut it, is basically.
And
Your
real
debt
quick,
is way too high.
You need to
cut. Yeah.
And real quick,
Well done.
another problem there is so many students, they take the first job they can out of college because they realize I need to start paying this off.
Yeah.
And a lot of them aren't starting businesses. They're not looking at potentially higher earning jobs because they say, well, I just got to get a paycheck in so I can start paying this off. And that's another area that I think is hindering the economy, where students are underperforming with their degree because they say, I'm just going to take the first job that comes my way.
Yeah, and shifting that, I mean, as we're talking about it, shifting that debt from individuals to the government, not necessarily
Absolutely
a fix there either.
Absolutely not.
All right, well, Brian Chung, thank you so much for breaking all that down. Appreciate you sticking around. Just ahead, Hong Kong protests intensifying as student demonstrators dig in against police. Why the turmoil there is starting to spill over to bottom lines with apparel maker Canada Goose getting slammed today. More on that right after this. Welcome back to Wi-Fi PM. We're checking the market action and still green across the board with the Dow up about 70 points right now, and the NASDAQ paring its gains a little bit there, only up by about 5 points. We'll see what happens throughout our hour. Well, clashes in Hong Kong are escalating as protesters attempted to block police from entering a university campus. The campus is now littered with school chairs, bins, and fences as protesters rush to form makeshift barricades to protect themselves. Schools have become a flashpoint in ongoing protests, with many students leading demonstrations across Hong Kong. Guys, this comes after an unarmed protester was recently shot by police. We've seen the violence there continue to increase over the last 24 weeks of demonstrations here. When we talk about it, though, politicians addressing the case here is interesting because not too much has been done on the Hong Kong front trying to support here. Of course, this comes as we continue to negotiate a trade deal with China. That adds a layer of complexity here. But clearly, this issue not going away.
Yeah, and the first thing that comes to mind when I look at this is I've covered a lot of protests stateside, but they're all on college campuses. And the number one issue that students have is just saying, you know, we're protesting fascism, we're protesting an authoritarian government. And when I see these images, I'm reminded, I want to tell these students, this is what it looks like when you're protesting a real authoritarian regime. And regardless of what your thoughts are in America, I think it's a good perspective to have. And I spoke yesterday with a survivor of Tiananmen Square, who now is a Hong Kong freedom advocate.
Wow.
And it was interesting how she was saying that one of the big things she's looking at is people in Hong Kong losing faith, not just in Chinese authorities, obviously, but also in authorities within Hong Kong. There's a poll where at the beginning of the protests in the summer, only 5% of people there said they had little to no faith in the Hong Kong police force. Today, it's at 53% of people there. And so they're losing faith not just in the Chinese, but also in the institutions within Hong Kong. Obviously, people losing faith very quickly in Carrie Lam, kind of handling it, even though she was handpicked by the Chinese. It's very clear that kind of turned on the protesters in a way we hadn't seen earlier. And I wonder if that happens more as the violence gets worse, which it feels like it's going to start to get worse here.
Yeah.
When it comes to the protests in Hong Kong, so they're not front page news every day in the U.S., but every time we check back in, it seems like the situation is becoming more and more untenable. And the big question for U.S. legislators is at what point will China actually step in, and what will that response actually look like? But when it comes to the economy, so we're seeing plenty of companies being impacted by these protests, because who wants to go on vacation in Hong Kong? So you've got retail stores having to close because of the protests, and also it's not attracting a lot of tourism. And Hong Kong is one of those big cities where a lot of people would have liked to, go do some tourism, go and enjoy some of the shops, and they're not able to at this point. But in terms of the protests, it looks like Hong Kong police is trying to calm the protests, but they're trying not to be too active in it or not too violent. But at the same time, what we've seen just this past week, we've seen one protester was set on fire. We've seen another Hong Kong police officer was actually dismissed because he was using his motorcycle and was trying to roll over protesters. So the situation is really terrible at this point.
Yeah, well, you mentioned the business impact too, and we're continuing to see that play out when we talk about businesses that are affected by all this. The latest one today, we've seen that play out right now. Canada Goose plunging today after the brand warned during its earnings call that ongoing Hong Kong protests are impacting the company's performance. The luxury coat maker's quarterly results were strong, though. Revenue coming in at 294 million Canadian dollars on earnings of 55 Canadian cents a share. But guys, investors clearly concerned about the situation in Hong Kong. Here they have 2 stores in Hong Kong, and on the call they mentioned that the protests were weighing on the results in Hong Kong. I mean, it's a luxury coat maker, if you're not familiar with Canada Goose, but I mean, just 2 stores and we're seeing the impact there.
Yeah, and if there was something they could point to and say, well, there's a sign that it's going to end, so they could assure investors, well, don't worry, it's coming to an end, but there simply isn't anything right now they can point to, and so I think it's very clear why the investors are getting worried. And it has been interesting, though, looking at the market more broadly. In Hong Kong, the markets there have been relatively resilient to all of this. We see little spikes going on when there is increased violence, but for the most part, I don't think there's been as much of a hit as one would expect, given just how broad the protests have become.
That's a good point.
I mean, when it looks to when we were talking about Canada Goose's earnings, so they crushed expectations for the quarter, and investors were really happy. So we saw the stock go up 10%. But once the CEO got onto the earnings call and said, you know what, Hong Kong warning, this is definitely going to hurt our business, investors said, well, you know what, we're reading the headlines, we're seeing the video. It doesn't seem like it's going to end anytime soon. There's still a crackdown with police, and we've seen the stock go down over 10% at this point right now. So in terms of Canada Goose, they're not the only company that's being impacted by this. Also Tiffany's, other luxury brands have been impacted by these Hong Kong protests, because really when you're looking at people being shoved, pushed around with police, throwing bricks, assimilating weapons, then of course, who wants to shop for, little blue Tiffany box?
Or coats or anything else. I mean, not just luxury, but everything across the board too. But I mean, to your guys' collective point, 24 weeks of this going on at the same time consecutively, that doesn't necessarily calm investors in thinking that this is any closer to getting resolved. And if you have no end in sight when it comes to negative impact to your shares, I mean, that is expected that it would weigh.
But the one thing Canada Goose has going for it is its Asia sales. Those doubled.
China did still hold up as well, too. You're right.
Exactly. So as long as it's not Hong Kong, but other parts of Asia, then they could still be good.
Interesting also to see how the Hong Kong protests haven't necessarily followed what we've seen in other countries with protest cycles. A lot of times there's this initial flashpoint, people get excited, and as they go on longer, people start to die out, and then you have only the radicals left. If anything, the number of people protesting has grown. I think there's kind of a collective unity there that we haven't seen with other protests, and I think that's one reason this has happened for so long, and why it's just not going away anytime soon.
And international support to a certain extent.
Yeah,
I mean,
absolutely.
We talk about the NBA blowback. That was because the general manager tweeted about support for Hong Kong protesters. So, I mean, there has been at least that, although we haven't seen too much of it actually on the ground when we think about international support or other government support out there as well. Got to take a quick break, though. We're back with the market's biggest movers on Wi-Fi PM right after this. Markets are cooling off here in afternoon trading. Let's check in with Scott Gamm on the floor of the New York Stock Exchange. He's got his eye on the Dow. Scott?
That's right, Zach. The Dow is only up 60 points right now, but that's enough for a record high right now, especially coming off of yesterday's session when the Dow closed exactly unchanged. That hasn't happened since April 24th of 2014. And guess what the Dow was trading at back then? 16,500. We are now approaching 28,000 in the Dow. That's a gain of about 68% over those 5.5 years. But enough Dow history. Back to today's action, we are seeing significant strength in Disney shares, which are powering the Dow right now. Disney is an important component of the Dow. The stock is up over 4% after the company announced that on its first day, Disney Plus has already garnered more than 10 million subscribers. We know Disney Plus launched yesterday. Now, analysts were expecting Disney Plus to garner 10 to 18 million subscribers in the first year. So Disney clearly blowing past those expectations. Now, when you look at Disney's stock over the past 6 months, remember the stock dipped mid-summer after Disney posted disappointing earnings. Well, the stock is now back near where it was trading prior to that mid-summer dismal earnings report, a nod to how excited investors are about Disney's streaming efforts. Zach.
All right, Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But next on Wi-Fi PM, a focus on big tech with Google entering the fintech space, looking to offer checking accounts, and Apple looking to lock up a big-name exec for its new streaming service. We're back with that in 60 seconds. Welcome back to Wi-Fi PM. I'm Zach Guzman, and we're checking the market action right now here. And it's green across the board. You can see the Dow up 62 points, as Scott Gamm highlighted just a bit ago. Record highs again there. We'll keep our eyes glued to the market action throughout the hour. But joining me today is Yahoo Finance's Sabeel Marcellus, along with Campus Reform Editor-in-Chief Cabot Phillips, along for the ride as well. Guys, happy Wednesday. It's a big market Wednesday.
Happy
today.
hump day, yeah.
Always good to
Market's
see.
happy.
Always good to see record highs on a happy hump day. But we're also watching big tech news today. From your tablet to your wallet, Alphabet is getting into banking. The Google parent company will reportedly offer checking accounts to consumers next year. The Wall Street Journal reporting that the project's codename is Cash, and the tech giant will partner with Citigroup and a credit union at Stanford University. CNBC notes the accounts will be branded with the names of the banks, not Google's. Guys, Facebook and Apple have faced obstacles in the banking space. It's kind of tricky because they don't want to fully move into the space by themselves because that is a regulatory nightmare, as we've highlighted.
Mark Zuckerberg.
Yeah, as we've highlighted on the show. Granted, Facebook's move into crypto, a lot of question marks around that. This seemingly a very safer play, teaming up with Citigroup.
Yeah, absolutely. But the question for consumers, it's like, how much power do these big tech companies really have? So they already have all our data, and we couldn't really opt out of that because that's really complicated. So they, all our preferences online. They know more about us than our friends. And now they also want to know exactly how much money we have in our bank accounts through these new partnerships with big banks. So it's concerning from a consumer standpoint of how much power we're actually ceding to like a Google or a Facebook or an Apple as they roll out these financial services.
Yeah, we saw their Project Nightingale yesterday, kind of some news breaking there in the Journal of how they're collecting health data, kind of storing it in the cloud, people getting concerns there. And I do think it's creating this steady drumbeat of, like you said, of people saying, well, I don't know about this big tech stuff. And it's not a partisan issue either. It's interesting how both sides have a dislike of big tech, kind of for different reasons. The left is saying because they're too big, we need to break up monopolies, they're too wealthy. Conservatives saying, well, they're biased and, it's infringement on privacy. But there is a, universal agreement of big tech bad. And so you mentioned the regulatory nightmare it would be. I think we could see that in the future. I think the thing Google has going for it, though, is just the brand recognition of people. They do trust Google if
well, you don't have if your search, it's Google.
If you've become a verb,
what else are you going
to Google something. And so I do think there's kind of universal trust there that may not be there as other places roll out their own cards. But yeah, certainly a further step towards global domination from Google and some other big techs.
And you know who's caught between a rock and a hard place are actual big banks, financial firms, because they're like, okay, should I work with an Apple? Should I work with a Google? Or should I just stand on my own because they're actually threatening our business?
Yeah.
So just one partnership I want to mention is Apple and Goldman Sachs. So they launched the Apple credit card this year, but you're seeing a lot of friction in that relationship. Goldman Sachs was really upset with Apple because in their ads, they're saying, oh, this was designed by Apple, not a bank. It's like, hello? What about Goldman Sachs? They were a part of this. And also when it comes to federal investigations and also pressure from the New York Department of Financial Services, it's all going on Goldman Sachs when it comes to the algorithm that determines how much credit someone can actually obtain with the Apple card. So there you see Apple kind of being mum and Goldman Sachs kind of taking the blame when it comes to the financial services because they're actually a bank.
Yeah, and that's a lot. I mean, when we're talking about other services that are out there streaming a totally different game than we're talking about when we focus on banking. But regarding trust, I mean, it's interesting because McKinsey did a survey looking at which big tech firms they actually trust more. Amazon, the leader in that regard. Facebook, not.
Facebook was the least trusted.
Perhaps unsurprisingly there. But McKinsey's also been highlighting the kind of shift in talent hiring, too, when we talk about tech. I mean, I think it's very fair to say that tech has become the big punching bag. It used to be Wall Street and banking, but it's just lost the cachet. Not as fun to beat up on Wall Street anymore if you got tech out there and everyone's using their platforms and services, but very interesting to see the shift here as both worlds start to blend. But focusing on streaming rather than banking, Apple TV Plus may soon get a talent boost of its own. Former HBO CEO Richard Plepler is reportedly in talks to sign an exclusive production deal with the streaming service, according to multiple reports. Plepler left HBO in February after AT&T took control, and he was with the company for nearly 30 years. A lot of people made a lot of his departure. During his time, the network became known for its slate of high-quality content. You might have heard of some of the names, Game of Thrones guys, to The Wire, to Veep. HBO, of course, is launching its own streaming service, HBO Max, in the spring. But, I mean, big firepower. When we talk about the streaming wars, getting a guy like Plepler to come over and kind of help things, a lot of the question marks in the Apple TV Plus front have been about content and whether or not the content that's been coming out, we've seen the reviews, not phenomenal when we look at the shows out there. So perhaps this could boost that.
Slim on content as well. It's not just that it hasn't been getting great reviews, it's that there hasn't been a ton to choose from. And I think when you look at the HBOs and the Apple streaming devices and services, there isn't necessarily a brand recognition yet so obviously we know what they provide, but I think a lot of consumers are saying, do we really trust yet that especially for Apple, that their original produced content is going to be good?
Yep.
You have that with Disney, with so many people knowing, well, we know what Disney brings to the table. We know that if they're producing original content, it's going to be good. Netflix has already overcome that hurdle. I think clearly Apple trying to get into that space. And also interesting, there's room for multiple big dogs here. The average person said they would be up to having, I think the number is 3.8 different streaming services, what the average person has right now in America, or what they'd be willing to have. So definitely room for a lot of competition there. The real competition, though, is going to come in putting out high-quality content they're producing themselves.
Yeah, absolutely. So quick comeback for Richard Plepler. He spent 30 years at HBO. AT&T gobbles up, Warner Media and takes over. So then he leaves in February, and it's like, well, you know what? I don't need you. I've got Apple TV Plus and all the resources that Apple has. Obviously, Apple has a lot to learn when it comes to dealing with the entertainment industry, the morning show, the critics, the whole circus of Hollywood. And, they've really struggled because a lot of the reviews for morning show were all terrible. As you're launching Apple TV Plus, I mean, how is that supposed to help your service? So with Richard Plepler, who obviously has all the great relationships with Hollywood, that'll definitely help Apple moving forward with their streaming service. And also, he's got a great eye. You know, it was under his watch that HBO got Game of Thrones. And you know that Apple TV Plus, that's definitely what they're looking for, is that kind of a franchise. So he's definitely the right person for that team.
And you think about, I mean,
and they've also got Steven Spielberg, Oprah. So they've got a lot of people, but it's just a question of like getting all that content out there.
It's a matter of getting it out there and getting it out there in the right way. But also you think about the competition here. Disney just shattering, I think, everyone's growth expectations here. The company is saying that it has more than 10 million Disney Plus subscribers. To put that in perspective, analysts had projected the streaming service would achieve upwards of 8 million subscribers by the end of the year, and it's already hitting that after one day. The stock jumping on that news, of course, guys. We can see Disney shares up more than 5% now, continues to rise on that update. I mean, it just goes to show how much I think they sandbagged the expectations of 60 to 90 million subscribers by 2024, and you got 10 million after day one.
Yeah, so I mean, I'm always kind of skeptical because when it comes to these companies, they know to lower expectations and then exceed expectations and then go, oh, wow, everyone's interested in our service. I think most analysts thought that Disney Plus was going to be a big success. They had some technical issues, which I was surprised about because this was the big marquee product for Disney. Right, they spun into a positive.
Demand so high, so everyone can't keep up.
Of course. I mean, they got great marketing machine. It was hard to miss that Disney Plus was being launched on taxi cabs everywhere. You know, the message was there. But in terms of Bob Iger, I mean, it's a huge success. He invested a lot into getting Disney Plus launched, and they've got so many franchises from all the, the fairy tales that all kids love. Plus, they've got Marvel, and they've got, other live action movies just for the platform. So it would have been hard, I think, for Disney Plus to not succeed at this point.
And the important thing to note here, too, is that, yes, it's 10 million, a lot to applaud there in terms of the size of the number, but also some of those being free trial subscriptions as well. So a question of how much might drop off as they have to pay a week later.
Yeah, and I saw some people, there's a little controversy, some people saying I'm going to wait to start streaming until all the episodes of the new Star Wars show are out, get my 1 month subscription, binge watch all of them, and then cancel my subscription. Some people looking to game the system. I think it really is hard, though, to understate just how strong the Disney brand is across different generations, too. You have got older generations that remember taking their kids to Disney movies and also grew up now seeing the Star Wars brand and others, and younger generations who sat around every Saturday popping the same Disney VHS in, and now even younger generations that are also looking up to that content and seeing new ones. And so I think it appeals to each generation in a different way, and it's just hard to understate how helpful that is. Well, be interesting also to see if they start to release more numbers on specific content, the numbers they're getting there. Netflix waited for a while before they started to do that. What will Disney do? How long will they wait? We see the number of people streaming and the memberships, but what are the actual viewership numbers? That will be interesting to see.
And also, I mean, how that plays back into the other revenue lines that Disney operates, too. If you have all of this excitement and buzz around the streaming service, what does that do for parks and everything else that they operate there as people continually get excited about the Disney world of content? And I think that that's just kind of starting things. Obviously, you're seeing investors cheer that today with the stock up more than 5%.
Netflix investors are probably not cheering this.
Netflix investors getting a little bit more nervous by the day, unless you believe that there is a big expanding pie for everyone to take a nibble on. Coming up, fresh off expanding to China ahead of schedule, Tesla looks to add Berlin to its list of production hubs. Why that would be a welcome boost when Wi-Fi PM returns. Welcome back to Wi-Fi PM. Tesla CEO Elon Musk announced another factory will be built outside of the United States. This time, it's in Germany. The electric automaker aims to have the plant running on the outskirts of Berlin by 2021, according to multiple reports. Musk says the factory will build batteries, powertrains, and cars, starting with the Model Y. Guys, of course, we know that he's been expanding into China, the Gigafactory there, moving full steam ahead of schedule. And now Germany joining the list of the international push.
Yeah, Elon Musk continues to prove that it's not a smart move to bet against him. So he's definitely, beating expectations here, actually building a plant in the outskirts of Berlin. But the question is, how will Elon Musk fare when you see traditional car companies actually move into the electric car space?
Yeah.
Will he still be able to continue to be the leader when it comes to electric vehicles? Because, Volkswagen, also in Germany, they, over the next 4 years, are rolling out electric vehicles. So it'll be interesting to see that competition happening in Germany and how that rolls out worldwide.
Yeah, 2 points on this that I noticed. One, the fact that German manufacturing numbers taking a hit earlier in the year. Hopefully this could start to bring back a little more confidence there in the manufacturing aspect for Germany. And two, the international, political effect this is going to have. Tesla came out and said a big part of this, they wanted to put it in the UK, but because of uncertainty with Brexit, they didn't want to do that. And I think this could actually be a thing that helps pro-Brexit people in the UK. They're saying, look, we haven't gotten a deal done, and now we're missing out on huge opportunities. Now, who knows if they were actually going to go to Britain and put that there, or if this was just them, trying to, kick them while they're down. But I do think this could be a thing that has political implications in the UK as the Brexit talks continue. Them saying we're missing out if we don't get a deal done. We're going to have even more jobs that aren't coming here.
Yeah.
I wish that was enough to actually resolve the Brexit conflict, but I have a feeling that's not going to be enough.
The Brexit problem could use all the help it could get to find a solution. But it is interesting to know that Germany is also one of those countries that has the strongest incentives when it comes to electric vehicles. We obviously know that Tesla's it's been impacted by the fact that the U.S. subsidy getting cut here when we talk about how big that company's become. As that subsidy here in the U.S. starts to wheel off, you think about where else it could go. Germany obviously making sense when it becomes cheaper for people to buy cars there.
And also Germany is the engine of manufacturing in Europe. So there are a lot of car makers already there, like Daimler and Volkswagen.
Sure.
So it makes sense that Elon Musk would actually make a move there.
I like the engine
They offer
pun.
a lot to the industry.
The engine pun not lost on me there. Before we go to break, I want to take a look at the Dow leaders so far today. Right now we're seeing Disney, Nike, P&G, Coca-Cola, and Walmart lead to the upside. On the flip side, laggards today, some names to show you in the red there. Dow, Pfizer, IBM, Walgreens, and Intel rounding out the list. Well, after the break, why a shortage of nurses in the U.S. is weighing heavily on the healthcare industry and pushing current workers to the brink right after this. Welcome back to Wi-Fi PM. We still have the major indices in the green right now. The Dow up by about 82 points, and right now the S&P being led by two sectors to highlight: real estate and utilities, the big gainers on the day, both up by more than 1%. Well, a new survey out from AMN Healthcare has found an alarming rate of burnout among nurses, with almost a quarter working 2 nursing jobs at a time. Yahoo Finance's Adriana Belmonte joins us now with the details behind this and some shocking findings here when you think about the stress that America's nurses are under.
Yeah, so I'm going to read a few statistics here that I thought really jumped out from the survey. So 22% of nurses hold more than one job as a nurse. 37% of those working the second job say that doing so negatively affects their quality of life. There's also 27% who have witnessed workplace violence. So it's kind of, just showing how, like, while they're in those settings, the burden that's being placed on them. And then there's also 52% of nurses who are saying that the nursing shortage has gotten worse over the last 5 years. So survey kind of covered a broad base of different conditions going on, but it just shows that, there is burnout happening.
I know you talk to people in the sector as well, though. It's not just the fact that there's a shortage, but also kind of, the fact that there are changing descriptions of the job, changing responsibilities of the job as well. So all of that kind of tying in here.
Yeah, so I talked to a nurse from National Nurses United. It's one of the largest nursing unions in the country, and she said she was very strong this emphasis that it's not a shortage of nurses, it's a shortage of nurses willing to work in the current conditions. So she said that, they're experiencing or displaying criteria for PTSD because, of the violence that they're witnessing or experiencing. There's a nurse suicide rates, are a little bit more than the average amount. They're, working the second jobs, and also automation is playing a role in this too.
Yeah. So we've got nurses under a lot of pressure, because if they're working with diminishing resources, they have to be the caretaker, but who takes care of the nurses? So seeing the results of this study, are there any resources that are being offered to nurses to deal with these kinds of situations?
Not at this time, it seems like. So a big issue here with what's going on, what they were saying with the current industry, is that there's a shift towards technology. And so some people are saying, well, we just have to get better at, adapting the technology to work with the nurses. But some of the nurses say, it's not enough. It takes away from the quality of care that they can present to their patients. And by doing this, it restructures the whole role, and they kind of feel like that profit is being valued over quality of care.
Yeah.
And so obviously plenty of problems pointed out here. Is there a solution that they're calling for? Or, is there a unified voice of here's what nurses want, here's what we think would fix the problem?
No, that's the issue here. I don't think anybody knows what the solution is, at least at this time. It just seems to, right now, they're just kind of calling out the fact that, hey, this industry is trying to shift more towards technology, that, they can't figure out how to cut labor expenses in the healthcare industry without affecting nurses and how they enjoy their jobs. So I think it's about finding that balance.
I mean, when we talk about all this too, though, healthcare seems to be one of those sectors that is showing job growth. I mean, that's kind of just the overall demand on the healthcare system, very large in general, but I guess nurses caught up in that as well, as more people need care with an aging population base.
Yeah, so there's also the retiring as well. So one of the questions in the survey was about, retiring, because baby boomers are aging out of the workforce, and so this is going to create even more of that shortage, however you want to define that. But yeah, there's since 2012, an average of 60,000 nurses have been retiring each year. And so, these nurses are saying, well, we've been prepared for this for a while, but there's also going to be the point where they have to start taking care of those people as part of society.
Yeah, so maybe not, even though there are job opportunities there, maybe not exactly the most satisfying job, at least as it once was, when you talk to a lot of nurses in the industry. But Adriana Belmonte, thank you so much for bringing us that survey. Well, shifting away from the healthcare industry to the art world, one hippo is making a big splash into the art world. A 300-pound golden hippopotamus, not to be confused with the hippopotamus, shaped bathtub sold at Christie's in New York yesterday for a whopping $4.3 million. So just a little bit above the bathtub that you use, Cabot. Yeah. The bathtub's previous owner paid only $168,000 in a 2006 Sotheby's auction. Look at that bathtub there. Meaning they took home an almost 2,500% return on the tub, guys. I mean, that is That's a hippo-sized profit right there.
I'm not going to dignify that with a laugh. They said this sold for almost 3 times the expectation too when it went up.
Which, how
for
do you know
auction.
what the expectation is going to be? I mean, is there a big data pool set to pull from when we talk about
Well,
hippo
the
pools?
previous
Hippo
owner
tubs?
paid $168,000 for this. This was over a decade ago. And when you look at the hippo, I mean, if you got the money, why not pay $4.3 million to get inside a hippo to take your bath? It also has a vanity and a sink so you can wash your hands after that bath.
Dual purpose.
So, but yeah.
Triple purpose.
I actually do appreciate this art. Some modern art I look at and I say, this is absolutely insane.
Utility here.
This I see, I go, that's pretty cool. I actually have a theory. You could go to a modern art museum and you could hang up just fake finger painting art from a 3-year-old and people would look at it and say, this is art.
This is something.
But this I look at and go, I can see the skill it required. I mean, the pricing, I'm not as
But that's a secret. That's left to the art experts to tell us the value of the painting that's on
But
the
that's
wall.
what I'm saying. I mean, at the end of the day, this is a business story because we're talking about an asset that appreciated in value by 200 or 2,500%. Name something else that can boast that.
That's Christie's stock and trade.
I'm just saying is that it's very impressive, and I'm on board with you. I think that this is art. I think it serves a purpose. There's a lot to be happy about.
It's not just art. I think you're actually supposed to take a bath in it.
Yeah.
Right?
I love that arts can serve a
Like
purpose.
a nice bubble bath inside the hippo.
Who hasn't dreamt of sitting in a golden hippo and...
I'm just saying, you dream too small when you say you want a gold toilet. There's a gold hippo bathtub out there waiting for you. That is the American dream, ladies and gentlemen. Cabot Phillips and Sabine Marcellus, thank you so much for taking the time to join us here on Wi-Fi PM. A reminder to stay tuned to Yahoo Finance. We're headed to the New York Stock Exchange in 60 seconds time. Let's check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
All right, we've got Peter Tuchman here to break down the Dow's record once again. Peter, the Dow extending its gains just in the past half hour. What do you attribute that to?
You know, and it's kind of curious. I just think the market, you mentioned that you felt that the market has run up maybe too fast and too quickly, too fast and too high. I kind of think this march from 27,000 to here, and even from 26.2, and we saw that bit of a sell-off recently, it's been steady and strong. I think there were some days that felt like a short cover. I think we got a little FOMO here, fear of missing out. There are people who have been in the sidelines anticipating whether what's happening in Washington today or ongoing. You know what? Let's just take it back. I think the China trade story has implications that are wide, and I think we're seeing that. I think the market engages it sometimes more than not. But at the end of the day, we still have no clarity there, and the market keeps forging its way higher. So for people way smarter than me, it seems that they obviously love this valuation. They're still buying it here. I think there are people who have been in the sidelines waiting for the fracture of the market, having rallied so high at this point, and it's just not happening. We're coming into the end of the year. Yeah. This is Christmas season. People are buying this. I mean, look at that steady move. We came in this morning with fear of what's, some China story, some Fed story, some Trump story, and the market has completely reversed that.
You mentioned trade. The pattern I'm noticing is that you don't necessarily need a good trade headline for the market to rise. Just the lack of a bad trade headline might be good enough.
Correct. But I think there are days, look, this has been going on for 18 plus months. Deal, no deal, no deal. And I've said it before, I think it's an irresponsible way to disseminate information. We should wait till we have something to lock our teeth into. At the end of the day, the market keeps going, whoa,
And we've just been selling off, bizarrely.
This must be news related.
We don't know what
Obviously
that
some
is.
Kind of a headline.
But the S&P just turned negative, the Dow pairing almost all of its gains.
Do we know it?
Live on the air. We're trying to figure this out.
Probably a tariff story. Or
but
God, you know what? You never, as I always say, if you're a trader, be nimble. If you're an investor, don't look, because we're a tweet away from a 1,000-point move.
Yeah, you really can't take your eye off this market. But Zach, we'll send it back to you in the meantime.
Yeah, just truth of the times. Tariffs always the go-to. A very telling move there. Coming up, we'll explain why Canada Goose is plunging despite an earnings beat on strong jacket sales. The ticker starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. Checking market action, we are seeing Disney leading the Dow right now, the only one of the three majors in positive territory. The Dow is up 43 points, the S&P 500 pretty flat right now as the Nasdaq is down 16 points. Let's start with a big story today. Federal Reserve Chair Jerome Powell testifying before the Joint Economic Committee earlier on the economic outlook. Powell saying the current Fed policies are, quote, likely to remain appropriate unless conditions change.
We see the current stance of monetary policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook of moderate growth, a strong labor market, and inflation near our symmetric 2% objective. So that's a very data-dependent statement. We do think monetary policy is in a good place, but we're going to be watching very carefully incoming data, and if developments emerge that cause a material reassessment of the outlook, then we'll act appropriately.
Joining us now is Yahoo Finance's Brian Chung, our resident Fed watcher. Brian, a lot of what we heard today from the Fed chair was kind of what we heard in his press conference prior. Was there anything today that led you to maybe Powell revealed a bit more about his thinking on the policy right now, or his economic outlook?
Not really, and I think the Federal Reserve would like to keep it that way. So the Fed has cut 3 times consecutively this year, so the current target Fed funds rate is between 1.5 and 1.75%. But Powell, when he used that language saying that, he feels that it's likely to remain appropriate, that's basically a translation that they're on pause for right now. But the looming question that markets would like answered is, how long will they be on pause? It's pretty much a done deal, at least as far as Fed funds futures markets are concerned, that the last meeting of this year, which is December 11, will not have any sort of rate change, so they'll keep it at the current level. But questions about in 2020, what's the outlook going to be? And I think the dot plot projections that we'll get in that December 11 meeting will be very telling for where the committee stands on what the projections will be for 2020. There has been definitely some divide. I've been tuning into a lot of Fed speak. Actually, almost all the Fed speakers have spoken in the last week or so, and it's kind of weird to see that the count. There are at least 4 members that have said they actually did not support the interest rate cut in October. So how much of a divide is that going to be going into this next meeting about whether or not they'll telegraph perhaps a change, maybe even to a hike in 2020? Now, for what it's worth, the Federal Reserve is not really at risk right now, I think, of raising rates. Chairman Powell made that very clear in his press conference on October 30 when he said the Federal Reserve is just not thinking about a rate hike right now. So there was no real downside to this committee hearing today. It's not like he was going to come out all of a sudden and say, you know, there's been some huge macro event in the past few days that has made me rethink, and actually a hike's back on the table. Nothing has really happened, but he said we're going to watch the data as it comes in and guide our future decisions based on that.
You know, this of course comes a day after we heard from President Trump at the Economic Club here in New York. He talked about how the markets would be 25% higher if the Fed had been more accommodative. You know, he's also talked about negative rates. When he looks around globally, he said, look, you know, sort of the same lines he's repeated in the past about places like Europe and Japan that he thinks are benefiting much more. You know, what stands between where we are right now with the Fed and the negative rates, and what should we be looking for? Because I don't think any analyst will come out and say, yeah, sure, we're going to see negative rates in the immediate future here in the U.S.
Yeah, it takes a lot to get from here to there. It would have to be a very significant downturn, but the Federal Reserve says they're not thinking about it right now. But as is always the case, as we saw in 2008, there's no telling about what types of unprecedented tools the Federal Reserve might have to rely on in the next crisis, because by nature they are unprecedented. I don't think anyone in 2005, 2006 would have said that quantitative easing, as we saw in QE1, and QE3, was going to happen as it did during those periods of time. So when we hear the Federal Reserve say we're not thinking about negative interest rate policy, I don't think it's a fair interpretation to say it'll never happen in the United States, but I think what it tells us is that they are not preferring that as a tool to combat the next financial crisis or recession or what have you. So what they've said that they would like to refer to is maybe bringing back quantitative easing again if they do hit the zero bound again. Maybe yield curve control is something that's been discussed. Lael Brainerd, the governor there, has said maybe there's the idea that we can try to target longer-term interest rates as opposed to short-term interest rates by buying longer-term treasuries. That's just a different form of QE. But if those tools don't work, there might be the possibility that the Federal Reserve would dip into negative territory if that were to be the case. But I think the Federal Reserve understands that the macroeconomic policies in place, given the current thinking, aren't necessarily good to go out there and say actually negative interest rates are on the table, because you don't want markets to assume that zero is no longer the lower bound. You do want to try to stay above that, which is why the Fed might be saying, look, we are not interested in looking at negative interest rates right now.
There is also an argument to be made that because the Fed is at least on pause for now, well, there needs to be more done on the fiscal side of things. Jay Powell today did kind of talk about the concerns coming from that, especially looking at the federal budget deficit and that growing number we've been watching. Take a listen.
You don't need to balance the budget or pay down the debt or anything like that. You just need to get the economy growing faster than the debt. And that should be I think, the goal.
Brian, you pointed out earlier that this is a concern that he has raised before. You know, what are you hearing in terms of your sources about sort of how the Fed is looking at the fiscal side of things now that they have had multiple cuts this year?
Yeah, well, the Federal Reserve has kind of said two things, kind of talking on both sides of the mouth. On one hand, saying that the debt is outpacing economic growth in the United States, which is a problem because at some point, maybe there might be the concern that we'll default on our debt and we won't be able to repay our bills. But on the other hand, you also have Jay Powell and members of the Fed saying we need more fiscal stimulus because with interest rates this low, we cannot provide firepower to the economy anymore. So we need better labor productivity, and maybe there are some sort of fiscal policies that can stimulate that. Well, that comes at a cost. So there's kind of a juggling act that he's basically telling Congress. But again, the Federal Reserve has made it clear, and Jay Powell has made it clear, he's not in the business of telling Congress what to do. So he's saying labor productivity and an aging workforce are a problem. It's up to you to figure that out.
Okay, we'll be watching. Thanks so much for that, Brian. Well, coming up, shares of Canada Goose selling off in the wake of its latest earnings report. We'll tell you where the company sees some of the biggest headwinds. That's next. Welcome back. Let's get to our big three tickers. Canada Goose getting plucked apart after a warning on its earnings call. Luckin Coffee is soaring as it prepares to overtake Starbucks as China's biggest coffee company. And nothing but frowns for Smile Direct Club investors in the wake of its first earnings report as a public company. But first, to Canada Goose. Shares tumbling despite reporting quarterly earnings that beat expectations. Revenue was boosted by strong parka and jacket sales. Brian Chung back with me. First the Fed, now we're talking about Canada Goose. Why are we seeing the shares plunging?
Well, it appears to be the commentary from management about the headwinds that they're seeing in Hong Kong. Obviously, the protests being very disruptive in that region where they do have a number of stores. This is a very direct-to-consumer based model that Canada Goose has built its entire business around. And what we saw is that even though they beat on the top and bottom lines, you can see the numbers right there, 294 million Canadian dollars in revenue on the top line, and on the bottom line, 55 cents Canadian dollars, again, beating estimates of 46 cents. So they cleared both of those numbers for this quarter, but I think the concerns, again, about Hong Kong really kind of overshadow what the growth trajectory is for this company going forward. Keep in mind that the Asia business is 16% of their sales as of this quarter. That is a step up from 12% of their sales the same quarter last year. So year over year, they've been trying to grow their share of the Asia business, and Hong Kong as the entry point in the Pearl River Delta, obviously a huge focus point for them. There's no telling about, and doesn't seem like any of the violence or uproar in Hong Kong is abating anytime soon. So I think that investors might be looking at this as a more longer term problem that really is a roadblock for one of their high priority, high growth, high focus markets.
Yeah, I mean, if you think about where Canada Goose is, those stores in Hong Kong, right sort of in the center of the city and where the protests are, it's been a bit of a bumpy ride though, right, for Canada Goose as they try to expand, increase their footprint in Asia. Remember, it was a year ago where they launched that big flagship store in Beijing, and there were protests because the Huawei CFO had been arrested in Canada. So they've had to kind of navigate the political waters in China and Hong Kong. What's the outlook on that front?
They have, and management was very careful not to make specific points or take a stance on these issues. Danny Reese, who's the CEO of the company, said, quote, the results are showing, this is referring to Asia, are showing dividends, notwithstanding obviously what is going on in Hong Kong, and just kind of ended his comments at that point. I think that for businesses, what we've seen from the episodes like with Coach, like with the NBA, is that taking a stance on these types of things have appeared to be a bad business choice, independent of whether or not it should be their responsibility to take a stance on those issues is a whole nother debate. But look, Canada Goose is a company that a lot of people are paying very close attention to because it's such a high growth stock. Keep in mind that, yes, the stock is down 13%, but the stock got clobbered earlier in the year around May when they had an earnings report and actually changed their guidance to a point that was not as bullish as the street had expected, so they took it down. This is a pretty amazing business. They have pretty impressive margins, gross margin of 54.6% during this quarter. I mean, that's an impressive amount of margin that they have on these products, which means that they, I mean, for a $1,000 jacket, they make pretty good money on each unit. But I think when it comes to the luxury market, we have always known, even independently of the Hong Kong protests, that Hong Kong and Asia is in very high growth, very attractive markets. So I think to see these protests kind of in the way of that is a pretty big roadblock for Canada Goose, a high growth company that investors hope could keep it going.
Yeah, we'll see how they perform in this quarter. You would imagine it's kind of their strongest quarter as the temperatures drop. A lot of people thinking about those warm jackets. Yeah. Thanks for that, Brian. We are also watching Luckin Coffee, the China-based coffee chain, getting a jolt with revenue beating expectations. Average monthly transacting customers, a key metric here, growing to 9.3 million from just 1.9 million a year ago. Dan Halley is with me here. Dan, we're certainly seeing a huge pop on the back of these numbers. Luckin already on track to surpass Starbucks in the Chinese market. Where do they take the growth from here?
Yeah, it seems to be that a lot of it is going into teas, really. You saw, obviously, millions and millions of new customers for this quarter compared to the quarter last year. Don't forget, they also opened thousands of new stores over the past year, and their stores, their footprint is very small, so they're able to build them out rather quickly. And they also rely a lot on delivery from those stores. These aren't big, lavish kind of Starbucks that you think about here in the U.S. They're much smaller footprint. You really just kind of go in and run out, kind of like the corner Dunkin' Donuts, really. Jump in, jump out, and get your stuff done. Tea is really the future of this. They saw 20% of their fresh brewed sales were tea. That's going to be a good growth area for a company like Luckin, and that's really where they're going to focus their growth going forward.
Having said that, Dan, we saw some big numbers, but this is also, as you point out, their big selling point is the quick delivery. I think it's within half an hour. That's what Starbucks has had to compete with. And as you know, this is a really expensive proposition, having to put in the investments. We did see the losses widen in the quarter. How do you think they turn things around?
Yeah, it's going to have to be just gaining more and more customers, and obviously they've been able to do that rather quickly. I think they're going to need to draw people from Starbucks. Obviously, Starbucks is kind of a brand with enough name cachet that people want to go towards. So Luckin's going to have to continue to do that, and really just kind of ensuring that they build out more of their tea offerings, more of their fresh brewed offerings, rather than focusing on kind of big fancy drink orders. The ability for them to close the spending gap that they have will be really important going forward. Again, this isn't a company necessarily that's making any money. They continue to lose some, but they're really gaining as far as their ability to build out stores and their ability to acquire new customers.
Okay, thanks so much for that, Dan. Our third ticker of the day is Smile Direct Club, and we are seeing a big sell-off there. The share's down more than 18% after the online dentistry company posted its first earnings report since its IPO. The stock is down more than 50% since it went public. Jared Blickery is with me at the Wi-Fi Interactive board. Jared, what is the big concern for investors with this first quarter under their belts?
Costs. In just a few words there, their marketing costs doubled. Now, for any company that's trying to reach multiple expansion on their top line in revenue, they have to they have to make themselves known to the public. And so that's costing a lot of money. That's eating into their margins. The path to profitability is pushed farther ahead into the future. But having said that, the company has a lot of prospects. They beat on both their top and bottom lines pretty handily. They also had some nice guidance for the full year. But again, that when it comes to fulfilling that guidance, it's going to cost a lot of money. So we see stock here down 18%. Interestingly, on its first day of trading, it was down 18% from its IPO price. So we're just about matching that. This is the intraday price action. You can see we gapped down to just above the 10 level, and now we're right around 9. And if we go to our max chart, which is going to show the IPO since inception, it's just been kind of a straight line down, although we did get a bounce, and we're now testing these lows here right below $9. And if we drop any farther, who knows what the limit is. But again, this is also a bad environment for IPOs. Beginning with late July, we saw this shift in sentiment and also the mentality that there wasn't the growth prospects for these stocks, at least in terms of price appreciation, that there was sooner. So it was a combination of coming to the market a little bit late and just having a model that requires a lot of input costs.
Yeah, yet another IPO that has seen a lot of volatility since coming to market. Thanks for that, Jared. Straight ahead, the outlook for investors following Fed Chair Powell's congressional testimony today. We've got two experts here to weigh in, plus a programming note. Tomorrow, MLB Commissioner Rob Manfred will be joining us on the ticker. That's at 2:30 p.m. Eastern Time. You'll certainly want to tune in for that. We'll be right back. Welcome back to the ticker. Let's do a quick check of the markets. We are seeing the Dow up 30 points right now, led partly by Disney following the big Disney Plus launch. The S&P 500 is down, as is the NASDAQ. Let's get to Scott Gamm on the floor of the New York Stock Exchange. Scott, we are getting some new developments on trade talks with China. What's the reaction on the floor there?
Well, Akiko, this market is in full-blown trade mode, and by that I mean reacting to any trade headlines out there. Just about 20 minutes ago, the Dow was at session highs and record highs, up about 120 points, and then within seconds, that gain paired, and now the Dow is only up about 30 points after a Wall Street Journal report came out just moments ago citing some hurdles with the trade negotiations between the U.S. and China when it comes to agricultural purchases and possible enforcement mechanisms. So, of course, this shows how fragile the market is, even though we are near record highs. Now, Disney has been the best performing Dow stock for most of the trading session, and it's interesting, the gain in Disney's stock didn't really change much when this trade report came out, and that makes sense because Disney doesn't have much to do with the trade narrative. And of course, with Disney, you have a lot of stock-specific news today, like the fact that Disney Plus has reached over 10 million subscribers in just its first day of existence, and analysts were expecting that kind of subscriber level over a year, not, of course, within a day. So clearly, the numbers are much better than expected when it comes to Disney, hence the stock gain you're seeing. By the way, the stock is now back near where it was trading in midsummer, prior to when the company reported that dismal earnings report in early August. Akiko.
Thanks so much for that, Scott. Well, coming up, what investors should take away from Fed Chair Powell's congressional testimony today. We'll have two experts join us. That's next. Welcome back. Trade talks with China are hitting a hurdle with negotiations on farm purchases. Let's bring in Jeffrey Kleintop. He is a chief global strategist at Charles Schwab. Jeffrey, we heard Scott Gamm on the floor of the New York Stock Exchange a short time ago saying that, look, we were looking at the highs, record highs for the Dow, and he saw it quickly turn sour after we started to get these headlines from the Wall Street Journal. A few days ago, it was about the tariff rollback. Now we're talking about reportedly the Chinese not feeling so comfortable with putting a number on the ag purchases. How do you read into these developments in the context of the market?
Wow, the devil's in the details with these trade agreements, that's for sure. And so even though there's kind of an agreement in principle around this sort of phase one deal, it's hard getting that last mile done, and it's incredibly important. Remember, this year's gains you could attribute to the Fed. Central bankers around the world cutting interest rates really lifted stocks in an environment of the economy slowing, trade slowing, and earnings slowing. Now the stock market needs a new catalyst, a new hero, if you will. That needs to be a trade deal, maybe fiscal stimulus, but we certainly don't have either coming underway in a material way right now, and that probably keeps stocks with a lid on them for right now, given so much uncertainty around trade.
And Jeffrey, you know, we've talked so much about sort of this optimism that has come from at least the president several weeks ago coming out and saying there's going to be a phase one trade deal signed. You know, when you start to hear these details, it's sort of the reality sinking in is that nothing has been put to paper just yet. You think the market maybe got out ahead of itself on this, and maybe investors are overlooking the risk of no deal?
Yeah, the market is certainly priced in movement towards a deal of some kind. You can probably see that most clearly in the incredible rally we've seen in emerging market stocks. They're the most trade-sensitive stocks of anywhere in the markets, moving to the upside more dramatically than the rest of the world, than the U.S., for example, and to the downside when we see these hopes reaffirmed and then dashed. Again, this time I think we are vulnerable to a pullback here, probably most notably in those EM stocks that are up double digits since their recent lows, as it looked like a phase one deal was coming into play. So certainly there is some risk here if it doesn't happen. Also, we've got this EU-US auto tariffs situation coming to a head. We've got more the December 15th tariffs coming up. So there's a lot going on in the next 4 weeks here around tariffs. So it is kind of coming to a critical point for the markets. And I'm afraid if we don't see further progress, a pullback is likely.
Okay, Jeffrey, I want to also bring in Tony Rodriguez. He is head of fixed income strategy at Nuveen, and he is with me here at the desk. Tony, I just want to get your thoughts on these headlines coming out of the Wall Street Journal that the Chinese perhaps are maybe backing out just a bit in terms of the ag purchases that have reportedly been agreed to between the U.S. and China, and what this means in the broader context of this overhang from the U.S.-China trade.
Sure, and I think the ag purchases are really a reflection of the fact that what they're really hoping to achieve out of this phase one is a rollback of the tariffs, not just the failure of implementing the December tariffs, but a rollback of the previous ones. I think that's a big sticking point. So my view is that we've seen this movie before, that we get to the brink of a deal like we did back in May, and all of a sudden, tariff man comes back in and tries to maybe push for more. And so I think the Chinese are, they don't have an enormous amount of trust in what they can accomplish. So they're really looking for something concrete on the tariff rollback. They're not getting that, and the market has moved a little bit ahead of itself in terms of anticipating an actual deal.
But in the previous hiccups that have happened, it didn't end up in a deal. So is that where we're headed right now?
It seems that way. I mean, our view is that the Chinese are very reluctant to commit to anything as we approach the election, whereas it seems like the administration, clearly, given that you're going to see potentially pretty weak growth here in the fourth quarter, they're going to be looking for some sort of economic win out of a deal. So I think the Chinese are feeling like they maybe have some leverage on their side. So our view is that it's likely to just continue in this negotiation phase or in a very watered down phase one.
Let's talk very quickly about what we heard from the Fed chair on the Hill today. He said he's comfortable with where the rates are, but that the Fed would respond accordingly if developments emerge that cause a material assessment of our outlook. What specifically do you see that would maybe cause the Fed to maybe reassess their outlook the way he said?
Sure, it would have to be in our minds weakness out of the consumer. So the global manufacturing recession, that's in place. We're seeing the weakness across the globe. It's even in the U.S. Cap spending is low, industrial production. But the consumer has been holding in really, really well. Unemployment's low, savings rate is high, wages are gaining at a reasonable enough pace. So consumer spending seems to be okay. But to the extent that we see weakness there, and we'd start to see it maybe with unemployment claims rising, maybe a weak employment report over this next couple of months, that is the kind of reassessment I think the Fed would be very uncomfortable with, because the consumer's been the linchpin holding us at this, 1.5%, 2% growth pace.
Jeffrey, you agree?
I think that's exactly right. I think watching the labor market's critically important here. We often refer to the labor market as a lagging indicator, but it's lagged the slowdown in trade, manufacturing, earnings, and business spending on equipment has pulled back, but not yet business spending on labor. That's the next shoe to drop. We've heard about some new layoffs, some new weakness in new hiring, maybe a couple lackluster job reports, but the real key is to see whether that moves forward. Consumer confidence is very high right now. That means it's vulnerable to a pullback in jobs, something we haven't seen yet, but is certainly a key risk.
Okay, Jeffrey Kleintop and Tony Rodriguez, good to talk to both of you today. Coming up, U.S. consumer prices jump heading into the holiday shopping season. We'll discuss what's behind the fastest rise, or at least fastest pace in that rise since March. Stay with us. Welcome back to The Ticker. I'm Akiko Fujita. Let's give you a quick recap of the tickers we've covered in the show today. Our first ticker was Canada Goose. It is now plunging despite an early pop after its latest quarterly results. It saw strong demand for its parkas and jackets, but the company warned that escalating protests in Hong Kong could have a significant impact on its performance in the current quarter. Second ticker was Luckin Coffee. The Chinese rival to Starbucks is soaring after its third quarter results. The coffee chain firmly beat revenue expectations thanks to a surge in sales. It's now on track to overtake Starbucks as China's largest coffee company. Our third ticker, Smile Direct Club. It is deep in the red after its first earnings report as a public company. Smile Direct beat top-line estimates, but it also reported mounting losses that are causing investors concern. And let's check the closing price of oil. Crude currently trading at $57.21 a barrel. That is up about 0.7%. Oil is edging slightly higher after OPEC noted it sees no signs of an upcoming global recession. Well, new data shows U.S. consumer prices rebounded more than expected in October. The index increased 0.4% last month as households paid more for gasoline, healthcare, food, and other goods, marking the biggest pop in 7 months. Energy prices jumped 2.7%, accounting for more than half of the consumer price index increase last month. In the 12 months through October, core CPI increased 2.3%. After rising 2.4% in September. Joining us is Jack Ablin. He is the Chief Investment Officer at Crescent. And John Lonsky, he is here with me at the desk. He is the Chief Economist at Moody's Capital Markets. So John, let's start with you and that CPI number that we got today. Put that in the context of all the other data sets that we've seen. What does that tell you about where we are in the cycle right now?
Well, it tells me businesses still have some pricing power, but inflation is not out of control. Core CPI inflation came in under expectations, but the only place where you're seeing inflation on a recurring basis, medical care, and that component, a mysterious component of the CPI that's referred to as shelter costs. You know, there's something called owner's equivalent rent that accounts for a good chunk of the CPI, but it can never be directly observed. It's an estimate that the BLS comes up with, and who knows how accurate it really is.
Jack, what's your assessment on the number we got today?
I think it's still pretty much good news all around. You know, we obviously see a little uptick in gasoline pump prices, but still year over year they're down. The consumer is still pretty strong, and that's what's powering our economy, even though business sentiment is lower and business investment is down. As long as consumers, the motorists, can drive nearly 300 miles on a gallon on an hour's worth of work, I should say, you know, gas prices are still pretty fair, pretty cheap for Americans these days.
We've seen all majors pair some of their gains so far today on these latest developments coming out of the Wall Street Journal. Trade talks between the U.S. and China reportedly hitting a snag over disagreements on farm purchases. John, you know, we've kind of seen these headlines a few days ago is about the tariff rollback and which tariffs were actually going to be rolled back. How do you think investors should be looking at this right now? Is this all part of the negotiating process that ultimately leads to some kind of signing at the end of the year, or is this something that's going to drag on for the next several months?
Well, I don't think investors should get their hopes up. Nevertheless, I wouldn't, dismiss the possibility that there might be some sort of agreement by the end of the year. And just getting this risk factor, this uncertainty out of the way would be a positive for market sentiment.
And Jack, what does it mean for consumers as we go into sort of the holiday shopping season? We've heard a lot about the consumers being sort of the strength, the pillar of the economy. At what point does all the uncertainty around U.S.-China trade start to seep in and sour some of that sentiment?
Yeah, I mean, you would think we'd see, higher prices in retail goods, for example, and we're just not seeing it, largely because the value of the yuan has declined relative to the dollar, offsetting at least a fair amount of the tariffs that are being slapped on consumer goods. That said, I do agree. I mean, the sentiment on the the business side is slow and deteriorating, and we're not seeing business investment. And so spending can continue for a while, but we really do need to see some capital investments and some business enthusiasm to really keep the market, keep the economy, I should say, going well into next year. I think Christmas, I'm not too worried about. It's really, second quarter and beyond of next year where we're really going to need a boost from the business sector. And I do think that President Trump recognizes that if he's going to take some action and make some progress on China, it's going to happen well into the re-election season mid-year.
And John, I want to give the last word to you. Was there anything that you heard from Jay Powell's testimony today that maybe sort of changed your outlook on where the Fed's headed? Was this pretty much kind of a reiteration of what we've heard?
I think it's a solid testimony. Jay Powell said, listen, we think the economy is going to improve. We think that business revenue growth, after slowing ever since the second quarter of 2018, is about to stabilize, if not turn higher. If it doesn't happen, if that doesn't happen, then we are going to be quick to cut interest rates in response. That will probably be a leading decline by the 10-year Treasury yield. Because inflation expectations are well contained, Jay Powell can well afford to take his cue from the Treasury bond market. And right now, the Treasury bond market is telling the Fed to keep Fed funds where it currently resides.
And very quickly, because while we've been focused on the Fed chair's testimony, I think the rest of the country has been looking at the impeachment testimony today. Is that still not a significant risk in the market? I mean, is that sort of one of those things where you just push to the side if you're an investor?
Well, yeah, I think it's not a major risk to the market. In 1998, we had the Clinton impeachment. The House voted to impeach. The Senate acquitted. We'll probably see a replay of that. I don't think markets are terribly concerned by what's going on in Washington on the purely political front.
Okay, John Lonsky and Jack Ablin. Great to have both of you on.
Thank you.
Thank you.
Well, will escalating violence and chaos in Hong Kong endanger Alibaba's new listing in the financial hub? We'll have details after the break. Let's get to our next group of tickers. Rapidly escalating violence in Hong Kong, raising questions about Alibaba's planned listing in the financial hub. Tilray delivers a murky picture ahead for the cannabis industry in its latest quarter. And Google is reportedly preparing to shake up the banking business. But first to Alibaba, the Chinese-based e-commerce giant is planning a secondary listing in Hong Kong at the end of November. That's according to CNBC. This comes as protests escalate at a Hong Kong university. Brian Chung is back here with the latest developments on this. So we kind of want to separate these two, right? I mean, Alibaba had been looking at the secondary listing in part because they're looking to raise more capital closer to home. And yet, we're looking at the last few days in Hong Kong, one of the most violent that we have seen since these protests began several months ago.
Yeah, violence, as we mentioned in a previous block, has not abated at all in Hong Kong and doesn't appear to be waning anytime soon. We're in the 24th week, I believe now, of these protests, and it seems like every week things just get ratcheted even more and more. What we've seen, though, from a business standpoint, is that it hasn't really precluded too much activity. The Hong Kong Exchange itself recently had the Anheuser InBev. Asia, their APAC division, recently IPO'd on their stock exchange, made a number of billions of dollars. That was a great capital raise for an AB InBev company that is saddled with over $100 billion of debt. And this was despite the fact that they had actually planned that IPO earlier in the year. They had to delay it because of a number of issues. Some speculated at the time that it had something to do with the Hong Kong protests and the inflaming developments in that city. But what we saw is that even though it's gotten worse, AB InBev actually didn't appear to be swayed by the escalating tensions and still IPO'd anyway. So I think for Alibaba, it's probably not a huge roadblock. One reason being that the Hong Kong exchange has actually pared back some of its regulations. They used to have a pretty rigid corporate governance requirement that didn't allow Alibaba, for example, to pick members of its own board. That's the main reason why Alibaba did not IPO originally in Hong Kong and then instead took their IPO to the United States, where to date it is still the largest IPO ever in the New York Stock Exchange history. So a little bit of backstory there, but regardless, is notable that they're going to go over to Hong Kong. CNBC reporting that it could raise about $13 billion for them.
Yeah, Alibaba used to be listed in Hong Kong. A lot of people forget that before they came to the U.S. as well. I mean, what is the benefit for them to be listed closer to home? This is, of course, a secondary listing, but Alibaba has faced some questions, or all Chinese companies here in the U.S. have faced questions about whether there will be stricter regulation for Chinese companies listing here amid all the tension that's happening between the U.S. and China. Is there a benefit, perhaps, maybe to listing closer to home, where maybe investors are more familiar with your sort of business strategy? Although Alibaba is a pretty global company.
Yeah, absolutely. Alibaba is based in Hangzhou, China, but obviously a very Chinese-focused platform to date. They've kind of been siloed from Amazon. Amazon's the primary e-commerce platform in the United States, Alibaba the primary platform in China. The most open capital market that investors in that region can go to is in Hong Kong, although China is trying to beef up its own exchanges. But as far as allowing investors that are close to home, that really understand the business model, that are willing to throw money into this business, Hong Kong is the place to go. And you do wonder to what degree, Alibaba's performance and the stock performance here in the United States had inspired them to say, hey, you know what? Even if we don't need the capital right now, keep in mind, this is a company that made $38 billion in sales for Singles Day only a few days ago. They probably decided, look, we know that the demand exists there in Asia and that we can open up this exchange in Hong Kong and get the demand for it. And raising $13 billion is something that few companies would turn out or rather say no to. So that's why Alibaba is pursuing that right now. For what it's worth, though, kind of worth mentioning that the stock is down about 3%, probably more related to Jack Ma's commentary saying that he wasn't pleased with the $38 billion in sales for Singles Day, as Reuters reported. So interesting there.
Jack Ma still moving the market, even though he's no longer.
Really, $38 billion is not enough.
It's not enough.
It's a lot of bees, in my opinion.
A lot of retailers that would love to have that number. All right, let's move on to our fifth ticker of the day. That is Tilray. The cannabis company is slumping after reporting mixed quarterly earnings. Revenue beat expectations, boosted by the acquisition of hemp food maker Manitoba Harvest. Jared Blickery is back with me. Jared, walk us through the numbers.
Well, it was, let's put it this way, it was a beat on their top line, and they've had 4 of those in a row. They beat by about 4%. Their revenue year over year is up by about 5 times, which is a huge number, and part of that has to do with one of their acquisitions in February of this year. They're growing very fast, but we are seeing share slump here, concerns about their costs, as always. It is fast-growing company. How are you going to expand your reach? It's a competitive landscape, and people have come to the realization after cannabis kind of peaked in late 2018, at least in terms of the stock prices, that there's not an unlimited market for it. And they've done a lot of acquisitions, and arguably some of them have been a little bit haphazard, maybe reckless. They're trying to branch out into different areas, and as a result, their capital structure is stretched a little bit, which limits their opportunity for future expansion. So that is a concern. If we take a look at the stock price here, we can see that it's been kind of up and down early in the day, but now is settling down. But let's go to a max chart so we can see that huge spike up. That's a bubble if I've ever seen one. That's something like 1,300, 1,400%. And then from here, it's been a drop of, gasp, 93%. If we look at it compared to its competitors, they're not faring very well this earnings season either. We had Kronos Group report yesterday, as we did Acreage. They reported this week as well. And if we look at year to date here, we can see even more red. We can see the ETF that tracks the space is down 27%. Everything's down by quite a bit here. So the space really needs to figure out where it's going, kind of consolidate, get its bearings, and get its costs under control.
Thanks for that, Jared. Well, sixth ticker of the day is Alphabet, the parent company of Google, offering checking accounts next year. According to the Wall Street Journal, the accounts will be run by Citigroup and Stanford Federal Credit Union. Dan Halley is back with me. Dan, a lot of people looking at this and saying, wasn't it just a few days ago we were talking about Google tracking health data as well? What do you think is a big play for Google? Because they're certainly not the only big tech company that is trying to find a way to get into banking.
Yeah, I think the big play here is really, and it's similar to what Apple did with the Apple Card, is to ensure that you are stuck with that ecosystem and you remain within that ecosystem. Now, for instance, with the Apple Card, the way to access it is either through the Apple Wallet app or online, but most people would want to access it through the Apple Card app on their iPhone. If you don't have an iPhone with you, then good luck accessing it on the go. That's going to be kind of what Google wants to do here, where they really continue to lock you into the ecosystem. And outside of email, outside of messaging, what better way to do that than with your finances? And that's going to be where this goes. Now, there's all sorts of questions on whether or not Google will be able to sell the information that they collect through this. They say that they won't. They say that they don't sell any information that they use through Google Pay. Those aren't sold to advertisers in any way, according to the company, and that's the way it's going to stay. Apple, by the way, does the same thing. They said that they don't sell any information, but Goldman, which does run the Apple Card, does. So it'll be interesting to see what Citigroup says it will do with the information on their side of things when it gets off the ground with Google.
And when you think about who's leading up this project, Cesar Sengupta, who's in charge of payments, he's based out in Singapore. He's been doing a lot in the payment space in other parts of the world, not necessarily in the U.S. And you highlighted the fact that Google wants to create this sticky app where users stay in it, they shop in it, they take care of all their medical care, kind of starting to sound like WeChat, right? And what do you think are the challenges of a company like Google trying to get that at a time when there's growing distrust here in the U.S. around tech companies?
Yeah, it'll be really interesting to see if people actually sign up for this. Now, with the Apple Card, it's slightly different because they have a physical card, and they also have Apple Pay. Apple Pay is the largest contactless payment system from one of the big major tech companies, whether that's Google or whether that's Samsung. But you have something like WeChat where you're able to pay through QR code. You just walk up to something or you take a photo of it and you run it through the app. That's not catching on here in the U.S., nor has it. And we really haven't seen contactless payments via something like Apple Pay or Google Pay catch on. There are 140 million Apple Pay users to 100 million Google Pay users. You would think that that number would be flipped, considering that Google's Android is the largest operating system in the world, but it's not. And frankly, I don't know what would get U.S. consumers to get on board with something like this, considering that it was such a big deal for us to even use chip and PIN. So whether or not we'll get on board with a Google-based payment system, that remains to be seen.
Okay, making small inroads. At least that's the goal for Google right now. Thanks for that, Dan. Coming up, ETF assets soaring to new records. We'll explain coming up. It is now time for our ETF report brought to you by Invesco QQQ. Today we are watching two new dividend ETFs, ProShares S&P Technology Dividend, Aristocrats ETF, and ProShares Russell U.S. Dividend Growers ETF. This comes as U.S.-based ETFs have racked up a record $4 trillion in assets under ETF management in 2019. That's at least according to research firm ETFGI. And some experts say this is just the beginning. Let's bring in Kieran Kerwin. He is a senior investment strategist at ProShares. So Kieran, let's talk about that number, $4 trillion. What's been driving the inflows there?
Yeah, it's certainly a big number, Kiko. And you know, if you look at the number of products out in the marketplace now, over 2,000 ETF products, a lot of new innovation, a lot of new investor adoption, right? So we're getting a lot more types of investors, types of advisors who are beginning to use ETFs. And I think really that's been you know, one of the drivers behind the growth in those assets. Of course, people are well familiar with the benefits of the ETF wrapper in terms of low cost and tax efficiency. And we're heading into tax season right now. So those things are becoming more and more front page headlines, and people are again embracing the ETF wrapper at the expense of, in many instances, the mutual fund wrapper.
Yeah, Kieran, when you talk about new investors coming in, or at least choosing to invest in ETFs, where's that coming in from? Are these investors who are trying to jump into the market for the first time and not quite sure which picks to go for, or are we seeing them maybe diverted from another asset class?
Well, I think heretofore, right, most of the ETF assets and adoption has been in the equity space. So, and it's all really been, for the most part, been acquiring cheap exposure, cheap beta, as we say. What we're seeing is that more and more types of investors are beginning to embrace other asset classes. So fixed income, for example, has been really a big winner in 2019 so far. Also different types of products like thematic type of ETFs, right? So these are products that are designed to capture structural changes in the way we live and the way we invest and put them in a, again, low cost, tax efficient package that's very easy to invest in. And those types of products are bringing more and more investors into the ETF ecosystem.
So Kieran, you touched on some of the ETFs that you're liking, but what are your top picks right now? You specifically highlight these dividend growth ETFs. What are you finding there?
Yeah, we especially like the dividend growth space. At ProShares, we just launched 2 new products, and that brings our total product count to 8 in the dividend growth space. And that is the largest lineup of dividend growth ETFs of any product provider. And the thing about the dividend growth area that we really like right now is the quality element, right? So we're finding that companies that have stronger balance sheets, better fundamentals, are able to weather market turbulence a whole lot better in many instances than straight asset exposures. So we like companies that are able to grow their earnings. Lots of folks have their eyes on earnings these days. Earnings in the market overall have been fairly flat. But if you look at companies that are able to grow their dividends, right, these are higher quality names. They tend to be able to grow their earnings in times like these, and performance has been there to support that thesis.
Okay, Kieran Kerwin joining us from ProShares. Appreciate your time. Coming up, why Nike looking to halt sales on Amazon. We'll have the details next. Let's go beyond the ticker. Nike says it will stop selling shoes directly to Amazon. This will end a 2-year pilot program between the two companies. Nike's direct-to-consumer president speaking to Yahoo Finance earlier today.
We want to move forward and make sure we continue to innovate on our own platform. And we also want to make sure that we build an ecosystem of partners, other partners that will help us have those direct and amazing experiences with our consumers.
Let's bring in Brian, Jared, and Dan Howley back into the mix. Brian, let's start with you. How much of this is really about Amazon, or how much of it is about Nike's evolving strategy with a new CEO in charge?
Seems like more so with Nike. Keep in mind that Mark Parker, who's the current CEO, will be departing the company beginning in January. John Donahoe, who is the former CEO of ServiceNow, also had a stint at eBay. It will be heading up the company, and his experience as a former eBay executive means that he'll be bringing a pretty strong D2C strategy here to Nike, which they might be trying to capitalize on by pulling back from their partnership with Amazon. So something definitely worth watching in the near term with this company.
Jared, you agree?
I think so. They're really trying to get into digital. Their possibilities there have really improved with this new CEO. But also, I think they're disappointed with the amount of gray market sales on Amazon, and a lot of other people are in the same boat. Birkenstock was the first to, well, at least in terms of shoes, to do this back in 2016 for a similar reason. So I think Nike's going to be just fine here.
Yeah, Dan, there are questions about whether other retailers are going to join the mix and basically bolt from Amazon. Jared brought up the concern about the counterfeits. How much more do you think Amazon needs to do to crack down?
They really just need to get a hold of this. This is something that's going on across the board with different types of products. And if Nike's going to pull out, then you can expect others will too.
Okay. Jared, Brian, and Dan Howley, thanks so much for that. Coming up, Cisco reporting earnings after the bell. Stay tuned for the final round. That's next.
Miles Udlin. Oh, here we go. Here in New York, this is the final round on Yahoo Finance. We got stocks pushing new highs. Disney pulling the Dow higher. We'll have more on that and all the market action coming up in just a bit. Plus, Nike is kicking Amazon to the curb while the sporting goods giant is doing e-commerce on its own. And Wall Street is getting bullish on shares of Apple. We'll discuss in our final round call of the day. Plus, got a lot going on down in D.C. We'll get the latest on impeachment and Fed Chair Jay Powell's testimony on Capitol Hill. Joining me now, the host of Wi-Fi AM, Dan Roberts stopping by on this Wednesday. Jen is out on assignment. Let's take a look at where the markets are right now. Hour to go in the trading session. The Dow up about 100 points. Thank you. Not Mouse House. Powell. Not Mouse House. Disney shares up big today. The company announcing 10 million subscribers to Disney Plus. We will get to that in just a bit. The S&P here at a record high yesterday. It made an intraday record above 3,100. The Dow, of course, coming off just that amazing 0.00 point move on Tuesday, the first time the Dow had done that since April of 2014. Now, earlier today, we saw trade kind of pushing the markets around a little bit. So we've got reports that trade talks have kind of stalled with the Chinese here. It's over purchases of agricultural goods. Donald Trump, in his speech yesterday at the Economic Club of New York, saying that there would be some sort of increase in agricultural purchases. This is a line, Dan, that the president has been bringing out for quite a while, and I think we can sort of get a sense of what trade is going to be as we get into 2020, which, in my view, will be targeted stimulus at the 5 states. Trump knows he only needs to win those 5 to win the whole election.
Well, and also, what will the situation be in 2020? The same, because how many weeks has it been that we've heard we're about to get a phase 1 trade deal, we're inching closer to signing a phase 1 trade deal, and actually just 2 days ago, or was it the end of last week, the Chinese came out and one of the representatives said, both sides have agreed to peel back some of the tariffs. And for most of the day, we didn't hear the response from the White House. And then President Trump said, no, we haven't. We're not peeling back the tariffs. And markets had responded and gone up. But I actually like a day like today where we don't have to piece through, well, how much is the drip and drab we're hearing about a potential trade deal affecting stocks today? That isn't the story. I mean, the story is, first of all, you've got really interesting news about Disney that arguably could be juicing the market, because I don't think it's a stretch to say that the optimism around the streaming demand there arguably reflects well for a couple other companies. Apple stock, been on a tear lately, not necessarily because of Apple TV Plus, and yet there's more optimism around that when you look at the demand for Disney Plus. And then also, look, the remarks by Jay Powell, I think things have settled to the point where, first of all, we got the prepared remarks already, and we saw, okay, more of, we'll do what's necessary, but actually responding directly to what President Trump keeps talking about, negative rates, saying that wouldn't be appropriate. So I don't think that necessarily you can put all of today's action on that, but that's a good thing. I mean, finally a day when Powell speaks and it isn't everyone freaking out because of what Powell said.
That's right. Now, of course, if we do look at the intraday chart of the market, I mean, trade is still, I guess as you would frame it, the marginal bid, right? So we do see the move kind of at midday. There were those negative headlines. But to your point, Dan, about the phase 1 deal, I mean, Trump has discussed the contours of what a phase 1 deal would look like in so many different terms that you can almost then, all right, if we have the 3 phases, right, we take that at face value, even though...
forget anything beyond phase 1. Let's get phase 1 first.
I think he was kind of just winging it when he said there'd be 3 phases, right? So now we're in phase 1. We can divide that phase even further, right? That might be 3, 6, 9, 40 phases in itself, and say we're still in phase 1 because, again, the administration watches the market. They know what the market is doing in response to this stuff. And I think, to your point about officials sending conflicting signals. I mean, we had Peter Navarro on the show on Friday. We asked him about something that Larry Kudlow had said publicly, and he said, well, that's not what we think. And so these guys are not on the same page.
You're kidding. They're not on the same page. Now, I'm willing to believe, though, that we are at least way past step 1 of phase 1. I'm willing to believe that we're somewhere in the realm of a phase 1 deal coming someday, but not imminently until it happens. I mean, I also think that if you talk to politicos, and I'm not one of those, it's like my favorite Twitter hashtag, I and Al, I am not a lawyer, but what you hear is the theory that President Trump doesn't want there to be a deal just yet. It's good for him if there's not a deal yet. He says, re-elect me, I'm the only guy who can get the job done. I've got China over the coals, and if you re-elect me, I'll get that trade deal.
I think at that point we start moving a little bit, He's not thinking through it that much.
Oh, I don't know. I think he would like to get re-elected. But
watch the stock market, right? Sometimes it matters.
How about the Disney Plus number? 10 million. We'll talk about it later.
We will get to Disney Plus. We'll do some PR for Disney later. All right, for more on today's market action, let's go to Scott Gamme. He's live on the floor of the New York Stock Exchange. Scott, we're talking about Disney here. We got trade. What are you looking at down there on the floor?
Well, Miles, the gain in Disney just keeps going. Now, when that negative trade headline came out about an hour ago, the Dow paired a good portion of its gains, but Disney stock specifically was able to maintain all of its gain, and it was not really affected by that trade report, which makes sense because what does the trade narrative have to do with Disney? But what is the reason now, an hour later, for the broader Dow's recovery from that negative trade headline? Well, more gains in Disney. The stock is now up over 7% at session highs. And of course, the stock-specific news surrounding Disney was the fact that the company announced that subscribers for Disney Plus now topped 10 million in just the first day. Analysts were expecting 10 to 18 million over that entire first year. So clearly Disney blowing past those expectations. The stock is now trading above where it was trading mid-summer, right prior to some of those losses that the stock suffered after reporting that dismal earnings report in early August. Now, some of the trade-sensitive stocks in the Dow are weighing the Dow a little bit. You're talking about names like Caterpillar and Dow Inc. Those are some of the worst performing Dow names. Now, outside of the Dow, we did want to update you on what's going on with Alibaba's stock. It's been down all day. The stock is now down almost 3%. Of course, Alibaba listed here at the New York Stock Exchange, and it has been for 5 years now, but reports recently are surfacing saying that the company is planning a secondary listing in Hong Kong as soon as later this month, and it could raise as much as $13 billion from that secondary offering. By the way, the market cap for Alibaba's stock, at least listed at the New York Stock Exchange, is $474 billion, guys.
All right, Scott Gam live on the floor of the New York Stock Exchange.
You know, one more thought about markets today, Miles. You and I, when we opened the show, we're talking about all the different factors that are affecting stocks. You know what neither of us even mentioned?
What's that?
Impeachment inquiry. It
Right.
doesn't matter for stocks. Kind of interesting.
Does not matter for the
amid
stock.
all the fervor and furor and fire and fury, and what will this mean? Stocks don't care.
For another time, but a very interesting time to be a business reporter, because there is kind of a line between what the public cares about politically and what the business viewers do, and I think there's a lot of interesting conversations to be had about why exactly that is. All right, let's turn to some retail news. In today's market, iconic sportswear brand Nike no longer selling its products on Amazon. The company announced the decision on Tuesday, saying it has opted instead to focus on its own D2C business, though it will continue to seek partnerships with other retailers and platforms. Now, just 2 years ago, Nike agreed to sell products on Amazon in exchange for stricter policing of counterfeits and restrictions on unsanctioned sales. This makes me think, Dan, about something that I saw just kind of in very small finance Twitter circles this weekend, which was someone took a screenshot of men's UGG boots search on Amazon, and actual UGGs were fourth. And the other things were 2 paid advertisements and then Amazon's own knockoff slipper.
Problem.
And so I think brands now look at Amazon and they know that the advertising bit of Amazon, which we talk about so often, is a real area that they're going to use to, 1, promote their own private label products, and 2, just put whoever will advertise against that search in there. Nike doesn't really need that heat, obviously.
Well, that is the story. Amazon's own search results and surfacing its own products higher, and also policing heavily, or laissez-faire, we won't police it so heavily, imitation products. And that's why Nike finally said, okay, we will work with Amazon. That was only 2 years. So by the way, pretty fast experiment, only 2 years. Right. But you'll remember that when Nike finally announced in 2017, okay, we are going to do a deal with Amazon where we'll sell Nike stuff. The problem was, and everyone who knows the story pointed this out correctly, it's like, this wasn't the first time Nike stuff was available on Amazon. There was some Nike stuff being sold third party, which Nike doesn't like. And that's real Nike, exactly, that's real Nike products, but it's someone reselling it for $1. And then there's cheap knockoff stuff. So something behind the scenes has happened here where either Nike realized it's still going to happen and us having our own products on there isn't helping enough that it's worth it to us. Plus, Nike would like to build its own DTC business, as companies like Under Armour and Adidas have done as well. They've really built their DTC businesses. So why help Amazon kill you?
Well, I think it's more, I think it's all that, but I think it's also about the advertising placement that Amazon is having. So like, let's think about a store, right? So the private label stuff, in terms of Amazon, I think it's overblown. You know, you go to a grocery store, they sell private label items, and they sell it near the Kraft mac and cheese.
You can get the generics, too.
Now, Kraft pays for shelf space that it knows will be at the right eye level or gets end of aisle, whatever it might be. So Nike thinks that they're partnering with Amazon getting that. Amazon has gone out and said, well, actually, we sold 2 separate shelves that are in better line of sight than your product. Now, we have our own private label mixed in there, but these are just 2 knockoffs, right? These is just Dan Roberts mac and cheese in front of Kraft because they paid a premium for it. I think that is what Nike really doesn't like, and other brands don't like this as well, is that a search for Nike doesn't yield Nike because Amazon has sold the space against the search.
Well, and let's just say, that's absolutely right. I wish that before this news came out, we could have done some testing of what happens when you search for Nike
I'll look it up
Vapor
right
Max on
now.
Amazon. That's fine, but
They
now
pull it off today.
now they're cutting I don't know, the story's out and it's said immediately. So
I'll go Google.
now I'm not super useful in terms of I've never bought Nike products on Amazon, but we should ask our sneakerhead colleague Reggie Wade. But I will say, this story writ large is not at all new with Amazon. It goes back more than a decade. I mean, in Brad Stone's book about the Everything Store, they use the example of Wusthof Knives, which is a leading, I think, German seller of really sharp, nice kitchen knives. And Wusthof was being undercut on Amazon with third-party resellers, all kinds of junk on there. So Wusthof, made a deal with Amazon to let Amazon sell Wusthof knives. Then, a couple years later, it still didn't like it and tried to say, we're going to walk. And then Amazon basically had it over a barrel and said, well, you can walk, but we can't guarantee that your knives still won't show up on Amazon. So that's hard, man. That's a draconian gambit. I mean, do you get in bed with the enemy to try to lessen the damage?
Yeah. Plenty of other Amazon-related things that we could talk about off the
What did you
record
find
and
on
not in
search?
public. When I put in Nike Air Force One, the first thing that showed up was a big advertisement for the North Face, although there were what appeared to be legitimate Nike product, but it's not like from Nike. It's free shipping, free delivery, but it's not like, Prime, the check mark where it's like Prime.
Right, which that really is powerful.
Speaking of Nike, very quickly, Colin Kaepernick working out on
Sure,
Saturday.
big news for the Falcons.
But
and by the way, right after
I
the
still
Falcons
don't
had a
understand-
surprise win.
I still don't understand this story here because it appears like the NFL called him and said, we're going to do a workout. And he was like, okay.
Well, he tweeted out, I've been ready for this for 3 years and waiting.
I know, but
We'll
it wasn't a negotiation. They just called him and said, you want to work out? All the teams will be
Well, make no mistake, all the owners in this league had said together, we're not going to hire Kaepernick.
Right.
A couple of years back. Now maybe the fog is lifted, the protests are over, the ratings are back. They decided, all right, let's give him a shot. Fine.
Well, we know he'll be wearing Nikes at the very least at that tryout. All right, coming up here with some stocks in the move, but first, let's take a look at where European markets closed on this Wednesday. Take a look at some of today's stock movers in the market. Canada Goose shares, boy, who writes this? Shares getting plucked here as the outerwear maker beat on earnings and sales, but it warned about lower wholesale revenue due to early shipments to department stores. That stock down quite a bit there. Luckin Coffee, the Chinese coffee chain, reported a smaller loss than expected and beat on revenue for its most recent quarter. That stock jumping on the news. And The Gap, Barclays, initiating coverage of the apparel maker, an underweight rating, claiming excess inventory and a lack of appeal with younger buyers will hurt sales in the future. Thanks for jumping on that one. Gap stock gotten absolutely destroyed over the last few years. Art Peck stepping down. Really no clear path forward for the Gap.
I'm not sure the Gap exists in 10 years. Maybe not in 5 years.
Right, I think the Banana, Athleta, Old Navy will exist. I think the Gap name might be broken.
For a while it was like, but Old Navy is really propping it up, doing well. Now even that is no longer true. Sorry.
Certainly changes will be made over at the Gap.
Just the other day in my Twitter feed, and maybe it was more of the, I believe that the phones listen to you, absolutely.
100%.
So I think it was after we actually talked about the Gap on the morning show on Wi-Fi AM, but I saw a promoted tweet for the logo hoodie. And it was an ad, and it was playing off nostalgia, the hoodie we all had in middle school. I had one with the comfortable pocket and Gap. No, so they're pushing the nostalgia.
I had a lime green hunting hoodie. That's great. Classic. All right, coming up here on the final round, Wall Street getting bullish on shares of Apple. We'll discuss that in our final round call of the day. But first, let's take a look where big tech is trading right now. 44 minutes to go in the session. All right, time now for our final round call of the day. Today we're talking about RBC's latest on Apple, the firm initiating coverage on the stock with an outperform rating, a $295 price target. The vote of confidence is owed to what else? The iPhone, which continues to be the company's cash cow. It expects a 5G version to re-accelerate iPhone growth. RBC also likes Apple's successful track record of innovation. Of course, Apple just today admitting that when it came to the MacBook Pro and the laptop I'm looking at right now, the innovation was actually a net negative. They had to completely rehaul the line for the keyboard. But Dan, you're enjoying your new iPhone right there.
That's right.
It appears as if you got the
Portrait
iPhone
mode.
11.
I finally have it.
Yep. The iPhone 11.
This is my work phone, but I had a 7.
I have 7 as well.
Years, so I just went from 7 to 11. Oof, it's a whole new world.
Are you outperform rated after getting a new device?
Well, I have to say, I don't like how big it is, but I guess that's the new normal. Bigger phones, bigger screen, people are happy with that. Photos look incredible. There's a lot about the touch and the interface that is different and changed that I don't like. I can't seem to get it to show me the percentage of the battery, which I really don't like.
This is a basic setting.
Those little things matter. No, I was Googling it. You can't change the setting. It won't show you the percent anymore up here at the top right.
There's not enough real estate because
I guess. And then how to take a screenshot is different buttons now. So I have some gripes. But the point is, look, remember all the fear and FUD over the iPhone sales. And in January, Apple came out and said, warning, oops, and China, and get ready. And everyone said, oh my God, and the stock fell. It didn't matter so much. It's okay. Things are doing well in China. People are still buying an iPhone now. Average sale price helps. I know everyone said that. Yes, for a while we were saying there's less reason, less need, less urgency to upgrade every new cycle. And I think that's true. But I think it's okay. Eventually you've got to upgrade, you buy the new iPhone. And with what Apple is doing on streaming, I also think that the news recently about Disney sort of has added some optimism around Apple. The framing of Disney Plus versus Apple TV Plus was wrong. We're seeing that the appetite for more subs is there. So I think
Yeah.
people are willing to add before they cut. So that's interesting to me as well. And of course, just today we had other Apple streaming news. I know we want to talk about the iPhone, and RBC is focused on the iPhone, but Richard Plepler of HBO supposedly going over to Apple.
Apple has returned $242 billion to shareholders via share repurchases since 2015. That's triple the pace of Microsoft and Oracle. The company has $100 billion of cash on hand. So basically, they're going to buy back a ton of stock. That's part of what the thesis has been. Richard Plepler's not buying back stock. So I think, again, Apple now, as RBC notes, trading at about 20 times earnings. That's the high end of its range since the iPhone came out. And I think to the surprise of a lot of people, Apple has not, for extended periods, garnered a multiple in excess of the market multiple. So there's a sense here that maybe the brand value, the brand moat of Apple will start getting 25, 26 times earnings applied to that. And that's really the path forward for the stock. I think you can back into all the streaming stuff, but ultimately, from a financial position, it looks attractive. It's looked attractive for a long time. It just hasn't had, I mean, you look at the chart there, this year's performance has been nothing short of stunning after that January disaster.
Absolutely. It's insane to think that that was as recently as January. And just quickly, the streaming stuff is also a story about iPhone because it's about the install base. I mean, putting it on all the new devices, that's an instant built-in number that they can say, in a year when it's how many subscribers, that number is going to be a lot bigger thanks to giving it to people for free for a year if you buy a new device. One feeds the other. And then also, remember when things looked bad with iPhone sales, so everyone said, oh, but look over here, it's services. That's okay, it's all about services. Well, in this note, which is a very bullish note, it's about the iPhone.
That's
all right?
Yeah,
Forget
higher
services.
margin device. All right, coming up here in the final round, we'll get the lowdown on Fed Chair Jay Powell's day on Capitol Hill. Brian Chung will stop by to talk about what Powell had to say about negative rates of all things. But first, let's get a look at some of today's Dow winners. Fed Chair Jay Powell on Capitol Hill earlier today testifying before the Joint Economic Committee. Yahoo Finance's Fed correspondent Brian Chung was listening in. He joins us now to discuss. So, Brian, Powell talked about a lot of things, but of course, he had to, I mean, everyone's just obsessed with negative interest rates. What? He addressed the potential for them in the current environment. Let's take a listen to what the chair had to say.
Negative interest rates would certainly not be appropriate in the current environment. Our economy is in a strong position. We have growth. We have a strong consumer sector. We have inflation that's a bit below target. So the very, very low and even negative rates that we see around the world would not be appropriate for our economy.
All right. Now, he said a very important phrase in that answer, current environment. I mean, I think everyone agrees that if there's a deep recession in even 5 years, but certainly further out into the future, that there will be negative rates in the U.S.
So here's the thing. Chairman Powell has said that negative interest rates are not on the table. But if you're a policymaker, why would you want to completely box yourself out of using any specific tool? Why wouldn't you want to keep everything on the table? Well, this gets into the macroeconomic question of whether or not you want markets to know that that is a tool that's available on the table, right? Because right now we are operating under a monetary policy framework, at least so the Fed says, where 0 is the lower bound, and that the Fed will do everything it can to try to fix an economy, a theoretical, or try to counter a theoretical downturn with any tool that's not negative interest rates until those tools don't work anymore. In which case, who's to say that the Fed won't then use negative interest rates?
All right, so obviously Powell is kind of responding to what Trump said yesterday about negative interest rates. And I mean, frankly, I think we would both agree we spend way too much time talking about what the Fed might do with respect to the lower bound in some future events. So let's talk about other things he discussed today, including China. Powell, I think, very revealingly saying, hard to tell what goes on over there in China. I think, in your view, is he speaking to a consensus that policymakers have right now in terms of, they say international risks or, vague kind of international developments? Is that kind of a consensus view of, we think we know what's happening in China, but we can't say for sure how it would impact our policy preferences?
Well, this was the entire focal point of the Jackson Hole Conference, which was how much mind should central banks, not just the Federal Reserve, but central banks around the world, be paying attention to what's going on in other corners of the world. Because the Federal Reserve's mandate, as it was given to them by Congress, has nothing to do with what's going on externally around the world. Right? It has to do with stable prices in the United States and maximum employment in the United States. But what we've seen is that when they signed the Federal Reserve Act into law in the 1910s, it was way more of an insulated economy in the United States than it is in 2019. So the question is, how much mind should the Fed be paying attention? When we talk about China, them being such a big part of the global economy, they've been slowing down. Their most recent GDP growth reading was 6%, which everyone was like, oh my gosh, look at China, tanking in terms of their economic growth now. You do raise the question about whether or not the Federal Reserve is kind of factoring that into their FRB US model when they try to figure out where interest rates should be going. But of course, as is always the case with Chinese data, it's unlikely that the numbers that they're showing are kind of 100% of the whole story. And there's no reason to expect that the Federal Reserve would have any better insight than that.
And I also feel like, correct me if I'm wrong, Jay Powell has answered whether we are looking globally, and the answer is yes. I mean, it may not be what President Trump wants. I mean, you talk about how it used to be much more close, and he wants that again. The nationalism over the globalism. But Powell has said, I think, a couple times now that okay, the U.S. economy humming along, we're okay, but globally, there's a lot of other countries that are slowing down, and that affects us.
Yeah, it's a balancing act.
Yeah,
so
certainly, I think the world central bank is an apt title at this point for the Fed. All right, Brian Chung, thanks for stopping by. Powell speaks tomorrow, yes?
Again,
same thing. He's gonna
run
say
it back.
Is it the same people?
No, House Budget Committee. Different.
House Budget Committee. Okay. Sure, it'll be
Can't wait for the
stuff.
juice.
All right, Brian, thanks for stopping by. Coming up here on the final round, we'll have more. Plus, Apple unveiling a new laptop that fixes a pesky issue that I know truly upset Dan Roberts. We're back with that right after this. everyone, Miles London here in New York. This is the final round on Yahoo Finance. Stocks pushing again to highs as Disney pushes the Dow higher. We'll have more on all the market action coming up in just a bit. Plus, Wall Street getting bullish on Apple. We'll discuss in our final round call of the day. And delivery startup DoorDash is raising big money, but is it running into the same problems that have afflicted other tech unicorns? We'll discuss. Plus, Apple unveils a new laptop, finally fixing a pesky issue. Dan Halley will join us to break it all down. Joining me now, we've got Yahoo Finance's Dan Roberts, the host, of course, of Wi-Fi AM right here on the stream. Let's take a look at the market right now. Got about a half hour to go in the session. The Dow up 110 points. The NASDAQ pushing into green figures. We'll see where we shake out in about 30 minutes. Dan, of course, the Dow today being driven by what we see in Disney. I know that we have talked, and you have talked much more extensively on the air about Disney Plus over the last couple of days. But I think on day 2 of the launch, they announced they have 10 million subscribers. That beats expectations. Where do we stand, I guess, with Disney Plus now that it works for everybody? Everybody can watch all the things they want. Where do you think we stand in the immediate aftermath of this whole hoopla? And Disney shares up 7%, their best performance in 7 months.
Yeah, and let me just say, you teased me for being a Disney bull, and I am. I think Bob Iger's done a great job. However, I haven't yet downloaded the app. I did think yesterday it was silly, the hubbub that was made over the glitches and outages. Yes. Of course, it's a nightmare. You don't want that day one. Right. But A, Disney twisted it into a humble brag with its official tweet that said, demand is even higher than we thought. And B, I knew and was saying yesterday, give it 2 days, it won't be a story. I mean, by the way, Apple, every time there's a new iOS out, everyone complains. They say, I hate it, it's glitchy, there's problems. And then they fix it, they release a new update, you don't worry about it. People who subscribed aren't going to cancel because there were issues on day one. Now, it is interesting to me the big bet this is for Disney. Make no mistake here. Yes, the stock is up, but I want to remind people this thing is not going to be profitable for years. Probably it will take as long as 4 years. And some reports say that some of the original Marvel shows have a budget of $25 million an episode. Yep. So there was a furor over Apple TV Plus's supposed budget for The Morning Show. That was reported at $15 million an episode, $25 million per episode we're talking for some of these Marvel shows like WandaVision and Falcon and the Winter Soldier. So there's a lot riding on it. It's the final big move and chapter in Bob Iger's tenure as CEO. Right. There is a lot of pressure to this. So I do think it's already a success. I think it will be a success, but I think you have to give it a couple of years to really see, and the pressure is on.
And I think that in general, today's reaction to what was, I mean, it was good news from Disney, but the stock is up 7%. To me, suggests there were quite a few people betting against the stock, right? Basically saying, we think this might be a pain in Disney's butt, and so there's a little bit of a squeeze happening here. But like you said, this is really going to be a show-me story for the next couple of years. Netflix share is actually reacting quite negatively to that.
It was also a small number, by the way, 10 mil. I mean, I think Disney intentionally has given a small number for what it expects for Disney Plus so that they can say we smashed it.
I think some people are going to say it's a big number.
60 to 90 million by 2024, right. But they got 10 million on day one, so I think they're going to get 30 million very quickly. I mean...
What's very quickly? End of the year?
30 million by end of 2019? No, but more than 30 million by end of 2020.
Okay, sure.
Yeah.
Basically, 15 months. All right, for more of today's market action, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Just talking about it a little bit here on set, Scott. Netflix shares under pressure on the heels of this Disney move.
Well, that's right, Miles. We're seeing Netflix down 3% right now. The stock has been down all day, but it's at session lows, just as Disney is at session highs. So it seems like investors are acting as if the Disney Plus situation is a zero-sum game. And we know Wall Street has been worried about Netflix for several months now. It's also interesting when you look at the market caps of both companies. Disney's market cap is double that of Netflix. We're talking about $270 billion for Disney and about $125 billion for Netflix. Remember, Netflix is a FANG name. I don't know, maybe Disney should be working itself into that acronym. Now, when you look at the broader Dow, obviously Disney has propelled the broader Dow and has really been the reason for the Dow's rebound following the time when the Dow got hit about 2 hours ago from that negative trade report. So when you look at the stock market, it looks as though investors aren't really worried about trade. But then when you look at the bond market, we saw the 10-year Treasury yield decline right as that trade report came out. It went from about 1.9% to firmly below 1.9%, and it hasn't really rebounded. So when you look at bonds, investors clearly are still worried about that negative trade report that we got at 2 p.m. By the way, the financial sector is the second worst performing sector in the S&P 500, guys.
All right, Scott Gamm, we'll talk to you shortly after the closing bell. All right, time now for the Tech Howl with Yahoo Finance tech editor Dan Halley. All right, Apple has, I think, kind of admitted a mistake of sorts, right?
Kind of, yeah.
In not really Apple fashion. They've got a new MacBook Pro out, hitting the market. It's 16 inches. It's heavier. It's thicker, bigger than the old MacBook Pro. But of course, it's really all about the keyboard, which Hallie, I imagine, will make its way into subsequent models of the MacBook, the MacBook Air. And I saw, Daring Fireball today. It's Mark Gruber, right?
Yep.
Yeah. Yep. Right. I get him and Gurman mixed up. Gruber basically saying it's sort of like it's the un-Johnny Ive decision that Apple would have never made under Johnny Ive's design leadership.
Yeah, they went with a thicker design, thick with 2 C's. They got a chunky. Let's get every kind
thick,
of.
or?
Yeah. No. Definitely not low-key thick. This is it's a 16-inch. This is the regular 15-inch model that's out right now. The new version, you're going to start at around 2,400. Let's see how high up I outfitted this one. I believe I was up to 6,000 for the one that I was outfitting before. So you can really go pretty whole hog on this thing. The idea is that it's a new, larger screen. It starts at $27.99. Sorry, that's really where you're going to go with the new Pro. 16-inch display, similar to the 15-inch in body, but really the big changes here are, believe it or not, the speakers are supposed to be dynamite.
Yep.
And changes to the keyboard. Now, you might be able to hear the keyboard on this. This is the older version. It goes, it's super annoying and loud. I don't know if you could hear that, right?
Yep.
You hear us constantly typing on air, and in the newsroom, it's a nightmare.
Well, I believe that people shouldn't be typing on air, but yes.
Hey, I mean, I don't. I just sit here and do this. But what they're doing is they're silencing the keyboards, and they're changing the way they're built. It's now a scissor design rather than the butterfly design. And that's going to not only improve responsiveness, hopefully kill any of those issues where little particles are getting stuck under the keys and people have to replace them, and then silence the keyboard.
Can they really silence the keyboard? You won't hear people tapping?
I mean, look, the thing is, we've all learned a lot about keyboard design. These keyboards are 50% shallower than the old keyboards. I can't get through typing anything on my laptop anymore without double spacing, which creates a period in a lot of applications, double clicking A and stuff. I use an external keyboard now because I can't use this anymore.
I still use
it's a disaster.
There's big changes. They added a physical escape key. They changed the buttons.
And I don't know how you do it because you.
Well, I bang so hard. I mean, I've killed my caps lock key.
Right.
My caps lock key has split in half a number of times, but the nice folks at IT just replace it for me.
Notorious keyboard abusers.
Our typer.
All right, so new, really expensive MacBook coming to all of our lives sometime soon.
God, I can't wait.
And
I'm ready for a new laptop. I would like one.
That's great. Dan Hallie, thanks for stopping by. Talk to you tomorrow.
Thank you.
Coming up here on the final round, delivery startup DoorDash is raising big money, but is it going to run into some of the same problems that have afflicted other tech unicorns? We'll discuss, but first let's take a look at how some big IPO names are trading in today's market. Delivery startup DoorDash has raised new funding, bringing its valuation to $13 billion. SoftBank-backed company, reportedly picking up a new cash infusion of $100 million. I kind of wonder about this one, Dan, because I think DoorDash has the SoftBank stink on it to some extent.
I'm surprised they took that money.
And I was thinking about the food delivery space. I wrote about this a little bit in the newsletter last week. With Uber, Grubhub, and DoorDash, there's just too many people going for too few eaters at this point, I think.
Oh, yeah. It is a fully saturated market, and it's hard to think that you can guarantee any of these will be the eventual winner. I mean,
well,
yeah,
Grubhub has
depending on the
been
area, one
profitable
is the
for
leader.
years, right? So, but they only play in their markets, and Dara Khosrowshahi said on the call, Uber's only going to play in certain markets. And so I'm curious, I guess, what DoorDash really wants to be after here other than scale and killing its competitors by undercutting them.
Well, that's what it would like, killing its competitors. But it's a very, very regional business. You know, depending on where you are, there's one app that is king. You know, in New York, I know DoorDash is already so big, and yet I only use Seamless. I mean, I've only ever used Seamless because I think there's a lot of, maybe brand loyalty is the wrong word. It's not that you have a love for whatever app you use, but once you're used to using one, you use it, unless there are examples where a restaurant is only available on a certain app. So for a while, McDonald's delivery was only from Uber Eats. So you would download Uber Eats because you were like, I want some McDonald's. Caviar made its name on partnering up at first with restaurants that didn't do delivery and didn't do takeout. And now you could do it on Caviar. Then Caviar kind of changed its thing, and it wasn't about that anymore. But yeah, it is a business that is kind of unappealing right now because there's just so many. It's so flooded. It's really, and there's no brand. I mean, what is the brand of DoorDash versus the brand of Grubhub or Seamless versus the brand of Uber Eats? There's no difference.
They're all playing in a commoditized space with hugely subsidized business models that basically are a handout to consumers.
And every restaurant agrees to partner up with all of them.
Right, at least for now. All right, let's move on to some more tech news today. Google may soon be adding a banking division to their company. The Journal reports the tech company is currently working with Citi to offer checking accounts, other banking features. Now, I see this story as, and I believe it was Bill Gurley, but it might have been another VC. I heard in an interview somewhere several months ago that no industry has quite ceded all territory in digital quite like financial services. The banks have basically done absolutely nothing to update their offerings. And I think that while this is being framed as, oh, Google's making this big push with the help from Citi, Citi is floundering. Citi's like, great, we would love to work with Google because we have absolutely no digital strategy. We saw this with Goldman working with Apple, and you can only imagine what the ramifications are going to be over the next 10 or 20 years.
It's a boost to both. The ramifications will be big. All these tech companies want in on banking. And you talk about, oh, well, what about concerns about your data and privacy? I don't think consumers care. I mean, imagine, our colleague Ethan Wolfman put it this way this morning. Imagine what Google did for email if it could do that for banking services. Make it faster, make it easier, make all your things play nicely and talk to each other. That's appealing. And, well, oh, I don't like the idea of Google having my banking data. People will get over that. And now you say they've done nothing to innovate. There is Zelle, which is the bank consortium version of Venmo, and has a little bit of, it's caught on with older people who trust the banks, who don't want a Venmo. They don't know who's behind Venmo.
Digital banking is getting your same paper documents on digital. That's it. There's nothing different.
It ain't hard,
There's
guys.
nothing different about the service. But I'm saying, like, they haven't innovated their offerings. All they do is they give you a digital PDF. Great, thank you. I didn't want my bank statement.
Well,
anymore.
and it's crazy to think how long it took some of them just to do that.
Right, and how often it works. All right, Peloton news here. The stock is surging right now. Bloomberg reports that it plans to introduce 2 new pieces of workout equipment next year in a further expansion beyond cycling. It's stock up 4%. Company working on a new treadmill that'll cost less than the $4,000 current model. It's also working on a rowing machine.
Outstanding.
Now, the rowing machine is interesting to me. The thing with the treadmill is they're using Woodway treadmills. And if you know about treadmills, Woodway is like top of the line. It's great. It doesn't have that big plastic thing on the front of it that you hit your toe on. It's a clean loop,
It's
clean band, I guess you could say.
infinity loop.
Sure. And it's a lot softer than other treadmills. I don't know. I'm like, sure, but I sort of feel like the Peloton thing is going more Nordic track than it is.
I was just
going
about to
like
say
the
to you.
new great big.
I was just about to say to you, A, love the idea of a rowing machine. It's a piece of equipment that I use when I go to the gym. Love the rowing machine. One of the few things you can do that does both cardio and muscle building. However, we're talking about a treadmill. They also have already the bike.
Yes.
We're talking about now a rowing machine. Now we're talking about a second treadmill. Wait a minute, aren't we just inching closer to an all-in-one machine?
There will be
It's going to
gyms.
become the Bowflex. It's going to be a Bowflex.
Or here's the radical thing. Related spins off Equinox. Peloton buys it and just rebrands all of the Equinoxes into Peloton.
Oh, makes great sense.
There you go.
You can go to your Equinox, and then how about throw SoulCycle in there? It all gets called Peloton.
Right. Yeah.
And you can go to SoulCycle or Equinox. The classes are there, and you can buy the bike.
We are available to take the banking fees for that if anyone would like to take us up on that idea. Coming up here in the final round, from launching GoDaddy to hitting the links with PXG Golf, Bob Parsons has just about seen and done it all. He will join us for a conversation about all that coming up right after the break. The Bob and Renee Parsons Fund has raised over $160 million the last 7 years for its Double Down for Veterans Match campaign and has a fundraising goal of $20 million just this year. Joining us now to discuss is entrepreneur Bob Parsons, founder of GoDaddy and the founder of Parsons Extreme Golf, among other ventures. So Bob, let's start with the foundation and your work there. Of course, you are working with the Semper-Fi Fund to support veterans. Talk to us a little bit about that push.
Well, what we're doing is the Semper-Fi Fund was originally called Semper-Fi Fund for Injured Marines, and we've since expanded it to cover all branches. And we help with PTSD when a young Marine or young soldier airman is wounded, and usually it's horrifically. We get somebody there, their family, to them, immediately. We get other service people there, and you got to get your ass back in duty, that sort of thing. And so what we do is we work on making the transition back to civilian life better. We help military families, and I tell you, brother, it's a wonderful thing. It's a daunting job.
That's right.
Well, let's talk about PXG, Bob. You're repping your brand here. The golf equipment business has changed so much. I mean, Miles is really the golfer here. I just like following the sport at the pro level. But, Nike got out, Adidas got out, so many, TaylorMade was sold off, and so much has changed for golf equipment. You guys make your clubs. You've got various golfers that are repping the brand. Why did you get in, when you got in, and how is it going?
Well, we got in because, first of all, we weren't going to compete with the other companies in. The golf equipment business is a tough business. Unit sales are down 23% since 2015. Prices are up a little bit, so revenue's flat. Thank us for that. But we got in because we're an innovation company, technology company, and the whole idea was we would spend whatever it took to make it an outstanding product, and then we'd put a price on it. As opposed to the way the typical golf industry does it, is they engineer to a price point. So we're different play.
So when you look at that strategy, and it's now 5 years since you guys launched, and you're still maintaining that price point. I mean, a set of PXG irons is going to run you more than $2,000, which is going to be, actually, Callaway's kind of catching up with some of the stuff that they're putting out. But when you look at that strategy, have you thought about changing what you want to do in terms of getting PXG into more golfers' hands by coming down the stack, as it were?
Well, no.
Okay.
In a word, and what is happening is other golf companies are trying to go up market to match what we're doing. Yeah. And it's always easier to go down market than it is up market. And so we haven't changed a thing. Now, we are trying to get our clubs in the hands of more golfers every minute, every day.
Absolutely, yeah.
And that's working for us. We just, we're on the Inc. 5000. We debuted as number 123. Our growth rate during the last measured period was 2,800%. So, it's a suggestion that what we're doing is working.
What do you make of the pro level right now? Miles and I are golf geeks, so you've got some guys that rep the brand, also some female golfers. How's that going, and who excites you in the sport?
Well, the people that excite me in the sport are the people that play my clubs. The rest of them I don't pay too much attention to. And we're pretty excited about a young PGA Tour player, Wyndham Clark. He is excellent. We have a guy we just signed. He's not on tour yet. He just came out of the Air Force Academy. His name is Kyle Westmoreland. His average drive is 355 yards.
That matches your veterans' causes as well.
Absolutely. And so, Bob, you obviously going back with GoDaddy, you've seen a lot of changes in the internet space, and we're talking here about the streaming wars. We're talking about what's happening at Facebook, at Instagram, at Twitter. When you look at the internet landscape right now from a business perspective, what stands out to you in terms of where the puck is moving to? We've seen in the stock market these SaaS plays have been on fire over the last couple of years, but really it's like the big entrenched tech giants continue to get bigger and bigger. What stands out when you look back at that space you were part of in the early days?
Well, it is, Google's always formidable. Microsoft is, I think they're coming back, more than they used to be. And Apple, well, still a force to be reckoned with. As for me, I'm building shopping centers. I'm selling golf equipment. I'm low tech these days, brother.
Bob, what is the domain name selling business these days? I mean, is that still a really good business to be in? There are obviously so many that followed GoDaddy's lead.
Well, I think when you sell a product that everybody needs and everybody's going to pay you every year for it, and it doesn't require any inventory, and you get paid in advance, I think that's an excellent business to be in.
Recurring revenue, baby. That's what the SaaS plays that we talk about.
It all is. All right, Bob Parsons, PXG, founder of GoDaddy. Thanks so much for stopping by. Good to talk to you. Dan Roberts, thanks for stopping by. We'll talk to you soon.
All right, thanks.
Coming up here today on the final round, we'll get technical with Jared Blickery just a few minutes before today's closing bell. But first, take a look at some of the trending tickers today right here on Yahoo Finance. All right, the Dow set for a record close. Disney powering the industrials higher. Jared Blickery joins me, the Wi-Fi interactive touchscreen. Jared, the Dow is the people's index, the biggest number, so let's just talk about that.
Yeah, we got it up almost 100 points. That is a record high, probably going to be a record close as well. We're not even going to the S&P 500 and NASDAQ Composite. Who needs support and resistance? Let's go straight to the heat map and talk about some of these stocks, because Disney just has a monster day. We've been talking about that one. But then you look to the left, those big cap companies, Apple and Microsoft, both at or near record highs just about every single day. Both of them combined as big as the entire market cap of Germany. I just saw that on Twitter.
There you go. And now I think what stands out to me in today's market action, so the other two averages, kind of a flattish day, but we have some of the recent leaders lagging just a little bit. We see JP Morgan lagging here. Healthcare is lagging. XLK, Intel lagging just a little bit. But really, it's the consumer names. Walmart ahead of earnings. Coke and Nike doing a lot of the lifting here for the Dow.
Yeah, and if you think about it, because it is weighted on points and not market cap, they got a lot of stocks over 200. JP Morgan is kind of low point, but it is at record highs. Goldman Sachs is over 200. Financials are in favor as long as yields are climbing, as they have been. Home Depot, 200 plus point stock that is pretty close to a record high. What's the worst performing stock in the Dow? I think it's Walgreens. And guess what? They might be out of the Dow. So they're just going to insert another company in there potentially. But yeah, a lot of strong stocks here. And that's why we see it as probably the leading index right now.
And I think just in general, when you look at today's market, that rotation trade, right, it remains broadly healthy, even if today isn't a bang out day for cyclicals.
Exactly. You got Apple, Microsoft, Nike, all the good guys.
All right, Jared Blickery live at the Wi-Fi Interactive Touchscreen. We'll talk to you tomorrow. Coming up here today, we've got the closing bell on Wall Street, plus Cisco earnings. They're due out after the closing bell. We'll have the numbers for you live when they cross. Welcome back to the final round here on Yahoo Finance. Miles Ludland with you in New York. I'm joined by Yahoo Finance Editor-in-Chief Andy Serwer. We are just 30 seconds away from the closing bell here on Wall Street. We are looking at a record close for the Dow if things hold up right here. The NASDAQ does not look like it's going to make it into green figures today. The S&P just near record levels. We'll have to see exactly where we shake out on the benchmark index there. But you're looking live at pictures from the New York Stock Exchange and the NASDAQ market site on this Wednesday. It's going to be a real barn burner for an S&P record. I know, Andy, with each record, the enthusiasm for this market builds ever more.
Or does it cool?
Well,
I mean, no, I think it builds. You know, it's a funny day, Miles, because the headlines belie what the indexes did to a degree, because you read the headlines and
Well,
it
we've
says,
got impeachment proceedings happening right now.
Absolutely, you've got impeachment proceedings. I mean, you know, a constitutional crisis in our country, conceivably. And then you've got trade deal hits snag. And you'd say, okay, with that, we're going to be down double digits, triple digits in the Dow, et cetera, down 1% or 2% across the board. But no, and that's mostly because of one big honking win stock today.
When America gets to watch Star Wars, nothing wrong can be happening.
Kind of do the theme.
That's right.
It's a little like, yeah, it was a little bit like.
You know what? I should have brought my trumpet.
Yes.
And we could have played it.
Or we could have brought Dan Roberts. It was like, pardon the interruption.
That's
I was
right.
going to start
That's
seeing like PTI, right?
Yeah.
Those guys.
Yeah.
But, you know, obviously Disney is a huge driver. And we can talk about that. It's a great story. And then Apple as well was looking good today. Both at record highs.
And you know, it's funny when you talk about that trade deal. Basically, the suggestion here is that there's a snag between the U.S. and China in terms of how many or the quantity, the value of agricultural products that the Chinese will commit to purchasing. And you were at the Economic Club of New York yesterday, where Donald Trump was very boastful about all the ag purchases that the Chinese were going to make as part of this great deal. And it does seem that while the market is so optimistic about this, there is a bit of a gap here between what it appears Bob Lighthizer and Peter Navarro and Donald Trump believe the Chinese have committed to and what, in fact, Beijing believes they've committed to.
There are various perspectives, and that's just on our side, to your
That's
point.
right,
I mean, never mind what the Chinese want. And by the way, you know, I was with some Huawei executives last night, and they were talking to me about the opacity of what the Chinese are trying to do and the fact that there's really just posturing on both sides. But I think, to your point, that our administration is not necessarily on the same page. And the president is obviously, let's just say, mercurial.
Yeah.
And yesterday at the Economic Club of New York, I thought he was rather standoffish when it came to how close we were to a deal. He said, we could have a deal. We're going to have a deal. We could have a deal. Now, that's a far cry from some of his other pronouncements that were much more optimistic.
Well, do you wonder, and I guess thinking about his comments yesterday sort of makes me think that while we all can vaguely agree that I think he kind of made up the phase 1, 2, 3 thing, right? He was just off the cuff, right? But now that he's latched onto that, phase 1 can be indefinite. Phase 1 could last forever. Phase 1 could have many movements, and it's actually beneficial, I think, to the administration to work inside of that framework.
Right.
You know, because it's like we're trying to get a deal. Here's our roadmap to a deal, but we still have to work out all these things. And in a sense, you can prove you've made progress by going nowhere.
Well, it's an unlimited outline. And the beauty of that is phase 1 of how many, and then to your point also, phase 1 part A, phase 1 part B. It's cynical, but I think phase 1 is the ag products, and I wouldn't be surprised if that does get accomplished within the next 10 months because it's nothing on either side.
Yeah.
The Chinese, they actually need some soybeans, and they can get them from Brazil, but it's better actually to keep these lines going, number one. And number two, President Trump would be happy to facilitate this and engender it because the farm vote is important in November of 2020. So it's a win-win. It's easy peasy for both sides. And, on the other hand, then if you start to get deeper, peel the onion another layer, do the Chinese want Donald Trump reelected? And again, talking to some Chinese executives last night, they said no love for him, less love for the unknown.
Yeah.
Right?
Certainly.
So very interesting from the Chinese perspective, not that they're about meddling in our elections, or are they?
Per se.
Right. Isn't that interesting to consider that how they basically handle themselves in the trade negotiations is essentially influencing our election.
Well, and I
Not
think,
like the Russians are, but in a different way.
I was going to say, I think the American populace showed itself capable of many different forms of influence just a few years ago.
Yeah.
And I think everyone in the international community certainly took notice of that. But let's go back to the stock market. And for more on today's market action, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Scott, record highs for the Dow and the S&P.
That's right, Miles. A record high for the Dow, especially coming off of the bizarre close we had yesterday when the Dow closed exactly unchanged. Now, that hasn't happened since April 24th of 2014 when the Dow was trading at 16,500. So that was about 70% ago over those 5.5 years. But for today, the gains in the Dow really driven by Disney. That was your best performing Dow stock. Nike and Walmart were the other big gains in the Dow as well. Now, the 7.5% gain in Disney stock, a good portion of that came in the last 2 hours of the trading session. By the way, Apple also up about 1% today, hitting a record high. The stock crossing $264 a share today, really on no news. Apple has just been on a tear over the past couple of weeks. Your laggards were names like Dow Inc., Caterpillar, and IBM, so you have some trade-sensitive stocks in there. And of course, we got some negative trade headlines at about 2 p.m. today. Now, outside of the Dow, we were watching Alibaba shares for most of the session. They ended the day down about 2.5%. Alibaba is listed here at the New York Stock Exchange, and it has been for 5 years, but recent news reports suggest that the company is looking at a secondary stock offering in Hong Kong, possibly as soon as later this month, and that could raise some $13 billion, guys.
All right, Scott Gamble on the floor of the New York Stock Exchange. We will talk to you tomorrow. All right, let's go to Goldman Sachs. Goldman Sachs saying it will introduce the ability for household members to share an Apple Card credit line after claims earlier this week of bias in its underwriting process. Now, the Apple Card previously had allowed individuals to apply for cards, but there was a controversy around some members of the same household getting different credit limits, specifically men being given credit limits that were in some cases 5 or 10 times in excess of what their female partners had been given. Now, both Goldman and Apple coming out with statements on this. The companies here trying to make this right. But I think, Andy, on the heels of the story today from the Journal about Google's ambitions when it comes to financial services, when it comes to how tech companies treat us as consumers, right? We are all, of course, just a collection of bits. Right. And I think in some ways that's new-ish to the banking sector. But for tech, there's been many issues with that, and they're okay with it. But on the consumer side, people are not okay with finding out that there's basically been gender bias built into the algorithm.
Yeah, and I think that's an excellent point, because when you talk about algorithms and all the problems we've had with them when it comes to Facebook and Twitter, et cetera, it really has to do with, say, social media and, oh, you'll like this, so you'll like that, and maybe your political orientation dictates we're going to send you these ads, which have led to some significant and serious social problems. But let's put those aside. When you get into banking and the like, you're talking about a regulated business. Number one, bad. Number two, when you start talking about gender bias, you're talking about a litigious minefield. Yeah. And you put those two things together, and it's not good. Now, you would think that a company like Goldman Sachs would not step in this. Having said that, they're not a consumer-oriented, a consumer-facing institution particularly. I mean, they've got legislation and regulatory stuff up to here, but still, this is a little different for them. I think it's sort of like it's a tiny perfect storm. Yeah. They're good at that, they're not good at that, and they go, whoops, whoops. But that's so funny. So you have a husband and wife, same balance sheet. Right. Same income statement. Right. But she gets a worse one. And so now they're just saying, okay, you're married, you're all the same.
Now it's fine. It would have been great if you had thought about that before. And I think this again goes to the challenges that both sides of this exchange, Goldman and Apple have when working together. Because Apple is obviously consumer-facing to the nth degree, but they view their consumers a specific way. Goldman has essentially no experience facing the consumer side. I mean, think of the Marcus checking account, but that's a different process.
Nascent at best.
And then I think, there's been tension, right, around the way that Apple advertised this card. They said it's by Apple, and Goldman said, well, by Apple. I mean, what are we doing here? And I think it shows how fraught these collaborations can be. And to me, it means that the loser is the financial services company, right? I mean, I don't think this is any skin off Apple's back in terms of reputational damage, but Goldman Sachs, gender discrimination, I mean, what more does that firm need? We're still living, to many consumers, in the post-crisis period.
Well, it's funny because both were clamoring to take credit for this, and now maybe they're, well, it's really the other guys.
That's right.
So that's number one. Number two, it reminds me, I talked to Warren Buffett a number of years ago about a joint venture that I was involved in at a previous company. And I said, well, it's a little tricky. And Warren Buffett said to me, he goes, I never do joint ventures. They never work.
That's right.
And I was like, gee, thanks.
Yeah, well,
and he was right. I mean, if you think about it, it's pretty tough to pull them off.
Everyone in a group project knows there's one person who does most of the work.
Yeah.
All right, little earnings here. Cisco just out with its fiscal first quarter results. Emily McCormick is live in our newsroom for the numbers. Emily.
Well, Cisco did beat on the top and bottom lines for fiscal first quarter of 2020 results, but we did see weak guidance. That's why shares are selling off in extended trading right now. Diving into those numbers, we saw first quarter adjusted EPS of 84 cents ahead of expectations for 81 cents. And then revenue was $13.2 billion versus $13.08 billion expected. Now, the street is focusing on that guidance for the second quarter. That came in light. So Cisco does see second quarter revenue down 3% to down 5%, far below expectations for a rise of 2.7%. That's consensus expectations on Wall Street. It also gave guidance for adjusted earnings per share of as much as 77 cents. That was also below expectations for as much as 79 cents. Now, Cisco's earnings results tend to be a bellwether for two major trends. Number one is capital expenditures on tech infrastructure, and then second are trade war impacts on major companies. On both of these fronts, we are seeing Cisco guiding below expectations. So one of the things that Cisco reported was that its revenue in its Asia Pacific, Japan, and China segment, that's about 15% of total revenue, that was down by 8% in the first quarter of 2020. We also saw in its infrastructure platform segment, that's its biggest contributor to revenue, and that's where all its networks, switching, data routing packages, that's where all of those sales come in. That was down 1%. So a bit of a mixed result for the first quarter and seeing that weak guidance, and that's why shares are selling off in late trading here. Miles?
All right, Emily McCormick in our newsroom with Cisco's latest quarterly results. Stock not happy about this. Shares down 4% right now. You know, Andy, looking at the release here, you've got Chuck Robbins coming out and saying challenging macro environment. So trying to talk up the results, but certainly that guidance guiding to margins that are going to be lower than what they saw in the most recent quarter, and then a surprise decline in sales. Not a great picture for the company right now.
Yeah, and they have lagged. I mean, they had a good 5-year record, but all that came in the first 3 years of that 5 years, if you follow. So particularly in the past year to date, they've been suffering, they've been lagging the market, you know, which is maybe surprising, but as Emily McCormick says, you know, they've got the trade war and they've got, you know, CapEx concerns and softening and around the edges. And we had a harbinger, which you used with bad news, the harbinger, with Arista Networks a couple days ago. And they were saying, you know, we got some softening demand from one of our end users, one of our customers. Maybe it was Facebook, maybe not. But, you know, when that sort of gave us a clue, and sure enough, you know, these guys came in a little light, and the tall man from Georgia, Chuck Robbins, will have his hands full getting this ship right.
And, you know, Cisco, I think like many tech giants out there, CFO Kelly Kramer saying the company remains in the midst of its transition to subscription. So 71% of revenue is now subscription-based. A big change for Cisco. Many companies have gone through this transition, but along the way there, you know, still caught up in shifting CapEx plans from companies. Because, of course, the theory being, if you are subscription-based, you won't get cut out of next year's budget, or your project won't be delayed in quite the same way than if you're a one-time CapEx outlay rather than an OpEx part of another company's balance sheet. You can be a little bit stickier, but that transition still ongoing over there at Cisco, and the stock down 4% in after-hours trading. All right, coming up here on the final round, fund manager George Young will join us to talk about two stocks that he's betting big on right now in this market. As we sit at all-time highs, we are back with that right after this. markets closing at a record high today with Jay Powell testifying before Congress that rates are likely not going higher as long as we sit in our current period of economic expansion. Joining us now to discuss all things going on in markets right now is George Young. He is portfolio manager at the Villere Balance Fund. George, good to talk to you again. So let's talk a little bit about how you see the market right now. We've got another record close for the Dow and the S&P. I think there's been quite a bit of enthusiasm when it comes to the trade outlook. Do you share the market's enthusiasm that we've really seen come around in the last couple of months?
I think I do. I mean, what happens is investors really have three choices. They can go with cash, they can go with bonds, or they can go with equities. And we know right now cash is yielding a paltry 1.3%. 10-year government bonds, they're very safe. That's wonderful. But again, they're at about 1.8, 1.9%. The stocks yield about that same amount. So you can take, some people might say, a flyer on buying stocks. But again, that's a pretty good alternative nowadays because you know you'll get that yield on good stocks and you'll continue to have some expectations of growth because earnings are pretty healthy. The economy is pretty strong right now. So I think the default is you want to keep money in stocks. Yes, I agree we're at all-time highs, and that does give me a bit of concern and a bit of pause. But again, there are always opportunities in the stock market. You do need to be a bit selective.
But George, just to follow up on that a little bit, does it strike you, given that the 10-year yields the same as the S&P 500, is something askew there? Because shouldn't it be the case that stocks should yield less? So does that suggest one is either way overvalued or way undervalued?
Well, I think what you're going to see is that the economy is going to continue to strengthen domestically. And again, that's in stark contrast to what's happened in the rest of the world, because as we all know, we've got negative yields the rest of the world. So I think that's where the disconnect lies. And in due course, you're going to see treasuries, the yield in treasuries go up, which means, believe it or not, bonds will go down in value. You've sort of seen that in the last 4 weeks or so, because we've had a pretty abrupt move in the 10-year, and more abrupt is more pronounced in the 30-year, because that's where the volatility lies. So I see that as an opportunity. Again, it's all based on the consumer and the domestic economy, and that's going to be what drives the stock market. Healthier earnings means that you have healthier dividends, so you should see dividends increase over time.
George, speaking of the consumer, I want to talk about one of the names that stands out to you right now. That's First Hawaiian, smaller regional bank. I mean, we've seen, those names, part of that Russell 2000 regional banking index, get picked up by the broader market from time to time. When you look at a name like First Hawaiian, what stands out to you in terms of that thesis right now?
Well, a couple of things. One, you've got a lot of government employees because of the defense contract, because of the State Department, the armed forces that are over there. You've got healthy tourism. You've got generally good weather over there. And you've got a lot of people that are flocking to move over there. So all that conspires to mean that you've got a healthy economy. And again, buying something like First Hawaiian is a proxy on the health of the economy. So in our fund, Villere Balance Fund, it represents about 3% of the investments that we have in stocks.
Hey, George, you sound like you guys are real kind of bottoms-up folks, as opposed to just set it, forget it, buy the FANGs or, the OEX or something like that, right? I mean, you guys like to do that fundamental work?
That's true. And also we're long-term holders, which kind of goes hand in hand, I think. And the important thing to remember is that over the last 20 years, stocks have appreciated about 6% per year. And if you miss the best 10 days, that's going to drop your performance to about 3% per year. So again, long-term holders, we're somewhat concentrated. We're bottoms-up investors. We tend to hold stocks for something like a 5-year period. So First Hawaiian fits perfectly into that theme.
All right, George Young, portfolio manager at the Villere Balance Fund. Good to talk to you. We'll talk soon. Thanks for coming on.
You got it. Thank you.
All right, coming up here on the final round, we'll have what we're watching tomorrow in the look ahead. We're back right after this. All right, now here's a look at some of the stories making headlines on Thursday. Well, Disney Plus announced on Wednesday that 10 million people have signed up for the service since its Tuesday launch. This is a big number. Analysts, for example, had expected the company to add 8 million subscribers within a year, not within 48 hours. So while some users had issues with the service on Tuesday, the overall sub numbers mean this launch is a home run. But now the hard part for Disney begins, because a streaming service is about a lot more than just putting some stuff on the internet to watch whenever you want. A back catalog will power a streaming service until, of course, it won't. And really, succeeding in streaming means you have to play by the internet's rules, not the rules of cable or broadcast or the movies. Buying the bundle, watching the game, seeing the movie in theaters is not enough to define success in the streaming world. In streaming, as on the internet, you need to have consumers increase engagement over time. You have to have consumers thrilled into new niches they didn't know they wanted to be in, and have viewers watching more of what they want, when they want, where they want it. Disney, of course, knows that all of this is true, but it's no longer just fodder for board meetings and earnings calls. This is Disney's new reality, and soon many rivals will join them with new streaming services. And then the content world will know that success on the internet is way more than just getting customers to sign up. It's something that Netflix has been trying to tell investors for years, and I'll guess we'll find out if the market is ready to learn this lesson. Now, turning to the calendar for Thursday, on the earnings side, Walmart earnings before the open will be the day's biggest highlight. This report, of course, giving us a key check on the U.S. consumer ahead of the holiday shopping season. Other notable reporters due out on Thursday should include NVIDIA, Applied Materials, Aurora Cannabis, and Canopy Growth. And then on the data side, producer prices for October and the weekly read on initial jobless claims will be the highlights. All right, coming up here on the final round, being a friend of Jay-Z's has its perks, and being a friend and a VIP for his charity gala is a whole nother level. What Hove gifted his fundraising friends, we'll have that right after this. Jay-Z trying to give VIP a whole new meaning. Now this one, of course, really, Andy, it's for our executive producer, Praz Subramanian, big watch guy himself. So Jay-Z sent Rolex watches to the VIP invitees to his foundation's gala, as well as bottles of Ace of Spades champagne. But it wasn't just a Rolex, right? Swizz Beatz posted a photo on Instagram. This is what I am calling the Jay-Tona. So in Rolex circles, the Daytona watch, I forget what the exact movement is, but it's got the 3 dots, you know, on the face, the whole chronograph situation. These guys, you know, they retail for $12.5 grand if you get the rose gold one, up to 40 grand. But the price of the Daytona doesn't matter. The thing is, you can't go into a store. You can't even go to a dealer and just get one. They don't exist. You've got to trade. You've got to know a guy who knows a guy who knows a guy. But apparently Jay is just sending them around to his friends because why not?
He knows a guy, right?
Certainly does.
I mean, do they do customs like, you know, Patagonia used to?
Yeah.
Do vests for, like, you know, Kleiner Perkins, right? Is this like, this is a special edition just for him, or is it a limited edition that he basically got?
Based on the picture, it didn't appear to have any. So like Domino's did a Rolex a couple years ago. That actually had a Domino's pizza. Yeah, it was. I think it was.
That seems like a mismatch, doesn't it?
But you know, those are coveted. Those are coveted
I bet they are.
by collectors.
Make a pizza get a Rolex.
It does not appear to be a custom Daytona per se, but this picture is a little bit distant. It was gold, so it could just be a regular, gold bracelet. It appeared to be an oyster bracelet. So I don't know if it's an Everrose
work on his
gold
filter
color
here
or
with that, right? When he's taking his picture, I don't know which filter he used on his Instagram.
Hey, if I got a watch that probably retails for 40 grand, but really has resale value of 3 or 4 times that,
well, yeah,
I think I'd keep the picture. I think I'd keep the picture out of focus as well.
Yeah, right. Okay. Fair enough. Touch it and it's worth a lot more.
There you go. So there's the chronograph. I think that's the Panda.
That's too many dials for me.
It's a little much. It's
Cross. Why does he need all those dials?
There's a name on Wall Street for the kind of guy who wears this that we can't say on air, Andy, but you know what it is. Coming up here, we'll have more on the final round. Plus, we'll head to D.C. for the latest on the impeachment inquiry. We're back with that right after this. Welcome back to the final round here on Yahoo Finance. Miles Sullivan with you in New York. I am joined today by Yahoo Finance Editor-in-Chief Andy Serwer. Let's take a look at where the markets finished today. You are looking at new records for the Dow and the S&P. S&P just kind of eking out a record close here, about a point ahead of its prior record, 3094.04. The Dow, a little bit more forceful to a record level, closing in, slowly but surely, on 28,000 for the benchmark index. Of course, a lot of Dow's gains today, or the Dow's gains today, can be attributed to shares of Disney. Let's take a look at that stock, up over 7% today. The company coming out and announcing that 10 million folks had signed up for Disney Plus. Andy, we've talked so much about these streaming wars, what they would look like, and now we kind of know. It's Disney coming quite strongly out of the gate. Netflix shares falling in kind on this news.
It's a big day for Disney, and it's a big day, as you say, for this business, because to me, it's really a demarcation point. And, just doing the numbers back in the envelope, this is a $20 billion day for the Walt Disney Company, and to Bob Iger, kudos to you. It took a lot of time. They figured this out. You can read the stories about how they figured out and saw that the business was declining, cable cutting, cord cutting, and all that. And so they execute this thing, and in a matter of 24 hours, they built what other companies like CBS, like Netflix, like HBO took years to do. And so I think this is a real validation. It's a super big deal. It sort of just says to investors, okay, Walt Disney's going to make this transition. There's going to be fits and starts. Maybe the stock's down tomorrow, but we're off to the races here. And, you know, it shows that legacy companies can make this transition, in particular this company.
And you know, you were mentioning earlier in one of our breaks about the way that the stock reacted to the Lion King's debut. And in some ways, is this, I guess, in your view, one of these inflective points in Disney history where, you know, certainly people knew the Lion King was coming out, but the reception that it got set the company on a new trajectory for the next couple of decades that I think we're still in. Is this perhaps one of those watershed moments in the history of a company that's had many?
It very much harkens back to that. I'm glad you brought that up, Miles, because when The Lion King came out, it was just this movie project no one really knew about. Remember, you know, Disney had the old animation movies, the Snow Whites and all that, and then they had these sort of hokey live action movies from the 60s and 70s, which are now part of their package, and they're kind of funny and cool. But animation, they hadn't made an animated movie in years. And so they made this thing, The Lion King, and holy smoke, it was amazing, and it was a huge hit. And it was, to your point, it was an aha moment. Wow, this is a whole new line of business. And I think it's very much similar to what happened today. Like if they had only gotten, you know, 300,000, still pretty good. Right. I mean, my goodness, but this is like, holy cow, right? This company has got scale, it's got muscle, it's got know-how, and this is another possible leg up in the history of this company.
Yeah, and certainly, you know, you can do the quick math there, right? $20 billion in value on 10 million subscribers. Quite a value the market is subscribing per subscriber. And of course, it's not a perfect comparison, but a lot of value in each of those subs.
And there's more to come. And of course, yeah, there's free trials and all that. And just one quick side note, actually, on one of their big competitors, Apple, the stock up today, maybe various reasons, but maybe also because of the news that possibly Richard Plepler is going to be doing a development deal with this company. So, you know, he is a maestro when it comes to developing and creating and distributing content. And so this is another possible, you know, salvo in the streaming wars. So it's really getting serious, folks.
Yeah, certainly. Time's changing very quickly. A story that we have not really talked about today was some testimony down in Washington. It wasn't just Jay Powell. It was also the first day of the House impeachment inquiry. Pretty significant stuff today from top U.S. diplomat to Ukraine, Bill Taylor. For more on everything happening down there in the Capitol with respect to impeachment, let's go to Jessica Smith live in D.C. Jess, what's the latest?
Well, that hearing lasted about 5.5 hours today, and some of the most compelling testimony came from the acting ambassador to Ukraine, Bill Taylor. He said it was his understanding that aid for Ukraine was being held up, as well as a White House meeting, until Ukraine publicly promised to investigate the Bidens and the 2016 elections. He said he found that very alarming. And then, in what was likely the biggest piece of news from this hearing, he said that his aide was with the ambassador to the EU, Gordon Sondland, when he received a call from President Trump. So Sondland and President Trump are talking, and President Trump is asking him for an update on those investigations. Sondland said that Ukraine was ready to move forward. And then here's what Taylor says happens next.
Following the call with President Trump, the member of my staff asked Ambassador Sondland what President Trump thought about Ukraine. Ambassador Sondland responded that President Trump cares more about the investigations of Biden, which Giuliani was pressing for.
So Chairman Adam Schiff followed up on that because that was a new piece of information that Ambassador Taylor hadn't shared before. He said he wasn't aware of it when he testified before the committee behind closed doors. And Taylor clarified during that questioning that, yes, Sondland was saying President Trump cared more about the investigations into Biden than he did about Ukraine. Now, Republicans really fought back throughout the entire hearing, saying that most of this testimony is secondhand information, it's hearsay. But it's important to note someone like Mick Mulvaney, the White House chief of staff, could provide firsthand information, but he's defied a subpoena to come and talk before the committee. Republicans also say they want to hear from the whistleblower that started all of this. President Trump just said a few minutes ago that he wants to find out who the whistleblower is. He's told reporters that he was not watching. He said he didn't watch for a minute today because he's been busy working, but we should note he has tweeted a lot of videos from the hearing today. He is speaking to reporters now, and he again called it a sham, going on about this impeachment investigation that he says is politically motivated. We'll be sure to keep you updated if he says anything else newsworthy throughout this press conference.
And I'm sure he won't miss Hannity tonight for anything. So we know he'll be all caught up after that. Jess Smith,
definitely.
live in D.C. with the latest. All right, coming up here on the final round, he put fracking on the map, the larger-than-life figure that was Aubrey McClendon. His wild story comes to life in Yahoo Finance's Illegal Tender podcast series. We'll talk to Ethan Wolfman and Bethany McLean about their work right after this. Yahoo Finance is out with a new podcast, Illegal Tender, that dives into the mysteries in the business world. Season 1 focuses on the rise and fall of businessman and energy executive Aubrey McClendon and the eternal question, can fracking actually make any money? Joining us now are the hosts of Illegal Tender, Yahoo Finance's Ethan Wolfman and Bethany McLean, Vanity Fair contributing editor. So, Bethany, I guess for folks who don't know McClendon, and I'd be surprised if too many of our viewers haven't heard of him, but when you think of Aubrey McClendon and the legacy he left, to you, where does it stand at this point, from this vantage point in the fracking kind of revolution?
Well, so Aubrey is one of those great characters that come along every so often in the business world, right? Like a master salesman. I was told this story by a source at the very beginning. He said, I didn't trust Aubrey. I didn't believe in his business model, but I never let him into my office for a meeting, because if I had, we would have bought a ton of stock and it wouldn't have ended well. And Aubrey was the guy who really pioneered one of the critical elements in fracking, which is money, raising capital. He didn't pioneer the technology, but he's the guy who convinced investors around the globe to hand over literally tens of billions of dollars. And that's the key ingredient in fracking, is capital. And so that to me is Aubrey's legacy. He's the guy who brought capital to the
Wall
fracking
Street
industry.
to the business
Yes.
kind of way.
Yes, he brought the money.
And then I guess, Ethan, you know, the story of Aubrey McClendon has a tragic ending, and I think there was many things that happened towards the end of his career that people remember before they remember his wildcatter phase. I mean, as you researched this story and developed this story, what to you stands out about the Aubrey legacy as we kind of understand it today?
And what's so interesting is that his whole career in life is this perfect parabolic arc, obviously with a bit of that in the middle. I mean, he failed and then unfailed and then failed again.
Yeah.
But what's so interesting especially is how his personality, I think, kind of drove the entire story. A lot of fracking, and Bethany especially can speak to this, is built potentially on something maybe similar to an Emperor's New Clothes kind of thing. It's not clear whether fracking can even make money, but because he was so charismatic as this individual, and because he gambled his own money anytime that he played one of these games, that that to me is probably the most interesting part of this entire story.
There's a great line, right? F. Scott Fitzgerald, there are no second acts in American life. That couldn't be less true in the business world, and Aubrey's one of those characters who proves how untrue it is, because he had a second act and a third act.
And his company, Chesapeake Energy, right? And I want to follow up on that a little bit because, Bethany, I know this is a point that you're keen on, and it's somewhat controversial that fracking isn't really all that it's made out to be. Right. I mean, a lot of people think, wow, this is an American energy revolution. This is a great thing that's happened.
Gas prices.
Freedom molecules.
Right?
The Trump administration calls them freedom molecules.
Right.
Well, look, it's this whole august idea of American energy independence that politicians on both the left and the right have been talking about since the 1970s. The idea that we don't have to rely on those messy places in the world for our energy needs. But it's not clear how much oil and gas America would be producing if the capital markets dried up, because these companies don't make money. They're dependent on a continued stream of financing. In a way, it's a Ponzi scheme. And so it's just not clear what happens to this much vaunted revolution if the capital goes away. But the second part of it is the whole concept of energy independence is pretty fraudulent when you think through it. Back in the 1970s, when the Texas Railroad Commission set the price of a barrel of oil, it meant something. Now, today, when the price of a barrel of oil is set on global markets, and when our economy is driven by imports from Asia, which depend on the Middle East for there's no such thing as energy independence. It's a meaningless concept.
I think kind of adding to that, an idea that I think you said came from Charlie Munger, him saying, well, okay, maybe we have a ton of gas and oil, but why would we want to spend all of that first? Wouldn't we want to just use everyone else's and then have ours?
Yes.
I think that's a really interesting point.
Can I ask you guys one thing, too? I mean, I don't know if we want to give this away, but like there's this mystery at the end of the story, right? Or maybe you just tell what the mystery is.
So, yeah.
Yeah. Well, I mean,
is his demise.
I mean, he dies. I think that we can spoil it for everyone that he dies.
But there's some ambiguity, I guess, around the exact cause. I mean, I remember when the story broke. It was like, oh, I can't believe that happened that way. But did it? I guess is it as clear cut in your mind after the story?
Well, look, on its face, it's hard to argue with, the circumstances. He was driving extremely quickly, not intoxicated, and smashed his car with no, brake marks against the side of a bridge. Now, comes immediately following him being indicted by a grand jury.
There's that point too.
I mean, those things have a pretty strong suggestion in there. But I think Bethany convinced me that it's really not clear. I really have no idea. There's a lot of good reasons to think that it could have completely been an accident because this guy was crazy.
Right. The indictment would have cost him everything. It wasn't just an indictment. He'd secured many of his loans with personal guarantees. One of the things I love about Aubrey, and I actually admire in a sort of Titanic kind of way, is that this is not a guy who used other people's money. I mean, he used other people's money, but he used his own too. He risked everything time and time again because he was such a believer. And I have, there's an admirable quality to that, right? So he would have lost everything had he been indicted. But on the other hand, he's a guy who lost everything several times before, and that never seemed to stop him. And people who were with him in the days leading up to it said he showed no signs of any kind of stress or any kind of that anything was different. So I don't know. It remains a mystery.
All right, well, you can listen to the full story of a legal tender, Aubrey McClendon, on Apple Podcasts. That's a new product out from Yahoo Finance. Bethany McLean, Ethan Wolfman, thank you both for doing the story and for joining us today.
Thanks.
All right, a little bit of an alert here. WeWork reported a net loss, of $1.25 billion in the third quarter. That eclipsed sales at more than doubled.
Oh, another podcast. I feel like
who would have thought that WeWork had
you guys
horrific
have your next story right here.
This is according to Bloomberg. So these losses doubling from the same period the prior year. Revenue in the third quarter, $934 million. Now, that was about double. It was up from $482 million. In the prior year quarter, but this all coming, accelerating losses vastly exceeding revenue as the company was trying to go public. It of course seems, everybody, like, of course, and Ethan and Bethany are still here. It of course seems like people saw these documents and said, boy, I don't want to buy this thing at all.
Yeah.
Illegal tender.
sure.
Season
I know,
2.
that's why we're keeping you here, because we're going to start your new project.
Definitely illegal tender. I mean, the idea to me, I just can't get over this. I don't think Adam Newman did anything wrong. Well, I'm overstating it a little bit for a fact. But the fact that Goldman Sachs and JP Morgan and the people who are supposed to be the watchdogs in our system let that prospectus go out the door without saying, I just,
But isn't
I
this a
can't-
common
I can't-
denominator with Aubrey
can't get-
McClendon, right? And it's
completely.
Wall Street greed. And okay, sometimes they're smart, sometimes they're fearful, but sometimes they're greedy.
And
in this case,
sometimes they're incredibly cynical, and they
Right.
think that they can take this thing, this piece of junk, and pass it off on investors and make their fees. And it makes me angry.
it galls you.
It galls me.
Adam Newman, great American success story.
I mean,
Get to it. You guys
I
got
think so. All right, Bethany McLean, Ethan Wolfman, Andy Serwer, thanks everybody.
Thank
Talk to you guys soon. Coming up here today, we'll have more from Fed Chair Jay Powell's testimony down in Washington before the Joint Economic Committee. We're back with that right after this. Fed Chair Jay Powell spoke on Capitol Hill earlier today, taking on a whole range of issues, including the economic outlook, the future course of additional rate cuts, as well as income and wage inequality. Powell also addressed a hot-button topic of the growing budget deficit and how it could hamper fiscal policy in the future.
We're going to have to get on a sustainable path. What does that mean? So the debt is growing faster than the economy. It's as simple as that in nominal terms. And that is, by definition, unsustainable. Ultimately, you will have to get it to where the debt is not growing faster than the economy. And it's growing faster in the United States by a pretty significant margin. So even with lower rates and even with decent growth, there's still going to be a need to reduce these deficits. And I would say, by the way, that's a need over time. You know, we're not in the business of advising you when to do that or how to do it. But it is inevitable that over time we will have to do it. And you know, frankly, if we don't do it, what happens is our children will wind up spending their tax dollars more on interest than the things they really need, like education, security, health.
In the past, you've mentioned uncertainties in the area of international trade as imposing something of an economic headwind for us. What, after we've had over the last couple of years a lot of trade measures going into effect, what has the Fed learned about the interaction between trade and monetary policy?
So the first thing I need to say is we should never be heard to be commenting on trade policy. It's not our job. We try to stay in our lane, but our lane is the economy. But we don't have any view at all, and we wouldn't express one on trade policy itself. Our lane is the economy. So in principle, anything that affects our ability to achieve our mandated goals is an appropriate subject for monetary policy. So we've been hearing now for a year and a half from companies, and I think this is fairly widely accepted now, that tariffs, but to an even greater extent, uncertainty around future trade policy is, for now, it has been weighing on business sentiment and is probably part of the global slowdown in manufacturing, in business investment, in exports, in trade. Part of the story. There's a much bigger story out there, but it's a part of that.
I see my time's expired. Senator Klobuchar.
Thank you very much, Mr. Chairman. Thank you to you, Mr. Chairman, for being here today. Some of the issues that I was going to raise have been discussed, the challenges ahead with our economy, including the deficit, which I will note was greatly exacerbated by the last tax bill, and as well as problems in some sectors, such as agriculture, which is very important to us in the Midwest. But I wanted to focus on a third issue I have, which is income inequality. And even if people have jobs, it's often hard for them to afford things. And then you have the added problems and strains. Washington Post reported this year in September that income inequality in America is the highest it's been since the Census Bureau started tracking it more than 5 decades ago. The top 1% have experienced income growth of over 200% in the last decades. And between 2007 and 2016, the median wealth of lower income families fell by 42%. In your opinion, will widening inequality lead to lower growth expectations over the long term? And what should we be doing about this?
So I guess I would start by saying that I think we probably would all agree that prosperity should be as widely shared as possible. And so I would just point to 2 aspects of the broader problem that I think are important and need attention. The first is just the relative stagnation of incomes below the fairly high part of the distribution. And that's even after allowing for taxes and benefits and things like that. That's one thing where we want to see incomes moving up broadly across the income spectrum. The second is mobility. I think you want to see people moving from the bottom to the top, and vice versa, by the way. It has to happen just as a matter of arithmetic. So, for example, the bottom 20%, what are the chances that if you're born in the bottom 20% of income or wealth, you'll make it to the middle 20% or the top 20%? The United States actually lags most other wealthy countries in that measure now. This is very much not our self-image as a country, and those are things we need to address. So I think those are important.
That's one. And I think increasing the minimum wage, I have my own views on this, would be helpful. But as you talk about that, one of our challenges right now is hooking up our education system with the jobs that are available right now and making sure everyone has access to those jobs. And I don't think it always means a 4-year degree. Some of the fastest growing job areas are 1- and 2-year degrees. I think we're going to have 64,000 or 74,000 openings for electricians. And one of the things I'm really focused on is apprenticeships and trying to make it easier for people to access those kinds of degrees. Could you briefly talk about that?
We just met last week with 6 people who run apprenticeship programs and funding of apprenticeship programs around the country in our boardroom, and I have to tell you, it's very, very impressive what they can do. They're focusing on low and moderate income communities. They're getting them in high schools and out of high schools and matching them up with employers who need those people. They're getting good jobs. It's really working. And the thing that limits their ability to do this on a much wider scale is funding. So,
exactly.
Yeah, it's very impressive what they can do.
I think a lot of this is how we use our resources for education and matching that up. I'll ask you in writing a question on retirement. I just think it's becoming such a challenge in our new economy and Senator Coons and I have a bill to address that called Up Savings Accounts, which I think is a great idea for small and medium businesses. But my last thing is back to the income equality very briefly. How would reporting economic statistics by income bracket benefit our understanding of the economy? We don't have that right now.
We're actually doing something with that at the Fed. You know, we like to cut data up and look at it in new ways, and this is one of the things we're doing is combining a couple of data sets that we had. We're quarterly publishing a distributional financial account.
And when will we get that then? By the next?
The next one comes out every quarter. So it's a new thing that we're doing. And again, it's just a combination of 2 existing data sets that we have. But we think it's an interesting insight into the economy. There are a lot of different ways to look at what's happening in the economy, and that's an important one.
And we'll be right back after a quick break. final look at where the markets finished on this Wednesday. Record highs for the Dow and the S&P. Of course, Disney, the big story today. That stock up more than 7% after a successful launch of Disney Plus. We'll see where the market shakes out tomorrow. For now, that's it from New York. I'm Miles Udland. This is the final round on Yahoo Finance. Don't miss it. Tomorrow, we will have coverage from the Paley International Council's Summit live here on Yahoo Finance. That's starting at 10:45 a.m. Eastern. We'll have all that for you tomorrow. But for all that today, that's it tonight. Everybody, see you later. I'm Miles Udland. This is the final round on Yahoo Finance.
Not a lot of action here in the pre-market. What are you expecting from today?
Well, today we don't have a whole lot of economic data in the U.S. We're coming off of yesterday was a non-trade day in fixed income, but I think, we're expecting continued upward pressure on yields here going forward. The market has really been set itself up going into this year for a kind of very late cycle environment. And I think that the news that we've gotten around growth stabilizing in the U.S., growth stabilizing in Europe, what the Fed has done, that they're going to stay easy, changes that environment. And I think the markets realize that we've now, it's not a typical late cycle environment. We've actually got a couple of years probably runway here as the Fed has turned easier. And so the market's readjusting back higher in yield in our view, and probably will continue from here.
James, what's likelier into your end, a melt up or a pullback off of this action? I mean, the market can't go up every single day.
It depends on a few things that are yet to come, including a conversation President Trump will have with the market today at noon here in New York at the Economic Club, where he may signal his intentions to either accommodate or push back on China with the tariffs. That is one of the major risk factors in the market now. Beyond that, it's going to be economic data, as Rob said. That's an input for the Fed to determine how they communicate to the market their intentions. The biggest two risk factors to the continual growth of the market are China and the Fed.
Given those two things, how are you positioning your portfolio right now? What are you telling clients?
I'm very cautious. I'm not looking beyond the 2020 election. I think it's very important to recognize that we have had an anomalous participation in the market since November of 2016. And should this presidency end or shift, it's going to really, really change the dynamics of the market. And so we're really focused on the next 11 months. And we're saying stand pat. Market internals are good. The Fed has signaled that there's no necessary course of action, and it really just depends on the turmoil in China and Hong Kong as well. Not the turmoil in China, the turmoil around the tariff and then the Hong Kong protests. Those are the two major risk factors. And so any flare-ups there, we could see somewhat of a volatility in the market. But otherwise, I think it's a calm seas ahead.
You know, as a player in the fixed income market, are you worried about ballooning deficits? We had a guest on yesterday suggest that the market might start to fixate its attention on that. We're approaching, what over $1 trillion?
Yeah, well, the growth of debt is phenomenal relative to where we've been in the past in terms of the government deficit. So that's certainly a relevant factor here. But as long as rates stay, relatively low, that it shouldn't cause a big problem for the government. And it's not one of the near-term drivers from our perspective.
Rob, you say that you believe overall investors are too bearish on growth right now. So then what should they be thinking?
So investors have been worried about the inflation risk in the U.S. So if we step back, since beginning of 2018, the global economy has been slowing. A big part of that is that taking all the fiscal boost that we got in 2018 out of the system, plus the things that James mentioned, the trade issues, Brexit, geopolitical issues. In our view, we were always slowing towards a sort of potential rate of growth, and I think we've gotten confirmation now that we're not going to recession. We're just going to grow at potential, which is around 2%, let's say, in the U.S., slightly below. And in our view, also, a lot of these risks have been priced into the market. So the trade risk, the Brexit risk, and there's the potential for good news. We think Brexit is going to be better news than we feared. We don't think there's a U.S. recession. So in our view, the investors have been positioning for this late cycle and now need to rework. I mean, if you go back and think about what investors have been doing this year, they've been buying duration, selling equities, right? Investor fund flows have been negative in the equity space, positive in the fixed income space. Even within fixed income, selling bank loans, buying, duration assets. And if we're not going into recession, if we are going to extend the cycle, we probably have to reset some of those trades, in our view.
Jared, I know we're pushing up against the opening bell, but what are you seeing regard overseas action right now?
Well, a lot of green here. We see in Tokyo, the Nikkei, and in Korea, the Kospi up about 0.8% each. In Paris, CAC 40 is up 1/3%. DAX is up 1/2. London's up about 1/2. And here in the U.S., we're just barely green here, about 7-8 basis points, 10 for the NASDAQ. And there's your opening bell.
Yep, there we have a new trading day underway with the Dow Jones Industrial Average going to open up about 18 points higher. There's this new survey out, Bank of America surveys its fund managers. 61% of investors surveyed expect the global 2- and 10-year yield curve to steepen in the next year, the highest level in 3 years. What does that tell you, if that were to come to pass, about market psyche?
I think the market psyche is varied. Rob's comments about the rotation out of equities into bonds is turning around the other way now that the Fed has lowered interest rates and that concern about potential contraction in the markets, it's subsided. And so I think any indications that we get that there are differing opinions, I think is being shifted to more of a positive outlook right now. And so I don't really take that input as something that would give me any indication that we aren't going to continue to grow in the markets.
By all indications, the Federal Reserve will stand pat on interest rates, at least for the next 6 months. What does that mean to fixed income?
It means that I think we would agree with that Bank of America survey. It means steepening yield curves. I mean, what the Fed has told us is they're not going to raise rates unless they see a significant amount of inflation. So if it plays out the way we expect with reasonable growth, the most likely path is that we get some inflation pickup, and that would spur the Fed to eventually raise rates, but that's quite a bit in the future. And as inflation picks up, you would get a steepening of the yield curve. That would be a natural thing to happen.
Speaking of inflation, 31% of investors polled expect higher core inflation in 2020. Would you agree with that? Is that aggressive?
I think that's very aggressive. I think for inflation to raise at that rate, we would have to see a shift in the market that I don't see any indication of. So I would say that's very aggressive.
What do you have to see in the markets to just say, you know what, maybe we're going to be less cautious? I think there's a lot of fear starting to come out there regarding FOMO, fear of missing out. At one point, you just throw in the towel on being a little less cautious and go all into stocks.
Well, I think that's the trend I've been suggesting is happening. Now that we've had the interest rates lowered, unlike previous Fed chairman where you thought policy was going to be about the internals, this one is about keeping the market calm, keeping the market happy. If you read the Fed notes, they talk about the survey inputs and what the Fed is expected to do and not disappointing. And so I think that because we've seen some accommodation by the Fed of the market expectations. There's going to continue to be comfort and confidence in the markets, and that's going to bring flows into equities. It's going to bring growth. It's going to bring consumer spending. And I think also the trade tariffs are a bit overplayed in terms of drama. I think it's political theater more than it is actually driving changes in the economy. If you look at the growth in the S&P year to date, the fastest growing sectors in the S&P are those that should be hit by the tariffs. And we're talking about industrials, we're talking about consumer goods, we're talking about technology. Those are the ones that were hit by the tariffs. The underperforming sectors in the S&P are the ones that should be immune to the tariffs, which are financials, utilities. And you see right now, the real thing happening in the market is people investing, things are growing, and earnings are good, the Fed's staying pat, and so I think we're going to continue to grow.
You know, Greg Dacko, who's often a guest here, an economist over at Oxford Economics, said that he believes the trade war has shaved about 0.8% off GDP. Doesn't that mean it's having a real impact? And when are we going to start seeing it flow through to earnings in a big way?
So that's a lot higher than our estimates. Maybe that is if we took it to the extreme, all the tariffs were in, maybe you can get close to that. But our estimates are not that it's shaved less than that off. Mm-hmm. But the trade war has definitely had impact on sectors. I think it's had impact on most broadly on CapEx spending, and the very well understood there's been a big divergence between services sector and manufacturing in the U.S. as well as in Europe. And let's not forget, Europe is more exposed to trade than the U.S. is through the German car manufacturers, et cetera. So there's a big gap open up between services side and manufacturing side. And I think that's largely due to uncertainty around trade. I mean, how do you make plans about what you're going to do in CapEx when you don't know what is going to happen with trade going forward? So it's had a big impact, we think, on that side of the economy. But that can stabilize. In our view, that's kind of stabilizing here.
Jared, back to you.
Yeah, we have the Dow Jones Industrial Heat Map here. Tech is doing all right today, but not Apple. It's off 1/3%. But for the year, we're just coming off another record high yesterday, by the way, 65% up for the year. And that is an increase in market cap of something like $485 billion. It's really a juggernaut. Microsoft also near record highs, up 1/4%. Financials a little bit underwater here. We do have the 10-year T-note yield down about 1 basis point. So JP Morgan down about 0.1%. Goldman Sachs down 0.2%. Let's get to in earnings stock, DR Horton, excuse me. And Brian, you were mentioning this earlier to me. Now it is up 60% year to date, and they had some nice earnings this morning. A lot of that was on the back of refis, and we have the 30-year yield up about 30 basis points this quarter. Most of that just in the first part of November. So that's going to be something to watch for these home builders, which have really outperformed a lot of this year.
Yeah, thank you, Jerome Powell. Rob, we've seen an interesting thing start to happen overseas. Yields in some of these EU countries have gone from negative, like we've been talking about all year, to start to be in positive. What does that mean for some of these struggling, indebted EU countries next year?
So we've seen European yields follow U.S. yields, higher from the absolute lows. They've kind of moved together, these core yields, if you like. The key thing for Europe is growth, right? So the level of financing, at the current level of finance, there's no real stress can be created by refining at the current levels. What really Europe needs is growth so that they can continue to grow to service those debts. So the effectiveness of monetary policy and the getting a reasonable resolution to this trade issue, we think is the most important thing. Because don't forget, as an economy, Europe is much more open than the U.S., has a much bigger exposure to trade than the U.S.
I want to get back to the U.S. for a moment and talk about these streaming wars, because Disney Plus launched today. Are you playing any of these big players in this space right now? How are you exposed to this streaming war stocks, if you will?
You're asking me about my big secrets. We are a growth-focused advisor, and in order to find growth, you got to find disruptive technologies. And we all remember sitting around the TV watching a show because we had to set our watches to that time and sit down and watch it.
Yes, we do.
Streaming has completely changed that, and it's disrupted the industry. And I think Disney coming in at about half, if I believe, the cost of Netflix might give them some initial traction. I think that there's a stigma around Disney, though, that they push their brand primarily in their broadcasting. I've got a nice little streaming portfolio, but I don't know if I want to talk about it on the public. And let me tell you why. These are small companies that are going to be exploding really big around the web. And Disney is too big, I think, to be nimble. But they had to get in this space, and I think it's more of a defensive move than it is going to be accretive to earnings.
So wait a minute. So you're telling me that there are smaller names out there that you actually think have better potential, a bigger opportunity for investors than a Disney, with all the content they have?
Yes. So artificial intelligence and data visualization is going to make streaming interactive. And so when we think about how much of a shift we've gone from sitting and watching a static program that was scheduled at a specific time, now we can access the programming that we want. What if we could access the programming that we want and interact with it? This is technology. This is artificial intelligence. What if consumer products and goods could be presented to individuals in real time based on their preferences? So there's some technologies that are coming that are going to be explosive opportunities for investors.
You can't share any names with us at
Hey,
all.
whatever you're pitching, I'm sold. I mean, I'm hooked. Like, I'm waiting on every word here. What else do you like for 2020?
Wow. For 2020, I like caution. I like opportunistic trades. We're talking about this trade war. We see opportunity and chaos there. What's going to happen with this trade war is that if President Trump wins, he's going to continue to use this as a tool to control the markets. What's going to happen, Taiwan, which is the #1 economy in terms of the stock market, is going to have to move some of their exports offshore of China into Southeast Asia. And I see opportunities in Thailand, I see opportunities in Vietnam, I see opportunities in Singapore, where relatively small economies can become extremely big out of this chaos.
The veteran unemployment rate is at its lowest since the year 2000, but that doesn't mean the service members who are transitioning into civilian life don't face real challenges. It's an issue that JP Morgan has invested in. Recently, I got to speak with Mark Elliott, JP Morgan, head of military and veterans affairs. I started by asking him how the firm is utilizing veterans throughout the company.
When we bring veterans into our environment, they're familiar with a lot of different things. We say that these veterans left a family. And so we said we want to create this ecosystem for these veterans where they come into this and they feel like they've gotten a big hug from our organization. And so we have this idea of the first year is so important for an employee. We say this first year is important for our veterans as well. So we put some programs in place. One of them is our Pathways program, where we say, listen, we're going to touch you a number of different times in this first year. We're going to give you an opportunity to rotate through a couple of jobs to see what fits for you. One of the biggest challenges that they had back in 2011 when they were placing all of these veterans was finding the right fit for this veteran, not just giving you a job, but creating an opportunity for a new career. So we say, let's give you a few opportunities to rotate to see what fits well with you, what fits well with the organization, and it has just done amazing things for those veterans.
And there's a new program, the Empower program. Tell me about it.
So Empower is another way that we look at the veterans and we look at the skills that they have and we say, listen, you bring a lot of what some people call soft skills, we call them anchor skills. And so we said, how do we couple your anchor skills with some of the training that an organization like Empower can provide? Many of those skills are around technology. So we have a big need for software engineers. So we can send these individuals to a program like Empower. They provide that skill, and then we can bring them into our organizations, and then they flourish. Along with those anchor skills, they can do amazing things.
When you talk about soft skills, there are a vet has discipline, a vet who has been perhaps an officer has leadership training. Those are some of the soft skills we're talking about. Yeah. These hard skills, they are now in demand.
Yes.
So are the vets finding it, those who are coming back into the workforce, the private sector, I think the unemployment rate for vets is 3.2%, where in the greater population it's 3.5%. Are they having difficulty right now finding positions, and these programs, are they helping them getting positions that perhaps pay better than what they would do on their own?
Yeah, I mean, so veterans are going to get employed. The challenge is are they properly employed? Are they gaining gainfully employed. A lot of times you'll see the employment rate low for veterans, but we find that in some areas they're underemployed. So it's about, do they have the right skills? Are we providing them with the right skills? So those are the things that we're doing with these programs. Whether you're talking about utilizing an Empower or some of the things that we do internal to organizations, that's the key, is how do we find that right job for Mark so that when he comes in, he feels like he's value adding on day one. But probably just as important, that hiring manager understands how does he leverage the skills that Mark brings to the table, and how does he help the rest of the team get the best out of them, because those anchor skills that Mark brings is a value add to the team. So we think all of those things combined together really just makes for a stronger organization.
I got to begin to wrap up, but I am curious. If someone's watching right now, but they're not one of the 200 companies, what can they do if they want to reach out to the organization to try and employ vets that might be linked up with, whether it's Empower or the other?
So one of the things I would tell you to do is we partner with SHRM, the Society for Human Resources Management, and so we help them develop a toolkit. So for any company that wants to start a program like this, they can reach out to SHRM and they can use that Veterans Toolkit to say, how do I start this program in my medium, my small company? We know they don't have the same resources that we have, but we believe that as a coalition, it's important to share some of those best practices. So that tell them that's one of the first things they do is reach out to SHRM. And then if they want to have some more, then just look up the Veterans Job Mission and they'll see all of the wonderful things these 200 plus companies are doing.
And then finally, because we stream globally, there could be some vets who are watching their investments and watching this. What's the hardest part for them about the transition from active duty back to civilian life and then civilian employment? And then what can we, as their fellow employees, once they're making that transition, do to move this situation along?
So the first thing that I tell these veterans that are thinking about getting out, it's never too soon to start having a conversation. I believe the conversation needs to be much further left of their transition. I would argue it needs to be all the way back to when you first come into the military. So you're developing a reputation for what skills you bring to the table. You're having conversations with various organizations. You're getting the necessary education. So necessary. We believe workforce development is important for the future. So all of those things need to be part of an earlier dialogue with our servicemen and women before they become veterans. So I would say it's never too soon to start.
We should also point out that Mark Elliott is not only the J.P. Morgan head of military and veterans affairs, he served 28 years in the U.S. Army, 2 tours in Iraq, and he retired as a colonel. We are grateful to his service and all the service that our veterans provide.
MIT economist Esther Duflo is one of 3 recipients of this year's Nobel Prize in Economics for her work in what the committee called an experimental approach to alleviating global poverty. Duflo is also the co-author of the new book, Good Economics for Hard Times, with her husband and fellow Nobel laureate, Abhijit Banerjee. And Professor Duflo joins us now to discuss. Thanks so much for coming by. Congratulations. We're also joined, of course, by Yahoo Finance Fed and economics correspondent Brian Chung. So, Professor, what stood out to me in the book, there was a discussion of just the profession of economics, I think, where it stands today, and saying economists, rather, were kind of more like plumbers. And, there was a direct comparison to physicists. And, on Wall Street, I think economists believe they're more like physicists. And I guess as you see the field of economics right now and the discussion we're having about public policy, does there need to be, or should there be more of a redefinition about what economics really does versus what I think the public thinks it does, which is predict what the economy happens, what happens in the economy, basically?
Yeah, I think it's reasonably urgent that it happens because economists is one of the least trusted professions about their own field of expertise. The only people who are less trusted than us are politicians. That's true anywhere in the UK and in the US. And that means, for example, the trust in weather forecasters is twice as high as the trust in economists. And I think one of the reasons is that the public sees us as one of two things. Either we are, the chief economist of a bank, say, who naturally represent the interest of this institution or maybe of the system at large, or we are seen as forecasters. And the problem is that economic forecasting is really, really difficult, and we are terrible at forecasting. Not much better than random, and about the same as just picking last year's growth rate. So no wonder the people doesn't trust us if what they think is what we're doing. But in fact, the reality of the economics profession is much, much different. The research that is happening is on any number of subjects having nothing to do with forecastings, such as how people behave in response to a more generous social welfare state or a less generous, such as how to fight global poverty, which happens to be my own beat. And we feel that these voices get very little play in the debate, and that's a little bit unfortunate. So that's kind of why we wrote this book, to try to be a voice to the profession at large on these really key issues that agitate us.
So let's talk about the work that won you the Nobel Prize. Focus on development, microeconomics, and the idea that you can't just necessarily throw a bunch of money into a country and expect those programs to work. That in many cases it's about how you deliver those programs, what the uptake of those programs are, and you used what you call randomized control trials. So tell us a little bit about how you localize development microeconomic policies that can really reduce, hopefully in the aggregate, world poverty.
Yeah, so our work basically starts from the premise is that you have to move from the big, not well-defined questions like why are some countries poor or does aid work, to better defined questions. For example, if you think about poverty, think about one dimension of poverty is not to be very well educated. So then we can move and think about education. And in particular, if you think about education, we can think, well, kids are in school and they're not learning, so why is it that they're not learning? And once we move that, you say, well, there could be any number of reasons. Let's pick one and see if we move that, will that change? For example, if we put textbooks in school, are kids going to learn? Or if we put computers in school, are kids going to learn? Once you define the problem that way, then you can address it with very much the same tool as you would use to test a new drug in medicine. So we set up these randomized control trials, always in collaboration with partners on the ground, like NGOs or the government, where you take, it could be 100 schools or 1,000 schools, randomly select some to get a particular program, another set to get another program, or to get the status quo, and then you compare them. And because you've randomly assigned the two programs, you know that there are no difference except that they got different programs. And if the test scores are higher in some schools than another, you know that it is because of the intervention. So you can move forward with that.
So to move from global poverty to what's happening here in the United States right now, with income inequality becoming an issue for the 2020 campaign, what do you think is the best defined question then, to use your words, that politicians should be asking right now to get to the heart of this issue?
So you can do exactly the same kind of shift and say, well, immigration, well, that seems like a big and scary subject. Let's move it into smaller questions. Number one, what really are the migration flows? Are they really large or are they not that large? Number two, do the wages of the native population suffer or not when a lot of migrants come in? Again, that's a question you can now answer, not necessarily based on RCT, but based on natural experiments that have happened in history. So there is any number of these questions that you can ask these ways. I think the migration question is a very important one, because we need to know, it turns out, for example, for migration, is when you look carefully at the evidence, which the whole literature has done before us, you can see that by and large, you never see any effect of even a large number of low-skilled migrants on the wages of the native population. And I don't think it's something that most people know. The intuition is very much the reverse. so that there would be a trade-off between letting people in because we are good people, but then at the cost of the native population, whereas in reality, that's not true. So once you've established that fact, then that's kind of puzzling. It goes against our intuition. What we're trying to show is that often our intuitions are wrong. But once your intuition is wrong that way, you don't have to stop there. You can say, well, how come?
And it's also smart to rethink, I think, of not just fiscal policies, but maybe even the definition of welfare. Your research where you tested the hypothesis of whether or not lentils, right, being dropped into an area as a incentive to take up vaccines actually increase the intake of vaccines and actually reduce the total cost of the program, which means that we might think of an incentive as something that's costly, but it could actually reduce costs in the end. Do you think that there's kind of a stigma in fiscal policy about we don't want to do anything that would be a handout or a giveaway to communities that need it, but even though in reality it might be effective in some communities in some areas?
Yeah, one thing that is completely common in poor countries and in rich countries is a deep suspicion of people who need help. There is this idea that if you need help, you're probably trying to take advantage of the system one way or the other. And in the poor countries and in the rich countries, very much in the US, since the welfare queen, there is that implicit bias, I would call, in the system, which I think is very, very damaging. First of all, because it prevents some of the people who really need help to even take it. I've done a project on food assistance, SNAP, that have replaced food stamps. And people are really discouraged by any hint of stigma that this is for poor people, this is not for me, even when they need it. Number two, the people who don't need welfare yet, who don't need assistance yet, are so trained in thinking that requiring help is demeaning that they are terrified of any change. And because they are terrified of any change, that of course makes them much less likely to seek out opportunity, much less wary about the changes that exist in the world naturally, and generally very unhappy because in our times there is changes and disruption everywhere. So I think it is really, really important to rethink that, especially since, once again, all the evidence we have suggests that people are not at all discouraged from working by more generous welfare. We just don't find it. There are like dozens of RCTs on transfers in poor countries, middle-income countries, and some experiment in the rich countries as well. People aren't lazy because most of all people want to have a meaningful job. That's something that is actually a human desire, I think.
All right, Esther Duflo, MIT economist, co-author of the new book, Good Economics for Hard Times, also Nobel laureate. Thanks so much for stopping by today.
Thank you.
Our next guest is an Air Force veteran who founded a company that flies unmanned aerial vehicles for the oil and gas industry. And joining us now to discuss is Diane Gibbons, CEO of Trumbull Unmanned. Diane, welcome. Your area of expertise ranges from engineering to logistics to artificial intelligence. How were you prepared for this by your time with the U.S. Air Force?
Sure. First, Jen, thank you for having me. Excited to be here today. And, transitioning from the Air Force to industry has certainly been a fun and interesting transition. At the Air Force Academy, I studied engineering, I instructed skydiving, and learned to fly. And I went to pilot training and ultimately served as an acquisitions officer managing stealth nuclear cruise missiles. And so that set me on an unmanned path, an unmanned trajectory, if you will. And beyond that, my PhD coursework and research in industrial engineering focused on integrating unmanned systems into technology. So I wanted to use unmanned systems and robotics to improve environmental sustainability. I wanted to use robotics to support national security, and I wanted to use robotics to engage and empower the next generation of scientists and engineers.
Now, Diane, for our viewers who don't know what Trumbull Unmanned does, I mean, you guys have contracts with some major Fortune 500 S&P members that our viewers would know. What's kind of the overview of what the day-to-day looks like, I should say, for your business and kind of where you guys are most involved right now?
Sure. And so Trumbull, we're a Forbes Top 25 veteran-founded startup, and we support autonomy and robotics. And specifically, we fly drones in challenging and austere environments to collect and analyze data for the energy sector. We also develop and integrate technology. So right now, as I'm speaking, Trumbull is spread across the country, supporting 4 projects, primarily for super majors, so the Exxon Mobils and the Chevrons of the world, as well as Department of Defense. And so we're, you mentioned ExxonMobil, we are scaling a global contract with them right now on inspections, and we're really excited to do so. They were our first client.
It's so amazing, a lot of the work that's being done right now using drones, the work that you're doing. I just saw a piece that the Wall Street Journal put together using drones to go and look at PG&E transmission lines in areas where there could possibly be forest fires. So I feel a little silly asking this question, but honestly, I think what a lot of people want to know is when we're going to have drones in our own lives as consumers. And as somebody in the industry, when do you see that happening? I mean, when are drones going to be delivering a pizza or delivering your groceries? Is that in our lifetime?
Sure. And so, Jen, you touched on a few really fascinating things right now. One, you mentioned PG&E in California. And so Trumbull was awarded a Department of Interior contract to fly drones to identify, track, and prevent wildfires. So that's something, we're excited about how unmanned systems can be used for the greater good. And you also mentioned them being part of our daily lives. The number of certificated Part 107 or unmanned pilots surpassed the general aviation population. So we're seeing a fundamental shift in how aviation and aeronautics is taking place. And so we're certainly seeing those advance at an increasing rate.
Diane Gibbons, Trumbull Unmanned founder and CEO, happy Veterans Day.
Thank you. And if I could just say that we're very excited about the veteran families that support veterans as well. So to the parents, to the spouses, and the children for the shared sacrifices they've made as well. Thank you again, Jen and Miles, for having me. Appreciate it.
Thank you so much for that.
Google has quietly been gaining a foothold in the healthcare space. Google launched Project Nightingale last year with Ascension, one of the country's largest healthcare systems, to collect data on millions of patients across 21 states and Washington, D.C. But here's the catch. Patients and doctors were not notified of the partnership. Dan Ives is back with us. He's from Wedbush Securities. Dan, obviously that's not good from a consumer standpoint, but if you own Alphabet stock, you own Google stock, do you mind them mining data, potentially earn more per share each quarter?
You look, I mean, fundamentally, if you look healthcare, it's not just Google, Amazon, Apple making big bets on healthcare. And I think this is just the first step because they're trying to get further entrenched within the consumer ecosystem. Obviously, this is a little bit of a noise in terms of the way it's coming out, but in my opinion, they're going to do M&A as well as more organic initiatives on healthcare.
Speaking of which, Fitbit for over $2 billion, I'd have to think that this is part of that larger, grander scheme for them.
Yeah, it's all part of the broad. I mean, that's why they went after Fitbit, because really comes down to health. If you look what Apple's done on wearables, well ahead of where Google is. Right now they're trying to catch up. But I think if you look at it from a mining data perspective, it's a balancing act, right? I mean, in terms of all the spotlight they have in front of the Beltway right now, I think Google needs to walk gingerly, but healthcare, right now it's an arms race. If you look at Google versus Amazon as well as others.
What other types of companies in healthcare might make sense for them to go out there and acquire? Is it a Cerner? Is it medical equipment? Is it Intuitive Surgical? You just go into bigger types of medical devices?
I think it's more on the AI side. I could see more AI technology on healthcare, more analytics. I could see more smaller acquisitions to build upon what they've done in Fitbit, as well as just their core initiatives. But I also see that with Apple, IBM, and others. Because right now, if you look at big tech, that's sort of the next frontier in terms of health.
Do you think other companies are doing the same thing where patients and doctors don't know they're mining the data? It's just this news actually became public on Google?
Look, I mean, I think it's hard to say, and obviously it's not a great look for Google in terms of, so I'm sure, there's some memos going on in 202 area code because of this. But fundamentally, I mean, it's tricky because they're trying to mine the data. And fundamentally, in terms of healthcare, I think there is gray lines right now being crossed because you're seeing more of the tech companies getting further entrenched on healthcare, the more in wearables that you see, just like Apple. Although Apple is obviously, from a privacy perspective, on another sphere versus the Googles and the Facebooks. So for Google right here, the opportunity's there, but no doubt it's a balancing act, as you see today.
Dan, while we have you here, switching gears, what did you make of the Uber uproar?
It's a jaw dropper. I mean, if you look for Dow right now, the last thing on earth as an investor that you want him and the board and the company to be focused on is getting into a political firestorm on the Saudi Arabia situation. I think it just speaks to, since the IPO, they just continue to sort of trip over their own shoelaces.
Do you think he survives the next year?
Look, I think it all comes down to execution. Because I think if you look at right now, I think patience is wearing thin among investors. And if you look, a lot of the turnover they've had on the executive, it all is on his shoulders. And thus far, what you've seen is investors sort of voting against that in terms of what they've seen. But you look at this week and this sort of noise, I think this just adds to sort of the black clouds around Uber.
Right, and this, we're referring to his comments about Jamal Khashoggi's murder in Saudi Arabia, saying that it was, quote, a mistake. I mean, Saudi Arabia is Uber's 5th largest shareholder. I mean, I would have to just think optically, this doesn't look good. I mean, I know he's saying now he spoke incorrectly, he didn't use the right words. Does that even matter at this point?
But why even go down that point? I mean, have you ever seen Bezos do that? No. Cook, Ballmer, Nadella? So it just speaks like, if you're trying to put yourself in that sort of sphere, these are not the types of comments that you want in such an area that you don't even want Uber associated with, just given the situation there.
The magical world of Disney Plus is finally here. The streaming service went live this morning in the U.S., Canada, and the Netherlands. Disney celebrated the launch, tweeting, "Cue the confetti and tears and fireworks. Start streaming #Disney Plus now." Well, not everybody is able to celebrate, though. This is the error message that some Android users are getting when they try to open the app. Well, when everyone is able to log on, there's going to be plenty to watch. In the first year alone, the service will have over 7,500 shows and more than 500 films, including the new Star Wars live-action series The Mandalorian, plus content from Marvel, Pixar, animated and live-action classics like Lady and the Tramp, National Geographic, and of course the recently acquired Fox catalog, not to mention all those Disney Plus originals. Here to break it all down for us is Dan Ives of Wedbush Securities. We're also joined by Yahoo Finance's Dan Roberts. Good morning, guys.
Morning.
I want to start with this, Dan, first. Disney Plus today, would you call it a game changer in the streaming wars or not?
I'd call it a game changer. It's the first real competitive threat to Netflix. If you look at the content, I think for Iger and Disney, it's really a major shot across the bow at Netflix. And I believe those 60 and 90 million subs that they've given longer term could be reached probably 2 years earlier. So I think this combined with Apple, I think it could disrupt about 10 to 15% of Netflix's core customer base.
Dan, how big could this really be for Disney over the next 1 to 2 years?
I think huge, but not only is it a competitive shot at Netflix and Apple TV Plus, it's also a huge risk for the company. I mean, let's just not understate how much Disney is betting on streaming. So not just Disney Plus, Dan, you know this, but also Hulu and then ESPN Plus, which we know Disney is bundling those three for $12.99. The Hulu in that bundle does have ads, but none of those three things is profitable yet. Now, of course, Disney Plus has just launched, but it's going to take a while for these things to be profitable. Some analysts estimate 4 years, big costs, and in fact, reportedly, and Disney hasn't confirmed this, but reportedly some of these original Marvel shows cost $25 million per episode. So billions are going into direct-to-consumer, but Bob Iger has said very clearly, direct-to-consumer is our #1 priority at the company now. So Disney Plus has to be a success.
Couldn't that bundling that Dan just talked about, though, mean that more people are going to cut the cord? And does that in some way cannibalize Disney?
Well, it will accelerate cord cutting. But I think today, if you look, we think about $50 per month is what the average consumer is willing to spend on streaming, which means there's still room for 1 to 2 services. You also have Peacock, HBO coming in the spring. But fundamentally, for Iger, I think there's going to be a defining chapter for him. And I think it really wraps in a red ribbon in sort of his chapter as CEO in terms of them on streaming. There was a window of opportunity here, and they took, and that's why there's 71 billion reasons with the Fox acquisition they did that.
I know today's all the focus is on Disney, and rightfully so, but I like what you wrote in Apple, because Apple is obviously still a player in the streaming space. Apple can gain 100 million streaming customers in the next 3 to 4 years. That's not chump change. That is big money potentially to Apple's bottom line.
Yeah, and Apple has something that no one else has. You have 900 million iPhones that you could penetrate. So there's some words out there, content's missing. Right now, if Apple decides to compete with Chipotle, they'd actually be a competitor. And you have a massive install base. I think 100 million in the next 3 to 4 years. I also think content lacking here, but I think organically they're stepping up to about 6 billion per year.
Is that priced into the stock?
No. I mean, in my opinion, if they're successful on T, that adds $15 to the share.
I think that's really interesting, Dan's point about the install base, because a lot of people right now are focused on the content on Apple TV Plus, and specifically the content not being that good. The reviews so far are not very good across the board for the original shows. But let's keep in mind, they just have such a huge volume of install base that is automatically going to get Apple TV Plus in the first year if you buy a device. And so if you check in on Apple TV Plus in 2 years and look at the number of subscribers, it's going to be a very significant number, even if it's still the case 2 years from now that the shows aren't generally received as that good. I mean, Apple can kind of automatically get scale because of how many people out there have an Apple device.
No, it's a great point. What I'd also say is this also speaks to what you're seeing in Disney and Apple. The stocks are getting re-rated because of the streaming potential.
Do you think if somebody's going to take on more than one streaming service in a month, what are the 2 or 3 that they get? I mean, I would imagine if you have kids, you can't not have Disney.
Yeah, I think Disney, you could see that, again, at 60 and 90 million in terms of their sub. That's very conservative. I think they could reach that 2 years earlier. So I think Disney, and then you look at the price points on Apple, $4.99, especially, the bundling features, that's going to be key. And then look, then it comes down to HBO and Peacock coming out in the spring. HBO high price points, but Friends and other, franchise they bought, they're making a big bet.
Do you think all these Netflix bulls out there understand that there's potential disruption to Netflix because of these streaming or the competitive streaming launches?
I think they do, but I think fundamentally right now they're at the top of the heap in terms of Netflix. 160 million consumers. They've spent $15 billion a year on content, so they continue to have miles ahead of the competition. But again, with 2 individuals, Tim Cook and Bob Iger, now going after, I think now it sends a ripple effect.
I'm thinking massive disruption.
In my opinion, right now, we're bullish on Apple, much more cautious on Netflix because of this, because just like you talked about, Disney is a real competitor.
Yeah, and I'm glad you asked about sort of the either or, because I think what you're hearing from everyone across the board is that in the near future, all 3 of these things can coexist. I have a story up on the site today that says that people have kind of overstated, like, oh, watch out Netflix because of Disney Plus. In a few years, maybe. But for now, people aren't going to cut Netflix to sign up for Disney Plus. They're going to add.
If you're an investor and you want exposure to the streaming wars right now, where do you go?
I think now you start to look at Apple and Disney as streaming plays, because I think if they're successful, you start to see a stock Disney that goes significantly higher. I think Apple right there, that could add $15 per share. So streaming, even though many investors look at Netflix, I think right now you really start to look at that, and then even look at AT&T with HBO Max in April.
Well, several American cities are making entrepreneurship easier, especially for those who have served in the military. According to a study by PenFed Foundation, the best metro areas for veterans to start a business are New York, Newark, and Jersey City. The Chicago area comes in as the second best metro location for those budding veteran entrepreneurs. The study ranks cities by its support for veterans, ability to start a business, economic growth, and livability. Joining us is James Schenck. He is the president and CEO of PenFed Credit Union. Good to talk to you on this Veterans Day. Let's talk more about these findings. We're sitting right in that area where you said was the most prime for veterans who are looking to maybe start up some businesses. What specifically stood out to you about the New York area?
What the study showed that in New York alone, there's over 2,000 organizations that support veterans. And over the last few years, with state and federal government funds, over $20 million a year is helping veterans launch their businesses. So it's a great city. The livability index is outstanding, and a lot of amazing human capital to draw from when they launch their businesses.
How important is that support system, especially for veterans who are looking to get started in their businesses? And how does that differ from some others who are looking to create their own startups?
All entrepreneurs need two things. They need access to capital, and they need an ecosystem of support. And so I think you see that, and the study has identified those cities that offer that. So New York, amazing access to capital. So when a veteran comes in and pitches an idea or a business plan, they have access to organizations that can help mentor them, help them grow. And they have business partners that they could refer them to during different phases of the decision sets that business needs to make.
There's another list that you have going here, which is the emerging cities for veteran entrepreneurs. We've got Jacksonville, Florida there, Denver as well. What are you finding in those areas that maybe you don't see in some of the major metropolitan areas we pointed to, like a New York or a Chicago?
Well, if you look at like Jacksonville, Florida, or San Diego, for example, they're big Navy towns. You have a lot of military bases. You have a lot of military professionals. You have a lot of logistical firms and government firms who support the military bases in those cities. And so that helps provide the veterans that support network they need of other business owners and other leaders who understand them and are willing to give them that start, that capital, or that mentoring they need.
And what do you think it is about that military experience that makes these entrepreneurs, or that creates or fosters the type of skills that are necessary for entrepreneurs as they look to start their own business?
Veterans are mission focused. Those who serve in the military have amazing training. They have amazing leadership skills. They have amazing focus on not letting barriers slow them down. To start a business, there's always a lot of barriers. They have to keep driving through and moving the organization forward. And the one thing I think separates veterans from other entrepreneurs is that true grit, that ability to focus, to keep moving forward no matter what the challenge in order to get the job done.
Okay, James Schenck, great to have you on. Thanks so much for joining us today.
Thanks, Akiko, for having me on this day.
Disney Plus is now live, although not for everyone. Many Android users are finding this morning that the mobile app is down for them on day one. Now, Disney is betting big on this new streaming service, spending big. Some analysts say it won't be profitable for 4 years, and some reports out there say that some of the original Marvel shows on Disney Plus have a budget of $25 million per episode. Woo! Joining us live from Austin, Texas to discuss is T.G. Watkins of Simpler Trading. T.G., thanks for joining us. Just how big could this be for Disney? How much of a threat to Netflix?
Hey, good morning. Well, I think it's going to actually be a huge threat. They've got the capital, they got the money behind them to really, as you say, take some losses in the beginning and build up that clientele and get everybody on board, show them the kind of subscription that it's going to be like, and then maybe run over Netflix, or at least give them a good run at their money.
Well, I mean, yeah, is there any sense of how profitable this could eventually become? I mean, we know the legacy media business is still very profitable. The margins are good in that business.
Yeah, well, I think what we're seeing is with everything going over to internet and with Netflix, they've shown that this can be profitable. They're doing well, and I don't see why Disney getting on board next and kind of trying to compete with, ESPN, actually taking on ESPN and things like HBO. They're going to do pretty well, and they've got the backing behind them. They're just going to say, hey, we're new to this space. Let's get everybody on board. Let's show them what we have so that they really like it. Like, as I said, they have 4K streaming. They're going to be really throwing some extra add-ons at a lower price to get those people on board, and then maybe they'll start looking at profitability later.
Extra add-ons and a low price, as well as, we've seen how there's a lot of options out there, and we've seen the consumer behavior when it comes to HBO Go or HBO's platform when, Game of Thrones was out. Do we see that kind of flow possibly happening for Disney as well, or are they looking for really, consistent customers?
I do think that they're going to be looking for consistent customers, but they need to have those kind of box office hits. Like you said, Game of Thrones, they're going to have to figure out what it is that they need to bring on board to really draw those people in for those bigger shows, whether it's going to be Marvel movies, whether it's going to be some other something that we don't quite know yet, but they're going to get it on board. They're going to make sure everyone's happy, and then they're going to kind of knock on those doors, I think.
TG, let me ask you, when we talk about Disney Plus and Netflix and Apple TV Plus, initially, for the last few months, a lot of stories would pit those against each other and say, uh-oh, it's a big competition here. But more recently, what we're hearing is actually, at least in the near future, most consumers who are used to paying for OTT apps are still willing to add more before they cut. That is, these aren't mutually exclusive. People aren't going to cut Netflix, at least at first, to add Disney Plus. They'll just add. And so you wonder when that time will come, when we do hit the tipping point where suddenly more people decide, wait a minute, I'm paying for 8, 9, 10 of these things. It's time to cut a few.
Well, you're correct about that. The other thing to think about this, because I was going through the numbers the other night, is some of us are kind of used to paying quite high prices when it comes to cable. I mean, think about sports networks or what we used to be paying for satellite and cable. Owning multiple of these are now cheaper in the aggregate than owning cable and satellite. So maybe for, as you said, quite some time, people are going to be okay owning multiple of these and paying a fair amount because just the overall cost is less. Maybe in the future, as they start to kind of aggregate everything and congregate, then they will start figuring out which ones they want. But I don't think it's going to be too much of a problem initially.
TG, let's talk about the stocks before we let you go. I mean, how much more room do Disney and Apple have to run specifically thanks to streaming? I mean, Apple TV Plus, for example, not great reviews so far of the shows, but Apple just has that huge install base. So that's a built-in audience that are going to become subscribers to Apple TV Plus. How much of the stock gains over the next few months do you think can be contributed directly to Apple TV Plus? And same for Disney. Is that a streaming play now?
Well, as with Apple, it almost seems like it might be already baked in the cake. Apple, over the last couple of weeks, months, has been doing phenomenally well, and it's really quite incredible what they've been doing. Now, Disney, if we look at a longer-term chart, I was actually just showing somebody this morning that they've now pulled back to some key support on the higher time frame charts, and they look like they're exactly poised to really take off and get going. And at only about $130, they've got a lot of room to the upside to go compared to where Apple is or where Netflix is. So I think Disney would be a real good play, but Apple looks like a really good one as well, considering it's the rest of the real importance is where it has been going over the last few weeks, which has been straight up.
All right, TG Watkins of Simpler Trading. Good stuff. Appreciate it. Talk to you soon.
Great. Thank you.